Very good morning, all of you. Very good morning, and thank you very much for joining this Sunday, the only free day you get. But I thank all of you for dedicating this Sunday for learning. Thank you, and a warm welcome to CA Raja classes. Hi, Prasun. Good morning. And any of you attending my webinar workshop for the first time, just type FT and please mention the name of bank you are working for and location from where you are attending this. Yeah, Prasun, good morning. Surat, good morning. Dilip attending for the first time. Anil, first time. Welcome, warm welcome. It's a marathon workshop. We are starting by 9:30 and it will go up to 5:30 or even stretched a little. Yeah, Vinay Sood, good morning. Bharat, good morning. Dilip from, okay, I believe from Nepal. Saikat, good morning. If you are attending from outside India, just mention the name of the country as well. Viresh, good morning. Sabina from Nepal. Kadak, Bharat from Vijayawada, Andhra Pradesh. Yeah, Suman Kumar, good morning. So once again, I wish to thank all of you for dedicating this Sunday. It's going to be a day packed with full of learning. This is the workshop which I generally conduct for a premium fee, but I've made it a decision that yes, this should reach all. Let us not put money as a barrier. Okay, so that's the reason whoever have attended this workshop earlier by paying fee, it's my apology note for making it free, but my intention objective is to take this to as many, because what you are going to learn from this is very crucial. It will help you on the job, it will help to protect your bank, it will help to save the interest of depositors, because whoever attending this, I believe you are all in key role of credit function is the brain function of a bank, and there you cannot be an ignorant person, or you cannot be a person with little knowledge. In credit, little knowledge is a disastrous, a dangerous thing. So I thought it is my responsibility to take this knowledge to as many as possible. That's the reason I made this session, full day session, free. So whoever have attended my workshop, the same workshop, one full day workshop, by paying close to 3,000 rupees, it's my apology note, but please excuse me. I want to take this to as many as possible. Okay, right. Now, before we proceed further, whether my audio, video, everything is clear. If audio and video is clear, just type AVC. AVC stands for audio, video, clear. Yeah, this side, Roshan, YouTube, Harsha, yeah, welcome. Pooja, welcome. Tarun Agarwal, welcome. Perfect. So thanks a lot. And even before we get into the presentation, I wish to make 2 or 3 announcements. Number one, see, since because this session is given free, okay, please do not pre-frame anything on the quality of the workshop. It's prepared with so much of effort. Several hundreds of bank executives have already attended this workshop by making fee payment, and all of them have given really wonderful feedbacks, and that only motivated me to take this workshop free once in a time, okay, or once for all. So do not pre-frame anything on the quality of the workshop. As the time passes, automatically you will understand you are deriving value. Number one. Number two, please have a notepad, pen alongside, and also a bottle of water. Please have a notepad, pen, and bottle of water. And if any of you are facing difficulty with the audio, If any of you are facing difficulty with the audio, because I just received 1 or 2 messages, it could be on account of internet connectivity on your side. Okay, because majority 95% they are okay with it. 5% there are some issues. It could be the internet speed. It happens. It happens. Okay, right. So the second announcement is, please have notebook, pen. You will have opportunity or necessity to note many things in today's session. So have that, and also have a bottle of water. Okay, keep hydrated. Number 3, the structure. Yeah, before that, shall I take a couple of minutes to introduce myself? Just type yes. Just type yes. See, I'll keep asking you to type out something, basically to ensure we are connected. We are connected because I have my own history in many occasions. This internet, without any prior permission, it simply goes off. Okay, thank you very much. There are quite a few new participants. So I'll take a couple of minutes to introduce myself. I am CA N Raja, Chartered Accountant by qualification and an edupreneur, teacher by passion. Just a day before completing my Chartered Accountancy, I got placed in State Bank of India as credit analyst. I worked for credit analyst for a period of 1 year, then got elevated as team leader. So I worked in State Bank for 4 years, handled 250 plus projects. It's 5,000 crore plus size. Then came out, started my CA practice, had practice for a period of 7.5 years with predominant focus on debt syndication, project funding. Okay, but my heart always goes for teaching training. So parallelly I pursued teaching. I taught financial management, strategic financial management for CA students. Then I also registered myself as empaneled trainer with a top private sector bank, where I handled on working capital, term loan. I also had this online teaching parallelly. Today, thanks to technology, I teach 180,000 plus students all over the world. It is 180,000 plus students all over the world, and majority of them are in banking sector. So that's the power of technology, and all these are all on official note. And on the personal side, I'm father of 2 children, happily settled in God's own country, Kerala. And this is all about me. Okay, so thank you. And one more thing, if at all we face some internet interruption, okay, it can happen. I'm not I'm not praying for that, but if at all it happens, I request you to stay back. Okay, sometimes it may happen like 5 to 10 minutes and all, a delay will happen, but I would request you to stay back so that I can make alternate arrangement and get back to you. Is that okay? So just type start. Just type start. I will give the layout of the workshop, then we'll go ahead with the presentation. Yeah, fine. Thank you. Thank you all. So this workshop, I named it as a marathon workshop because I've conducted this for paid students several times. Today, it's going to be a marathon starting from 9:30 to evening 5:30. So our coverage will be credit analysis, basic, that is introduction to credit analysis, followed by financial analysis covering ratios, cash flows, fund flows. Then we'll move on to working capital, where we'll understand the concepts, assessment, all technicalities related to that. Then non-fund based products like letter of credit, bank guarantee. Then we'll go deeper into term loan, why term loan, how term loans are assessed, what is DSCR, all those stuff. Okay, so this is going to be the flow, and it's from morning 9:30 to 5:30, and of course we'll have breaks in between. It is a purely structured program, and all the contents I have recorded, so it will be played sequence by sequence, and I have the timeline for each and everything. So I'll try to stick to the schedule, and we'll have seamless presentation. You please be ready to learn. That's the only requirement from your side. So we'll get started now. In this session, let us understand what is credit analysis process, only its overview. Let's say there is a business entity and this entity is in need of money for its business purposes, maybe for working capital or for some long-term purposes like project. Now, who can contribute for this? Obviously, the owners are supposed to contribute, but it may so happen that owners cannot contribute all the money, so they will be approaching the financial institutions, banks for support. Now, these banks, financial institutions are mere agents of public. They have mobilized money from the public in the form of deposits or by issuing various instruments. So these money have to be used very, very judiciously. So these banks will not give the loan just like that. They will do various kind of analysis and they'll try to understand the customer. So an analysis process will happen here, and that's what we call as credit analysis process. So if that process gives them satisfaction that yes, this business entity is genuinely in need of this money and they are capable of repaying, then they will go ahead and sanction the loan so that money comes to the business entity. Okay, so let us understand that here the focus is on analysis. The very objective of this workshop is to make you understand what is the process, analysis process carried out by the bankers. Okay, so credit analysis process is a process which is adopted by the bank for sanctioning the loan. And who should understand this process? Bankers should understand this process because only then they can understand their customers. But customers should also understand this process because only then they will understand the rationale behind the various queries that are raised by the bankers when they approach for a loan. Because bankers are going to ask many queries to the customers when they approach for a loan, and many of the customers will not understand the rationale and they feel irritated or they'll feel dejected when too many queries are raised. But here we have to understand that bankers are mere agents of the public. They are supposed to ensure that money used only for productive purposes. So they try to ensure that by asking as many questions as possible. Okay, so bankers got to understand this process to understand the customers. Customers should understand the process to understand what is the rationale behind the various queries, and in between we have project finance consultants who are going to act as a link between the banker and customer in most of the cases so that they can understand both segments. Okay, so this project finance consultant should also understand what is credit analysis process. So what is credit analysis process? What is the process involved? The process is like this. Number one, the banks will be evaluating the management experience and expertise. Number two, they'll go through credit history. Number three, they'll understand the financial standing of the customer. Number four, they'll look into the industry condition and they'll look at repayment capacity of the customer. Okay, if all are convincing, then they'll go ahead and sanction the loan, otherwise not. Okay, so our workshop focus will be on understanding each and every aspect of this. Then of course we'll also be getting into the other detailed areas. In the previous session, we have understood what is the exact flow of loan applicants analysis, that is the credit analysis process. The first one is evaluation of management's experience and expertise. So how the banks are going to do it? I mean, it's purely a subjective matter, but I'm trying to give you some kind of a guideline so that can be applied. But again, it is purely subjective. It would vary case to case. So let's see. So here I framed a questionnaire which the bankers can use in understanding the management's experience and expertise. So let's say I have two customers. One is customer A, the other one is customer B, and both the customers are approaching. Let's say they are in the same line of business. So now I want to select the best customer. How would I do it? Let's say both customers are approaching A and B, in which one customer, that is A, has educational qualification and B has no educational qualification. Now this is going to be a subjective matter because educational qualification is an added advantage. So if I look at a customer who is having educational qualification,
probably I would be selecting that customer who is A, but it does not mean the customer who has no educational qualification has no experience or expertise in the business. Okay, so educational qualification is an added advantage that would enable the banker to select Mr. A, but it does not mean that Mr. B should be rejected. Okay, so understand, it is only an added advantage and it is not the criteria for rejection, because in my experience I have come across various entrepreneurs who are doing millions or billions of business without say graduation, a college graduation, or without masters. Okay, so educational qualification is not a mandatory criteria, but of course there are some kind of a loan, say for example professional loans, which can be given only for people who are professionally qualified. In that case, yes, education is the mandatory criteria, but for business it is not the case. So what we can do as a banker, A can be given preference, but it does not mean B is rejected. So banker have to apply some other test to weigh B in some other angle. Okay. Second, again A and B are approaching. We are going to measure from work experience angle. Mr. A has educational qualification but has no work experience. B has no educational qualification but has work experience. So now your weightage is getting shifted from educational qualification to work experience. A is a fresh graduate from an educational institution, whereas B has already worked in that particular line of activity. He has got a work experience. So in that case, more weightage will go for B because he knows what that business is all about. He has worked on them. That's not the case with A. So now if I reject A, now what is the risk? We are not encouraging new entrepreneurs. Okay, it means we are making people only to work, we are not allowing them to do their business. So again here bankers have to apply their mind. Okay, they have to see, even if this candidate has no work experience, whether he is capable of doing the business which he is proposing to the bank. Okay, so again some other parameters have to be looked into. Fine. And let me make one thing clear. I mean, all the items are not interconnected. I'm giving different scenarios. Okay, it means say the item A and B are not interlinked, they are different scenarios. So this is different, this is different. Now we'll move on to the third scenario. We are understanding that one of the applicant had been a trader, that is A had been a trader, B no. In this case again the preference can go for A, because since A had been a trader, he would have known who are the suppliers, who are the customers, where the product can be sold, at what price it can be sold, what will be the demand. So he'll know the pulse of the market, whereas B has absolutely no idea how this trade or how this business purchase and sales will happen. In that case, we'll have preference for A. Fourth parameter, experienced employees on board. A does not have any experienced employees, everyone fresh graduates, whereas B has experienced employees. Now from the bankers angle, bankers are very much concerned about the repayment of the loan. Repayment will happen only if the organization makes profit. The profit making is possible only if they have experienced team. So in that angle, here B will have more weightage than A. Then let's say good team. A has good team, B no. It means it has a good team of employees, because you need skilled labor, unskilled labor, then experts, specialists. So they have all, B does not have that. Then in that angle, A will get preference. Then let's say the promoters or the loan applicant is known in the society for association with various chambers of commerce. Here A is not a known personality, whereas B is a known personality. Now since because he is known very much in the industry does not mean that he has credibility. Okay, known in the industry means because of the media, yes, or because of the various social platforms or social network, they will be known or they'll be very visible. but it does not reveal what is their integrity is all about. So here the manager should evaluate the credibility, right? Should evaluate the integrity and do not fall prey for their status, okay, or their position. Of course, the status or position will follow only if they have good credibility, integrity, but that is not the foolproof. The banker should cross check and they should not fall prey for their celebrity status in the society. Next, this applicant had conducted extensive research and analysis. Who had conducted? A conducted extensive research. When he talks to the bank, bankers understand that yes, this guy has good knowledge of the business, what he is planning to do. Whereas B absolutely has no idea. For many of the queries of the bankers, he is not in a position to reply. In that case, obviously, the banker will select A. Let's say there is another parameter running another business. That is, A is not doing any other business, but B is doing another business. Now, how this will help the banker? The banker will be able to understand how efficiently this B is capable of doing the business. I mean, they need not wait for this new business to pick up. Already one business is run by Mr. B, and they'll be able to take a decision, yes, whether this guy is capable of doing a business or not. So if that business is going to report profit, okay, and if that business has not suffered any say bad debts, okay, or has not defaulted in any of the bank loans, then it gives a good indication that Mr. B is capable of doing business. In that case, they would select B. Okay, so now this are all the very simple parameters, but bankers have to apply their mind. They have to be very particular because evaluation of the management experience and expertise is the foremost, and only if they are convinced with the management they should go to the other parameters. Okay, so to summarize, when we say evaluation of management experience expertise, we have to understand this is the first and foremost. The management, the promoter should have knowledge of business, they should demonstrate their knowledge, they should have educational qualification, if not good work experience, they should have experienced employees on board, that should be good team, they should have presence, they should have visibility in the market. Association with various chambers will do good because that is going to bring in business, but that alone is not going to ensure they are credible or they are people of integrity. They should have conducted sound research on the business which they want to do. They should have analyzed it. Only then we'll get an overall framework or overall picture of what is the management experience and expertise. Let us move on to the second aspect in credit analysis process, that is credit history. I mean, the bankers are going to analyze the credit history of the customer, and how they are going to do it I'm going to explain through simple examples. Let's see. So again, I have categorized various scenarios by having two customers, A and B, and see in which customer the banker will have more comfort. Let's say two customers are approaching bank, and let's look at the number of loans outstanding for both the customers. Customer A has got 10 loans, customer B has got 4 loans. Or let's say the customer B has nil loan, no loan outstanding, no loan were taken in the past. Now, in which customer the banker will be more comfortable? Probably I would say with A, the banker can have a high degree of confidence provided if all the 10 loans are in good condition, right? I mean, Mr. A is managing all the 10 loans, there is no default, and the loans are not too high. It means, I'm going to use a technical term, he is not leveraged. I mean, he has not taken excessive loans. Only in terms of numbers it is 10, but in terms of volume it is low. So here the bank could go comfortable with A because bank can understand his credit history because he has taken various loans and he is regularly repaying those loans. It is not leveraged. But the bank can also say no to A if these 10 loans are not having satisfactory track record, he is not making payment on time, okay, and he has borrowed a lot of money. he is leveraged. In that case, A will be rejected. Now with regard to B, it is difficult for the bank to come to a conclusion about his credit management, because in the past he had not taken any loan. So they will not understand how this customer will react if he takes the loan, whether he'll make payment on time, whether he will delay, or whether he will default. Okay, it means the credit history, the credit knowledge of this customer is very limited or absolutely nil. So bankers may have some kind of reluctance for B, but they will go ahead with Mr. B if the security what he is offering is going to be satisfactory, or the business what he is doing is generating good amount of cash flows so that they can be used for paying the loan without any difficulty. Okay, so A will be selected if all the loans are having good track record and it is not highly leveraged. B will be selected only if the security or cash flows are comfortable. Okay, that's with regard to number of loans outstanding. Let's say there is another parameter which the bankers are going to look at, that is EMI service date. We know that when bank gives loan, those loans have to be repaid on a fixed date. Let's say for both the customers, already they have taken a loan, both the customers, they are supposed to pay their EMI, that is equated monthly installment, on the 5th of every month. Let us see when they are actually making the payment. Mr. A is making the payment on 5th itself, whereas Mr. B makes payment only on 10th. So in this case, obviously the bank will go with customer A because he has got credit discipline. The discipline is he is supposed to pay on 5th, he is paying on 5th itself, whereas B is paying on 10th, so there is a DPD. I call it as days past due, and this is going to put lot of hardship for the bank, because bank is supposed to get money from Mr. B on 5th, but bank is getting that money only on 10th. It means bank is going to have asset liability management issues. Bank will have asset liability management issues, or say mismatch issues, because bank is not getting its money on time. So bank will have difficulty in meeting its obligation to others. So bank will not prefer these kind of customers. Next, let us look at one more scenario in understanding the credit history. Let's say both the customers have availed cash credit or OD facility, and these facilities will have interest servicing. Okay, let's say interest servicing is due on 30th June of every month. Now Mr. A will make payment only on 10th, whereas Mr. B will make payment on 30th itself. In this case, bankers will be interested in B because he is having that discipline, whereas bankers will not be okay with A because he is again putting the bank into hardship. Next, let's look at the CIBIL score. Now what is CIBIL score? CIBIL score is the score which is going to reflect the credibility of the loan applicants. Now this CIBIL score will be there for each and every individual, and will also have CIBIL parameters for corporates or say business entities. Now how this CIBIL score is arrived? This CIBIL score is arrived based on the number of loans, based on repayments, based on various loan enquiries made, right? Then based on write-off, loan write-off, then if there is any one-time settlement. So all those factors will go into the CIBIL score. So if a customer has a great credit history, I mean he has manageable number of loans, all payments are happening on time, and he is not making roving enquiries with various banks for loans, and he has never gone or indulged into write-off or one-time settlement, then in those cases CIBIL score will be satisfactory. Let's say it will be 800 plus or say 880 plus. But if that customer has defaulted in any of the loans, I mean he is having issues in the repayment, or in the past he could not pay some loan, so because of that some banks had suffered a loss, so they have written off the loan. Or in the past he had taken a loan, he could not pay back the full loan, he had paid only the part amount, and part amount was waived by the bank through one-time settlement. Or he has lot of credit hungry, he goes and make enquiries in various banks, or he has too many loans. It means all those will bring down the CIBIL score, say to something like this or even below this. So which customer the banker will be preferring here? Is it 500 or 880? Obviously the customer will be preferring customer B. Okay, sorry, the banker will be preferring customer B because he is having good credit score. It means he is maintaining his credibility in the banking overall. Okay, next, relationship with the existing banker. The next parameter is the relationship with the existing banker. Now, let's say the customer already having a banking relationship, already the customer has availed a loan and they are doing it, but that customer has come to the new bank. So this new bank, how he will evaluate? So he will try to understand what is the relationship with the existing bank. Is it a smooth relationship or is it in the existing mode? Here Mr. A is having a smooth relationship, whereas Mr. B, the existing banker, is in the exit mode. They want to get rid of B. It means it indicates there is a strain or it reflects his credibility to the existing banker, and that's why they want to get rid of B. And how the banker will get to know about all this? He'll get to know about all this when he interacts with them. Okay, I mean he interacts with the existing banker, and of course it's a very dicey situation because when the new banker starts interacting with the existing banker, then there is going to be say competition pressure, or the existing banker will try to retain the customer and new banker may lose that customer because existing banker may give some kind of a even softer package for the client or customer. So it's very dicey, but still they have to do it to understand what is the relationship. So in this case they'll be okay with customer A rather than B. And whenever a customer who is having a loan with an existing banker is approaching a new banker, then the new banker is supposed to get what is known as CIR. We call it as Credit Information Report. And if CIR is positive, then they'll be okay with that customer. If CIR is negative, they may not consider that customer. Because in Credit Information Report, the banker will say whether the contact of the customer is good or bad. And how they will generally write, they'll say satisfactory or not satisfactory. Okay, they'll say it is satisfactory or unsatisfactory. Okay, and let us also look at the loans outstanding position. Mr. A has got a loan, but he has no overdue. There is nothing overdue, whereas Mr. B has a loan and that has a overdue for 95 days. What do I mean by overdue? That is payment not happening on the due date. Payment is not happening on the due date. It means it has crossed due date more than 90 days. Okay, it means the payment is pending greater than 90 days. In this case it is 95 days. Now why I am stressing too much on 90 days? Because for 90 days, if the loan, its interest and principal is not serviced, then it will become non-performing asset, which is going to result in loss for the bank. Okay, so in this case obviously the bank will be okay with A and not with B. So let's summarize. The credit history is the key driver, okay, because it is going to reveal the past history. What are the loans they have taken, what are the loans they are servicing, whether they are servicing on time, is there any overdues, that is days past due. And they'll be looking at CIBIL because the score will reflect the credibility, and credit information report from the existing bankers will give key information to the banker if they are taking over a loan. Then something which we missed out is for understanding the credit history, the banker should go through bank statements. Now this is not only going to give information about credit history, it will also gives information whether this customer has financial discipline by routing the transactions in the banking system, because not routing the transaction in banking system could result in creation of black money. Okay, so that should be discouraged. And if most of the transactions are routed through banking system, it means automatically they are getting accounted, and whatever the profit that is calculated is going to be the right profit, more or less. Okay, so let's just have a look at that. I mean, how the banker should scrutinize the bank statements. Again, I have two customer A and B, and let's see. So there's a customer A who has 300 transactions in last 3 months in bank, and it all customer initiated transactions, whereas customer B has only 10 transactions initiated by himself. Now in this case, the bank will obviously prefer customer A, because this customer has been routing all his transaction, or he is initiating a lot of banking transaction. It means most of his transactions are getting captured in the banking system, whereas that is not the case with customer B, because let's assume that both of them have same level of turnover, and this guy 300 transactions, whereas this guy has got only 10 transactions. It means Mr. B is covering substantial transactions. He is covering substantial transactions. He is not routing them through bank system, so obviously the bank will go with A. Now let us see some more information. Let's say the credits in last 3 months. For Mr. A, the credits that are coming to his account is, let's say, 50, whereas for B it is only 10, and again I'm assuming both of them are having same level of turnover. So again this is a matter of suspicion, because when both of them are having same level of turnover, how Mr. A is having more credit and Mr. B is not having? Because Mr. A has the practice of channelizing all the turnover receipts into the banking system, whereas Mr. B is not doing that. It means he can do some kind of a covering of transaction. It means at the end of the year something may disappear from turnover, right? So again here the bankers will be comfortable with A. Now let us also look at the check bounces. Mr. A has issued, let's say, 100 checks in the last say 6 months. B also has issued 100 checks. Now out of the checks he issued 100, 2 checks got bounced, whereas for B 5 checks got bounced. So in this case the bankers would be obviously comfortable with A, because he is maintaining his credibility, he is maintaining his integrity in the market. Integrity, that is the promise to pay. I mean, he's a person who can be relied upon, believed, whereas Mr. B, he is issuing checks left and right, but 5% of the checks are getting bounced. So again the bank will be comfortable with Mr. A. Now let's say Mr. A and B has received 100 checks, from their customers. A and B has received 100 checks from their customers. For A, there is only 1 check got bounced received from the customer, whereas for B 10 checks got bounced. Now again bank will be comfortable with A, because A's ability to repay the loan will depend upon the checks that are ultimately received from his customers. So here only one customer or 1 of 100 check is getting bounced, whereas here 10 of 100 check is getting bounced. It means are not that trustworthy. So his cash flows will get blocked with them, and eventually B also will not be able to repay the loan. So bank will be comfortable with A. Next, critical routing of transactions. So whatever the sales that are reported by Mr. A, he routes them through banking channel only, whereas B routes only 10%. It means again the bankers are going to be comfortable only with A and not with B, because A has got a lot of financial discipline, B does not have that, and B would be creating a lot of black money. Okay, so we came to this point when we summarized credit history, that is banker should go through the bank statements basically to check bounces, because that is going to reflect the credibility and integrity. Okay, so by going through the credit history, as a banker will get to know what is the integrity? I mean, whether the customer has integrity or not, whether he has got intention to pay the loan or not, or whether he will default in future. Let's move on to the third aspect in credit analysis process, where the bankers will try to understand the financial standing of the customer. So let's go through some examples to understand this. Now let's say again there are two customers A and B, and they are doing same business. They are the same level of turnover, profit, everything fine. But Mr. A is producing profit and loss account balance sheet, and Mr. B says he has no profit and loss account balance sheet, but he is doing the same business as that of A. In this case, the financial standing of A can be measured, whereas the financial standing of B cannot be measured. It means obviously the bankers will be preferring Mr. A because he is producing some kind of evidence, say financial documents in the form of profit and loss account and balance sheet, which will talk about what are his sales, what are the expenses, the profit, the assets and liabilities. Okay, fine. Now A and B have shown their financial position. Now, having seen that Mr. A is preferred by the bank and B is not preferred because he is not producing P&L and balance sheet, what Mr. B does is he goes and prepares his P&L and balance sheet. Now he is submitting. But what Mr. A is doing, A is submitting audited P&L and balance sheet, whereas B is giving unaudited P&L and balance sheet. Again, the bankers will have preference to Mr. A and not to B, because here whatever Mr. B says as his turnover, as his profit, as his assets and liabilities are unreliable because it is not verified by an independent third party professional. In case of A, it is verified by an independent third party professional, say chartered accountants, who are going to do audit and they are going to give an opinion, whereas in case of Mr. B, no one has checked. So it can be true or it may be wrong, or it may be inflated profit, or it can be manipulated figures. Any combination is possible. So in that context also, A will have preference over B. Now, having understood that only if it is audited, banks are going to consider, what Mr. B does is, B is getting his accounts audited. It means, now here you have a scenario, A and B. A is also having audited, B is also having audited, but here again, bank is giving preference to A and not to B. What is the reason? Here, A's audited financials has a clean audit report. It means auditor has no objection with any of the accounting figures or any of the accounting practices, whereas B's financials are audited, but auditor has lot of objections which he had brought out in his report. It means it has something known as qualified audit report. It has something known as qualified audit report. So what is happening here? Despite getting the financials audited, B is not favored by the banker, only A is favored because he has got clean audit report without any issues. Okay, so how the bankers are going to understand the financial standing of the customer? First, they want to look at the financial statement. Number two, they got to be audited. Number three, they should be clean. There should not be any issues. I mean, the bankers are not going to accept the position. Let's say you are going to communicate your turnover only orally and you are not going to present it in P&L. It means bankers will not accept this. Bankers will accept only if it is presented in P&L. And bankers are not going to accept the profit which you are going to say in oral because it is not ascertainable. But if the same is audited, then bankers will also be happy because it is verified by a third party and independent professional. Okay, so bankers will understand the financial standing of the customer by going through the financial statements, and that financial statement should be audited and it should have clean audit report. Now this is the base. Now on this base they'll be looking for various parameters. Say for example, Mr. A has sales of 100,000. He is reporting a profit of 20,000. Okay, it means he is reporting a profit of 20,000 for sales of 100,000. So we can say he is having a profit margin of 20%. Now how this information was derived? From the financial statements. Whereas for Mr. B, first of all, it is not ascertainable because he is not having financials at all. Then later he brings the financials in which he shows sales as 100,000, profit as 5,000 only. It means it is only 5% profit margin. So again here Mr. A will have preference over B because A is reporting a profit margin of 20%, whereas B is reporting a profit margin of only 5%. Fine. So bankers will also be looking for various other financial parameters to understand the financial standing. Let's say both of them are presenting their financial statements. Now they have the financial statements, it is audited, it is clean, fine. A is having total debt of 50, let's say 50 million, and A had contributed 25 million in the business. So the total money borrowed by the business entity of A is say 50 plus 25, it is 75. And now you try to understand the relationship between the debt and equity. The debt is 2 times of equity because equity is 25, debt is 50. We can say debt is 2 times of equity. So we are creating a relationship, debt to equity ratio, which is calculated as debt divided by equity, and we get the number as 2:1. It means we can say debt is 2/3 and equity is 1/3. If I put it in percentage, 67% is debt and say 33% is equity. But if you look at B, B has total debt of 50 and his equity is only 5. So what is the total? The total is 55. And what do you understand? Out of this 55, 50 had come from debt itself. It means 50 divided by 5. Okay, 50 divided by 5, I get the ratio as 10:1. It means for every 1 rupee, for every 1 currency of owner's money, I call it as equity, there is a debt of 10, which indicates this B is highly leveraged. It means he has got excessive debt in his structure, and this excessive debt will bring in lot of financial risk into the business. What is financial risk? That is the commitment to pay interest, the commitment to pay principal, whether the business makes profit or loss. Okay, so which customer will be preferred? Obviously A will be preferred because his debt equity is comfortable at 2:1. Now how the bankers are understanding this? By analyzing the financial statement. So financial statement enable the bankers to understand financial standing. Similarly, let us look at one more scenario. Both A and B are presenting their financial statement. Both A and B has current asset of let's say 100 million. Whereas the current liability for A is 75 million, whereas for B it is 110 million. Now what's big deal in this? Look at here. Current liability means the liability which are repayable within 1 year, and current asset means those assets which can be converted into cash within a period of 1 year. So within 1 year they are supposed to pay 75 million, and for that the resources available are 100 million. So even after paying the 75 million, they'll be still left with a balance resource of 25 million. It means if I create a relationship between these two, that is current asset divided by current liability, I get what is known as current ratio, which is current asset by current liability. 100 divided by 75, I get 1.33. And what it communicates? 1.33, it will be read like this, 1.33:1. It means for every 1 rupee of current liability, there is 1 rupee 33 paise of current asset. So there is something extra, so that is going to give a breather. But look at scenario B. What is the obligation payable within 1 year? 110 million. What is the resource available? It is only 100 million. So there is a shortage. And if I create the relationship 100 divided by 110, what I get is 0.91 is to 1. It means for paying 1 rupee of current liability, the resource available is only 0.91, which is less than the obligation. It means there is going to be a lot of stress. And what is this stress? We call it as liquidity stress. We call this as liquidity stress. And how the bankers have understood this? By analyzing the financial statement. So this enables the banker to understand the financial standing of the customers A and B. And obviously the bankers will prefer customer A because his liquidity seems to be comfortable, whereas that is not the case with customer B. Okay, so here liquidity seems to be comfortable, whereas here liquidity seems very stressed. Okay, so let's summarize. The bankers will understand the financial standing of the customer by analyzing the P&L and balance sheet, so that they get to know the performance efficiency by focusing on profit and various parameters in relation with sales. They'll understand the solvency by comparing the debt with equity. They'll understand the liquidity by comparing the current asset with the current liability, and they get to know what is the overall financial position. Let's move on to the next parameter, that is understanding the industry condition. Yes, bankers have to understand what is the exact condition of the industry before giving loan to a customer in a particular industry, because it will have an overall impact. Let's go through again with the comparison of A and B. Let's say two customers doing a similar turnover, similar profit is approaching the bank, whereas customer A is one industry, customer B is another industry, and this industry is in growth mode and this industry is in decline mode. It is possible because each industry will have a cycle. So depending upon the cycle, the banks will increase or decrease the exposure, or will increase or decrease the funding. So here the bank will have more comfort with A because he is in the industry which is in the growth mode, and would try to reduce the existing exposure in B. It means they'll not open up new loans to the customer in that specific industry. So B comes under the industry which is in the decline mode. So banks will generally have say cutoff or threshold. It means it is not that they will not give loan to anyone in that particular industry. Say for example, I'll call it as iron and steel. Iron and steel, it is not that they'll not give loan to anyone in the iron and steel, but they'll give the loan only if the credit rating is going to be very high, because banks will have their internal credit rating mechanism where they'll be rating the customer based on various parameters, and only if the rating is going to be very high they will take exposure. They'll give loan to a customer in the industry which is in the declining mode. Okay, so how the banks are going to select here A and B? Based on the industry which is in the growth mode. If the industry is in the growth mode, even the marginal say average credit rating is fine, but if the industry is in the decline mode, only those customers who have highest credit rating will be given loan. Second, regulations have to be looked into. If that industry suffers too much of regulations, too many regulations, then bankers will try to be very specific, because bankers are not expert in the law related to the particular industry. So they don't want to take an exposure into an industry which is highly regulated, because every day there will be some changes in the law which will jeopardize the normal operations of that industry as well. Okay, so if there is going to be too many, they'll try to keep it little low, and if the regulations are not too rigid, okay, fine. But of course regulations are required for any industry, so this is a subjective one. Then environmental issues. If that particular industry has a lot of environmental issues, then bankers will try to go slow on those kind of industries. Say for example, dyeing, right? Now this dyeing is going to create a lot of pollution, and it is possible that all of a sudden the pollution control board of a state will come and say this particular activity cannot be carried out here. It has to be taken to very, very distant places. or they can altogether object the entire activity itself. It means environmental issues will put an end to the business all of a sudden, and bankers are going to be at high risk. So if there are environmental issues associated with the activity or with the industry, the bankers will try to go slow. So here bankers may not prefer A, but they'll prefer B, who is in an industry where there are no environmental issues. Sometimes what will happen, the ultimate regulatory institution, say Supreme Court, will come and put a ban on particular industrial activity. Say for example, it happened in the case of iron ore, it happened in the case of iron ore, it happened in the case of liquor. Okay, so if there is going to be a ban, or if there is going to be high level of intervention by Supreme Court, then the banks will try to go slow. So in this case, there is no ban on A, but there is a ban on B. It means the bankers will be comfortable with A and not with B. And sometimes certain industries will have a lot of political drama. Say for example, again, the liquor business, because this is an industry where there will be a lot of protest by public, and there will be a lot of ups and downs, U-turns from the political arena. It means the pattern cannot be predicted exactly. So if there is going to be a lot of political drama, the bank will not prefer this industry. So the bank will prefer Mr. B, or B's loan proposal, because he is not into the industry which has a lot of political drama. Then comes the rating by credit rating agencies. There are credit rating agencies like Fitch, we have CRISIL, we have ICRA, we have CARE, then we have India ratings. Okay, so all these will periodically come out with a rating of industry. They do rate industry as well. So if they downgrade the rating of industry, then again the banks will try to go slow. So if A has a positive rating for his industry and B has a negative rating, then the bankers will prefer A. Now comes the ultimate point, where the bankers are actually interested in measuring the repayment capacity. Now this comes especially in cases where the banks are going to give term loans, because term loans have to be repaid over a period of time as per schedule. Now when the due date approaches, whether the customers will have capacity to repay. Now how banks will be measuring that? Let's see. Again, two customers A and B, both of the customers are having obligation of, let's say, 10 lakh, that is 1 million each. A is having a cash profit of 15 lakh, that is 1.5 million. B is having a cash profit of 10 lakh, that is 1 million, exactly equal. So here what is happening? In case of A, probably I'll put it here. In case of A, the obligations are 1 million, whereas cash profit is 1.5 million. So we can say cash profit is greater than obligation, whereas here cash profit is equal to obligation. So which customer will be preferred by the bank? Obviously it is going to be A, because we all will agree that businessman is not doing business only for paying the loan. In case of A, if you analyze, the cash profit is 15 lakh, that is 1.5 million, of which loan is going to be 1 million 10 lakh. It means he is left with a balance, and that balance is 0.5 million 5 lakh. Now this 0.5 million 5 lakh can be used for, say, supporting the margin, or I can say it can be used for supporting the working capital of business. So this comfort is available in case of A, whereas that comfort is not available in case of B, because whatever is available as cash profit is getting consumed for paying this 1 million obligation. It means they are left with nothing. Then how they will support working capital of the business? Okay, so bankers are going to measure whether the customer is having the capacity or not, and for this they are going to look at the cash profit. So we'll be understanding this a little deeper in the later sessions. So bankers are interested in repayment capacity. They're going to check whether the customer has got ability to repay the debt. When we say debt, it is both principal plus interest not only the new loan but also the existing. So it is going to be existing and new loan, and whether the customer will have the capacity to pay the loan throughout the loan period. Because here I have measured this and maybe this is for 1 year. But if the loan is for 5 years, let's say loan is for 5 years, then for all the 5 years this capacity got to be measured. Okay, and very critical point is whether he is getting the capacity to repay the loan throughout the loan period only out of operational cash profit. Only then the loan will be sanctioned. I mean, if the operational cash profit is not supporting the repayment of the loan, then it means that project or that loan is not viable option for the bank. It is not a viable option. Okay. Now, more than this, more than the repayment, the banker should be very much convinced about the intention of the borrower to repay. If he has got no intention, then despite making operational cash profit, that loan will not get serviced back. And how this he will understand? By carrying out the analysis of management, experience, expertise, and his credit history.
So thank you. First 60 minutes, our first session is complete. How the session is going on? Are you deriving value? Are you deriving value? Just type IDV. IDV stands for I am deriving value. Okay, this session I have never played in YouTube. Okay, it's a dedicated session created for today's workshop. Thanks a lot. Thanks a lot. I could see energy pouring. Please maintain this energy throughout the day. For entire day, it is packed with valuable content. It's packed with valuable content. Okay. Now let's get into financial analysis part. Let's get into financial analysis part. And before that, just give me a minute. See, I'm going to share the Telegram group link here. Okay. It is in this group, all the questions will be answered. Okay. So whatever queries you come across, you can post them in the Telegram group. The very reason is I'm a little bit selfish on this count. It's because in my Telegram group, there are 1000 plus students who are bankers already registered. Okay. They are students. And when you ask a question, its answer, not only you will get, but they will also get that. Okay. So I'm little selfish on that count. I want all my students also to know what you are asking and what I am answering. So I'll be posting the Telegram group link here. Okay. Maybe after 1 or 2 minutes. Now we'll get started with financial analysis. Okay. Just imagine a scenario. Your customer, bank's customer, who is into a business, is approaching the bank for a loan. Let's say for working capital or term loan. Now, how does the bank take a decision to give loan to that customer? By doing or by carrying out a process called credit analysis. In that, bank will be evaluating the customer profile, credit profile, management aspects, and financial aspects. And these financial aspects can be evaluated by using various financial analysis tools. In that, the most or very important tool is ratios, financial ratios. So in this webinar, I will take you through what are ratios, what are the key ratios as a banker you have to go through, and what those ratios communicate. That is, what are the things you can infer by looking at those ratios. That is the core objective of this program.
Let's get started with financial ratio analysis. For some of you, what I'm going to speak for next 15 to 20 minutes will be very familiar because you would have already heard or listened to that in our earlier webinar. But we have several new participants, so for them it will be more beneficial. When we say ratios, they are basically relationship between two numbers which are created in a logical way. That is, I can relate the sales and profits. I can relate the sales number and profit number, and I can arrive at a ratio, that is profitability. So there is a logic here because by relating these two numbers, I get to know what is the profitability. I can relate current asset with current liability, the numbers of current asset and current liability, and the logic is I can understand their liquidity. I can relate debt with equity so that I can understand the solvency of the business. So ratios are basically a relationship between two numbers which are created in a logical way so that we can understand the past, present and future performance, and we can also understand the strengths and weaknesses. So ratios are not mere mathematical concepts. In banking, in financial analysis, using ratios we can understand how your borrower has performed in the past, how he is performing now, and how he is expecting his performance to be in future. And also by looking at the ratios, you can understand what are the strengths and weaknesses of the borrower. Ratios can be classified into four broader categories. They are liquidity ratios, capital structure or leverage ratios, activity ratios, and profitability ratios. First, let's get started with liquidity ratios. What do we mean by liquidity? Liquidity means ability of the business to meet its short-term expenses and obligations without any difficulty. So in liquidity ratios, we are actually trying to understand whether the business is having any pressure to meet its obligations. For that, let me take you through the memorandum of a balance sheet. See, in business, funds can come from various sources. Funds can come from owners. It can come from outsiders. When funds come from owners, we call it as equity. When it comes from outsiders, we call it as liabilities. The money that are coming from outsiders, what we call as liability, can come with an obligation to repay within 1 year. It can come with an obligation to repay after 1 year. When it comes with an obligation to repay within 1 year, we call them as short-term liabilities. So these are all the money you have raised, maybe in the form of cash credit or overdraft or advance from customers, and you have the commitment to either repay them or to deliver the goods in case of advances. So using this money, what you will do? You will create some assets, basically short-term assets. But if you look at the proportion here, the short-term assets are greater than the short-term liabilities. It means what you have created as assets is greater than the money what you have borrowed in short term. It means these assets could not have been created with just short term funds. Some more funds have come in for creating these assets, and we call them as long term funds. It's only because of that reason the short term assets are greater than the short term obligations. So what is the relationship of this scenario with the liquidity? It has. When short-term assets are greater than short-term liabilities, that business will have comfortable liquidity position. It means short-term liabilities are repayable within 1 year, and for repaying you need resources, and those resources are actually in the form of short-term assets. So if you want to repay 10 million and if you are having a short-term assets of 15 million, it means you are having resources of 15 million using which you can pay 10 million. We can say the liquidity position is comfortable. Okay. To understand this even more in depth, let's understand something very important now, that is fund utilization principle.
Yeah, sorry for the interruption. Of course, I'll be saying this in the presentation itself. In the recorded version also, you will hear the same thing, but I thought I should come on screen and sensitize. See, this 9:30 to 5:30, you are going to learn several things. But one thing which you should never ever miss out, one thing which you should never ever forget for your lifetime means it is this, it is fund utilization principle. This principle will save several thousands of businesses, take it from me. If you understand the crux of this business, and if you take an oath to teach this principle to as many others as possible, you will make a significant change around the business community you have. Okay, so I request you to give your full attention for next 10 minutes. It's going to change the way you look at things, and it's going to save several thousands of your customers. We have several bankers here today, and you can save several thousands of families and business units. Okay, let's move on. And once I complete this, I'll come back to you once again.
Whoever attending this workshop, please take this principle to your heart, to your mind, and try to teach this to as many entrepreneurs as possible. Educate the entrepreneurs, whether you be a banking executive, a credit officer, or a relationship manager, or a chartered accountant, or cost accountant, or finance manager. Okay, this is very, very important, because 95% of the business units have failed only because of not understanding this principle. Only 5% of the business units are failing or becoming NPA or becoming sick company because of technology, because of marketing, sales, quality, HR, legal issues. Remaining 95% of the businesses, they fail because of one single reason, that is, they have not understood how to utilize their funds. Let me take you through. I said funds can come from owners and outsiders. And when funds come from outsiders with a commitment to repay within 1 year, we call them as short-term liabilities. And using those short-term liabilities, short-term assets can be created. But short-term assets is greater than short-term liabilities. It means automatically it gives rise to the understanding that a portion of short-term assets is funded by long-term funds. And what we can infer, the remaining long-term funds are being utilized for creating long-term asset. So in this way, we can break any balance sheet into these 4 compartments. But what's even more important is how these funds are going to be utilized. Short-term liabilities can be used for creating short-term assets. Good. Long-term funds, that is basically the composition of long-term liabilities and equity, can be used for creating long-term assets. Good. Long-term funds can also be used for creating short-term assets. That's ideal, because that's going to give the much needed liquidity comfort for the business. Whereas there is one thing which should never ever happen in any business. Never ever divert short-term funds for long-term purpose. Never ever divert short-term funds for long-term purpose. Because whoever have given money for short-term period, they are going to ask that money, they are going to ask you to repay that money in that short-term period. And if you are not going to meet that commitment, repay that in short-term period, then that becomes the beginning of end of your business. Because they will go for all the legal recourses available. Just imagine the short-term money was given by a banker in the form of a cash credit or overdraft, and it has become due for payment. He is demanding the payment, and when you look back, you don't have short-term resources because you have used that money in creating some land or building or plant and machinery. So it's sitting in the form of a long-term asset. So how long they will wait? If a banker, if the loan amount has become overdue, they'll wait for maximum 90 days. Then they'll declare the account as non-performing asset and they go for recovery measures, right? So that's why I say that becomes the beginning of end of a business. So never ever divert short-term funds for long-term purpose.
For you, the key takeaway from this webinar is going to be this fund utilization principle, because this is like a life savior. It means business units which are aware of this fund utilization principle, they will act with financial discipline. Business units which are not aware of this, they land in serious trouble. By the time they realize that they have committed this mistake, they'll not even be in existence. That's the kind of consequence it can have. So if you have understood the message that is conveyed, please, I request you to take an oath now. The oath is you have to teach this to others. Please teach this to entrepreneurs you know. Please teach this to your friends who are entrepreneurs. If you are working in a bank, please teach this to your customers who are entrepreneurs. Please teach this to your friends. Okay, by teaching this, you are actually saving several thousands of families. How? Because this mistake is committed by business entities, and there are several people who are working in that, their lives also get questioned. So by teaching this to entrepreneurs, you are saving their business as well as their dependents. So please type I will teach. Please type I will teach, or simply type IWT.
With this understanding, let's move on to the first ratio, that is current ratio. I'll take you through 3 scenarios, but before that, let's look at the formula part. So how do we calculate current ratio? Current ratio is calculated as current asset divided by current liability. Current asset in the numerator, current liability in the denominator. What are current assets? These are all the assets which can be converted into cash within a period of 1 year. What are current liabilities? These are all the liabilities which have to be settled within a period of 1 year. Obligations got to be settled. And this is how scenarios should be for every business. That is, current assets should be greater than current liabilities. Let me take you through those 3 scenarios. Look at this. Scenario 1. Here you see current asset as 600. Let's say 600 million. Current liabilities as 300 million. So from this, what we can infer is this business has an obligation of 300 million to be settled within a period of 1 year, and for that they have corresponding resource, current asset of 600 million. It means they are having a comfort of remaining 300, so I call that as net working capital. So how I derive this net working capital? It is very simple. Current asset minus current liability gave me net working capital, and these net working capital are nothing but the long-term funds. So what we can infer is this long-term fund of 300 and short-term fund of 300 is used for creating short-term asset of 600. So that's one way of looking at it. The other way is within 1 year this business has to settle 300. For that they have resources of 600. It means they still have comfortable margin of 300. And now if I calculate current ratio, which is current asset by current liability, 600 by 300, I get the ratio as 2:1. It means for every 1 rupee obligation there are resources of 2 rupees. I repeat, for every 1 rupee obligation there are resources of 2 rupees, and that's why I say liquidity is comfortable here. Whereas in scenario 2, current assets are 300 and current liability is also 300, and if I calculate net working capital, which is current asset minus current liability, it's nothing. It means this entire current assets was created by current liability only. So there is no long-term fund contribution for creating this current asset. And if I calculate current ratio 300 by 300, I get it as 1:1. 1:1. It means for every 1 rupee of obligation, I have resources of 1 rupee. For every 1 rupee of obligation, I have resources of 1 rupee, but not all times this 1 rupee resource will come for rescue. There will be some issues that you will understand when we go through quick ratio. Look at the scenario 3. My current assets are 200, current liabilities are 300. So what does that mean? I have borrowed 300 with a promise I will repay within 1 year, but what I have created with borrowed money is only 200. So what happened to that remaining 100 which I have borrowed? I borrowed 300 short-term money. I'm supposed to use that for short-term purpose, but instead I have used that remaining 100 elsewhere, where obviously for long-term purpose, because current asset is the short-term purpose. In current asset I could see only 200. So what happened to the remaining 100 that had gone for supporting the long-term purpose? And that is the last thing which I said in fund utilization principle. Never ever divert short-term funds for long-term purpose, but that's what they have done here now. And if I calculate net working capital, which is current asset minus current liability, I'll get 200 minus 300. What I'm getting is negative 100, and this is what the fund they have diverted from short-term purpose to long-term purpose. So whenever there is a diversion of short-term funds for long-term purpose, you will see a net working capital being negative. And you will also be in a position to notice that by looking at the current ratio. Because calculate current ratio now, current asset divided by current liability. 200 divided by 300, you get current ratio as 0.67:1. It means for every 1 rupee obligation, I am having only 67 paise. It means there is a clear-cut shortage of 33 paise per rupee of obligation. So we can say in scenario 3, this business is in serious trouble because within a year they have to settle 300 million. They have resources of only 200 million, and it is also very much evident by looking at current ratio, because for every rupee obligation they have only resources of 67 paise. So these kind of inferences are possible when you look at current ratio. Okay, for calculation it is very simple, but what it communicates is something very important, something really significant in decision making. Also it is very relevant. Okay, right. Next, I'll also take a couple of minutes to explain why current ratio of 1.33 is insisted by most of the banks. Some banks, of course, they'll have like 1.1, 1.33, 1.5. Okay, let whatever be the logic what I place here, you can extrapolate for 1.1, 1.5, 2 also. Okay, listen.
Shall I explain that? Because many of you would have heard that minimum current ratio is like 1.3 or 1.1, whatever the minimum. But why banks place such a condition? Why it should be minimum so much? Yeah, Raghav is saying like it is 2:1. Okay, it depends. It depends upon the bank's policies. But why that minimum is stipulated? It's not just current asset being 1.33 times of current liability. No, it has something even more deeper. That's what I'm going to showcase. Yeah.
Let's say my current assets are 100 million and I'm having current liabilities of 75 million. And with this, if I calculate current ratio, I get current asset by current liability as 100 by 75, that is 1.33. So it's going to be 1.33. So when the current ratio is 1.33, automatically what we can infer is 75% of the current assets are funded by current liabilities, and what we can derive is the remaining 25% of the current assets are funded by long-term funds. Because current asset minus current liability we call as net working capital, right? And net working capital is nothing but the long-term funds which had come for creating this current asset. It means there is a 25% long-term fund contribution for creating this current asset, and this is what most of the banks stipulate as a sanction condition, basic sanction condition for releasing working capital credit facilities. For example, if you go and check back the sanction letter issued by your banks for cash credit facilities, generally the margin condition on inventory will be 25%. So it means 25% of the inventory have to be funded by long-term funds, right? So this 25% long-term fund contribution basically represents 25% margin condition stipulated by banks for working capital, and this is the logic behind 1.33. So when the current ratio is 1.33, the conclusion is 25% of the current assets are funded by long-term funds, which is in sync with the sanction condition, the condition stipulated by the bank as working capital margin.
So how many of you are exposed to this logic for the first time? I mean, it's not a rocket science. Yes, I could see answers coming from Porchudian, Shager, Vidyachal Singh, 25% margin. Okay, so that's the logic. When you look at a current ratio of 1.33, you can conclude there is a 25% long-term fund contribution for developing or creating that current asset, and this is something which you will link with working capital assessment. Okay, when we get into working capital assessment, we'll be able to relate with this even more. So if this is a first time learning for you, and if it is a kind of a bulb on moment for you, type bulb on. In this entire workshop, we have to see several bulb on moments. Just have your hands on the keypad or keyboard, type bulb on, whoever got exposed to this. So I want to see the pouring bulb on, or simply type BO. Simply type BO or type bulb on. Yes, Bharat, Vinny, Sudhakar, Murugesan, Sabina, Suman, Naren, Vasant. Yeah, it's running. I could not. Yeah, Sindhuja, Ranjani, Vinay, Ganshyam. Thank you, thank you. Let's maintain this energy. And do you know when we have our break? Our scheduled break is by 10:45. Is that right? Sorry, not 10:45. Our scheduled break is by 11:30. 11:30. Yeah. So why 1.33 is preferred? Because when current ratio is 1.33, there is a 25% long-term fund contribution. And the question is, why 25% long-term fund contribution? If you relate with the Nayak committee, if you relate with the Tandon committee, automatically you will get the answer. But worry not, we'll maintain that suspense. We will understand that even more deeper under working capital. Okay, right. So thank you. We'll move on. Yeah, so Thompson is saying if margin for fixing drawing power is 40, whether MPBF also got to be changed? Yeah, because when you are automatically fixing a higher margin because you perceive high risk, then yes, this will also be on the higher side. Because when you prescribe a margin of 25%, that is in sync with current ratio of 1.33. And when you prescribe a higher margin, then your expectation on current ratio should also be high. Okay, let's continue.
Next, we'll move on to quick ratio, also called as acid test ratio. So look at this scenario so that you can understand this better. Current liabilities are cash credit 100, sundry creditors 200, whereas current assets are cash and bank of 100, stock of 100, and receivables of 100. Okay, so the total both sides is 300. So this is exactly our scenario 2 in current ratio discussion. This is what our scenario 2. And I said it might look like an ideal scenario, but this is not an ideal scenario. Okay. Now, why this is not an ideal scenario, even though the short-term funds are exactly used for short-term assets? This is not an ideal scenario because some of the current assets, say the stock, this stock will not be available when you need cash immediately, because you have to convert the stock into, let's say the stock is in the form of raw material, then you have to convert that as finished goods. Then you have to identify a buyer. Then if he insists on credit, again it will take its own time. Okay, so for that reason, this stock is not immediately available. So what is our total current assets now? It's not 300, it is 200. So we call this as quick assets. Current assets was 300, but what is available at a faster pace or quickly is only 200. Now let's compare. And before that, let me put that in the form of a graph. That is, here this blue bar is my obligation current liability. My resources or current assets, it looks like matching, but this orange bar will not come for rescue, because of that what is immediately available is only to this extent. Only quick assets are immediately available. Even though I have lot of current assets, what is immediately available for me to settle my current liability is only quick asset. So there is a gap. That's why we calculate the quick ratio, or say the acid test ratio. So here we know current assets are 300, but quick assets are only 200, and we have to compare that with the current liability. So quick assets by current liability will give us the quick ratio. In some balance sheets on the asset side, you will also have an item called prepaid expenses. Okay, this is already paid for, so it is not going to fetch you any cash within a period of 1 year, but it is actually helping you to reduce the payments within a period of 1 year. So from current assets, as we have removed stock, we should also remove prepaid expenses. That will give us quick assets. And if that is divided by current liability, you get the quick ratio. In this case, current asset by current liability, 300 by 300 gave us a current ratio of 1:1. But if you want to know the real face of it, you have to take quick assets divided by current liability, 200 by 300, you get only 0.67:1. So for every 1 rupee of obligation, the quick assets that are available is only 67 paise. For every 1 rupee obligation, quick assets that are available is only 67 paise. So how a quick ratio should be, or how a liquidity position of a business should be. Look at this. This blue bar is your obligation. If you have 300 as your obligation, your current asset should not be exactly equal to 300. It should be greater than 300. Okay, roughly let me say it should be like 350. Actually, it should be greater than 350, because there is a kind of benchmark ratio for current ratio, right? The benchmark ratio is, I mean, theoretically it is 2:1, and what is widely accepted is 1.33. Okay, and here I have used the number 350, but you just focus on one understanding, that is current asset should be greater than current liability. But our focus is on preferable liquidity position. Current assets should be greater than current liability, but quick assets should be at least equal to current liability. Okay, that's the message we should take now. Current assets should be greater than current liability in such a way that current ratio is 1.33 or 1.5 or 2:1, but quick asset should be at least equal to current liability. It means quick ratio should be at least 1:1. Only then that business will have real liquidity comfort. What is the point in having a current ratio of 2:1 when all the current assets are in the form of stock? It will not fetch, it will not give any money when you are in urgency. Okay, that's why we say quick ratio should be at least 1:1. Let's now move on to the next important ratio, that is debt equity ratio, or we also call it as TOL by TNW, total outside liabilities by tangible net worth. Let's get started. Here also I'm going to use a balance sheet, and on the left hand side I've just mentioned as liabilities, but it is equity and liabilities. Okay, now listen. This business has raised 100 million from shareholders. From bank it has raised 100 million, debentures 100 million, and from sundry creditors 200 million. It means totally this business has raised 500 million. Now let us not look at the asset side, because our focus is on the debt equity, that is outside liabilities and equity. So what we have to do now is we have to compare the debt with equity. So what is equity? Equity is basically the owner's money, which is 100 million, and debt in this case, that is outsiders' money, bank loan, debentures, sundry creditors, all three put together is debt 400 million. And we have to relate these two so that we can calculate debt equity ratio. Let's do that. Debt is 400 million, equity is 100 million, and debt equity ratio is debt by equity 400 by 100, and we get the value as 4. But I'm going to express that as 4:1. I'll take you through 3 scenarios once again here so that we can understand it better. Scenario 1, we have already calculated outside liabilities is 400 and owner's contribution equity is 100, and debt equity is 400 by 100, and we get it as 4, and I'm expressing it as 4:1. It means for every 1 rupee contributed by the owner, this business has borrowed 4 rupees. I repeat, for every 1 rupee contributed by the owner, this business has borrowed 4 rupees. That is, if this business is raising 5 rupees, of which outsiders are contributing, look, outsiders share, outsiders are contributing 4 out of 5, that is 80%, and owners are contributing 1 out of 5, that is 20%. They are contributing only 20%, and remaining 80% have come from have come from outsiders. And I see this as a highly risky proposition, because this business has too much of outsiders funds, and none of the funds would have come free. All funds raised in the business will have cost, whether it is raised from the owners or from outsiders. If it is raised from the bank, they are going to expect interest. They are going to expect repayment. If it is raised from the supplier, he will load that cost in his product. So this 80% is actually attracting more fixed cost for this business. And if for some or the other reason, if the sales of the business is going to come down because of the market volatility or fluctuation or a recessionary condition like what we are facing or going through now, this business will be in serious trouble, because its sales graph will be coming down, whereas fixed cost will remain fixed. So after some point of time, this business will start reporting losses, because fixed cost is same fixed, but sales are coming down, sales are going south. Okay, that's why I see this as a highly risky scenario. But let's look at scenario 2. I'm going to take the same total funds of 500, but I'm just changing the proposition. I'm just changing the proportion. I'm saying total outside liability is 333 and equity is 167, and if I calculate debt equity ratio, it is 2:1. 333 by 167 gives 2:1. It means if 1 rupee is contributed by the owner, this business is borrowing 2 rupees. So put together, if this business is raising 3 rupees money, of which 2 rupees, that is 2 out of 3, 2/3 is contributed by outsiders, and 1 out of 3, 1/3 is contributed by the owners. And for me, this scenario is much better than the first scenario, because here the outsider shares have come down. Okay, it means the fixed cost for the business will come down. The financial risk is coming down. And owners are contributing more. In scenario 1, owners contributed only 20%, but here owners are contributing 33%. When owners will contribute more? Only when they have more confidence in their business. I'll take you through scenario 3, where total outside liabilities is 250 and equity is also 250, so it's equal, and if I calculate the debt equity ratio, 250 by 250, I get it as 1:1. So if this business is raising 2 rupees, of which 1 rupee is coming from outsiders and 1 rupee is coming from owners. So this is the best, because the financial risk is also lesser here. Okay, and owner share is more. It means they understand the business, that's why they are investing more. They see this as a promising business, that's why they are investing more, so that they can have more returns out of that. Whereas outsider share also has come down drastically, so fixed cost will also be lesser. So the indication is scenario 1 has high level of financial risk, scenario 2 is ideal, and scenario 3 I would say the best. The debt equity ratio what we have calculated now is very simple, but in reality there will be some more complications attached to it, because it's possible that what we see as owner's money may not be available. It could have gone out of business. And what we see as owner's money may not be actual owner's money also. Let me give you a scenario so that you can understand it better. So this is one sample balance sheet I'm using. Look, there are shareholder funds 200, bank loan 100, debentures 50, sundry creditors 150, so total is 500. And on the asset side, you have current assets 250, fixed assets 150, investment in subsidiary 50, goodwill 50, so total is 500. Now with this balance sheet, let's first calculate our debt equity in the normal way like what we did earlier. So what we have to do, we have to find out what are shareholders' funds, and in this case it is pretty straightforward, 200. Then we have to compare that with the debt, which is outside liability. So bank loan of 100, debentures of 50, and sundry creditors of 150. And what is the total? Total outside liabilities is 300. So debt equity we can calculate debt divided by equity or total outside liability by net worth. Okay, 300 by 200 will give us debt equity ratio as 1.5:1. It means for every 1 rupee contributed by the owner, this business is borrowing 1.5 rupees. And the maximum debt equity for a business can be like 3:1. Okay, just before I said 4:1 is highly risky for a business because 80% debt. So 3:1 means 3 out of 4, 75% can be the maximum debt. It means there should be 25% contribution. And now if you look at this ratio, it is 1.5:1. It means if this business is raising 2 rupees 50 paise, of which 1 rupee 50 paise is coming from outsiders, it means outsiders are contributing 60% and owners are contributing 40%. So this looks like an amazing or wonderful ratio. Okay, but now I'm going to supply some additional information. One is this shareholder funds of 200 million includes a revaluation reserve of 50 million. Includes revaluation reserve of 50 million. Okay, now comes our first headache. This revaluation reserve or the reserves which are created when assets are revalued to match with the market condition or to match with the market value. Let's say for example, this fixed asset of 150 includes some land, building and all. In that they had some land worth 10 million. Okay, they had land worth 10 million. I'm just narrating the story before doing the revaluation. Okay, so let me give you the breakup. This 150 has two components, 100 million plus 50 million. What is that 50 million? That's what I'm explaining. This 100 million worth of old assets included land worth 10 million. Okay, and now they've realized that this land is going to fetch 60 million in the market. This land is going to fetch 60 million in the market, but in their books, in their balance sheet, they are carrying that land only at 10 million. So they have engaged valuers. They have done the valuation and they have realized that its value is 60 million, but they are carrying in their balance sheet only at 10 million. So there is an increase of 50 million which they wanted to provide. Okay, so they are providing for that increase in value of land 50 million, additional 50 million. That's how we have the fixed asset of 150 million, which is basically the present 100 million plus increase on account of valuation 50 million. But whether this 50 million was realized in cash? No. It is the expected increase in value of asset which you will be able to encash when you sell the asset. Okay, so that's the understanding. But this business has no plans to sell the land. They are not going to sell it tomorrow. They are not going to sell it even after 1 year. They don't have any plans to sell, but they wanted to showcase they have so much of assets. So since they don't have any plans to sell that asset in near future, what is the point in doing this valuation? There is no point. But how the accounting treatment goes? You cannot have a lopsided accounting treatment, right? You cannot just increase the asset by 50 million. When you increase the asset side, that is when you increase the right hand side, you have to increase the left hand side also, only then the balance sheet will balance. So when the fixed asset was increased by 50 million, on the left hand side, that is under equity and liability, the shareholders funds will also get increased by 50 million, because under shareholder fund we will have a head called reserves and surplus. Under that there will be a head called revaluation reserve. Under that this 50 million will be parked. Okay, so now try to visualize. On the fixed assets, the original value is 100 plus 50, so it is 150. So that additional 50 is also kept on the left hand side under shareholder funds with the heading revaluation reserve. Okay, but that money was not at all realized. So because of that reason, bankers adopt a very conservative approach. They will ignore that 50 million. They will ignore revaluation reserve. So that's what we are also going to do now. Even though we see shareholder funds has 200 million, since that includes 50 million of revaluation reserve, from this 200 million, we are going to deduct it. Okay, so point number 1. Number 2, look at the asset side. There is an investment in subsidiary of 50 million. So this money is not sitting in the present business. This 50 million has gone outside to subsidiary. So it is not sitting in this business, rather it has gone out to subsidiary. And subsidiaries are generally long-term investment which are not likely to come back. And our banking system also recognizes this fact that this money is not going to come back. So that will also be reduced from shareholders funds, 50 million. Then also have a look at goodwill. Goodwill is the intangible asset which they are carrying now. Probably this goodwill they would have accounted in their books when they have acquired some asset where they paid over and above its value. Okay, let's say they have acquired some particular company where they have paid over and above the value of that business. When they pay over and above what it is actually eligible for, that incremental portion we recognize it as goodwill, because that is going to give them additional revenues for the business. Okay, fine. Now this goodwill is an asset, is an intangible asset, but this goodwill will not fetch any cash when this business is collapsed. Follow me very closely. This goodwill of 50 million, okay, today value is 50 million. That's what captured in balance sheet. Assume this customer has defaulted the loan. Bankers are taking possession of assets. They are enforcing. They are selling each and every asset. They can sell current assets. They can sell fixed assets. All will have some value. It will give some cash flow so that loan outstandings can be reduced. But one asset will not fetch any value, that is goodwill, because already the goodwill of the business, the reputation of the business is lost, and that's why they have become an NPA. Okay, that's why that business is in NPA condition, and that's why bank is enforcing the assets. Okay, so the goodwill, which is an intangible asset, will not fetch any value at the time of realization. So bankers, on a conservative angle or conservative side, they will also deduct goodwill from shareholders funds. So originally the shareholder funds what we have is 200 million, but of that we are deducting 3 items. So now what we have is adjusted shareholders funds. We call it as adjusted tangible net worth. And in this case, it is only 50 million. We started with 200, but it has come down to 50 million. And please note, I'm using adjusted tangible net worth. We started with net worth, right? And this net worth figure, when it is adjusted for revaluation reserve and goodwill, we call it as tangible net worth. Because these two items, this revaluation reserve and goodwill, are almost intangible. Okay, goodwill is absolutely intangible. Revaluation reserve is only a book entry. So when we deduct these two items from net worth, we migrate to tangible net worth. And when we deduct this investment in subsidiary, we get adjusted tangible net worth, and some banks, they also deduct when investments are made in associate concern, and even if some long-term loans are given to subsidiary concerns or associate concerns or sister concerns, even that will be deducted by conservative bankers. Okay, now let us calculate this modified debt equity ratio. We know debt is 300. Okay, we'll take debt, that is TOL, in the numerator, and in the denominator, instead of net worth, we'll have adjusted tangible net worth. So 300 by 50, and the ratio is 6:1. So look at the difference. TOL by TNW, it is 1.5:1. Okay, it looks like a wonderful ratio, but if you want to see the real face of it, you have to go deeper, and here you can see TOL by adjusted TNW is 6:1. So most of the banks, they have this ratio as well. So they not only just look at TOL by TNW, they'll also see what is behind this. Okay, what is the reality, what is the exact face of this business, and that gets communicated through TOL by adjusted TNW. Let's move on to working capital turnover ratio. Here I've just skipped the order because I wanted to present this before. It's very important from banking point of view, from credit appraisal point of view. Working capital turnover ratios, we are going to classify them into 3: inventory turnover ratio, debtors turnover ratio, and creditors turnover ratio. First, let's get started with inventory turnover ratio, and in that process we'll also understand inventory holding period. I'll take you through two scenarios, scenario 1 and 2, and look, here I'm giving you information about cost of sales of a particular business. That is, in 1 year they have made sales. I'm not talking about the sales, but I'm giving you the cost of that sales. The cost of that sales, it means their raw material, labor, manufacturing expenses, okay, all those, the selling, admin expenses, all those that are gone into the cost of sales. Okay, that's the information you have, which is 120 million, and they maintain an average inventory of 10 million. Okay, by looking at these two numbers, what we can infer? What I can infer is they maintain an average inventory of 10 million always. It means they purchase their first set of inventory, that gets sold, so they purchase their second set, again that is getting sold, and since they want to keep an average inventory of 10 million, again they purchase a third one, that is getting sold, they purchase their fourth one, that's getting sold. Like that, they would have purchased and kept inventory almost 12 times, so that 10 into 12, it got sold. That's why we have cost of sales as 120 million. Again I repeat, they purchased their first set of inventory for 10 million. Okay, it got sold, and they wanted to maintain inventory always at the average of 10 million, so they purchased second set, that is also getting sold. So when the first sale happens, the cost of sales will be 10 million. When the second sale happens, cost of sales will become 20 million. When the third set of inventory is consumed, the cost of sales become 30 million. Like that, 12 times this inventory would have been consumed in total. That's why their cost of sales is 120 million. So what we can infer here is this inventory was rotated 12 times, and that's why they got cost of sales as 120 million, and that's what we measure as inventory turnover ratio. That is 120 by 10, we get 12 times. This is inventory turnover ratio. Let me give you some numbers for scenario 2. Here also my cost of sales is 120 million, but the average inventory what I maintain is 60 million. It means I have purchased an inventory 60 million, and that is getting sold in the process. Then when it has come down, again I purchase and maintain inventory, that is also getting sold. So this first lot of inventory got sold, so my cost of sales is 60 million, and when my second lot of inventory also got sold, my cost of sales have become 120 million. So what is the message? I've rotated this inventory 2 times. 60 million first lot, 60 million second lot. So here the inventory has been rotated only 2 times. Whereas in scenario 1, I keep not so high inventory, but I was able to rotate this inventory several times. Whereas in scenario 2, I had very high level of inventory and the sales is not happening at a faster pace. Because of that, I was able to rotate only 2 times. If this had been something, if scenario 2 is something similar to scenario 1, what would have happened? Ideally, this 60 million should have been rotated 12 times and my sales should have been somewhere like 720 million. But no, it's not happening. My products are not getting pushed in second scenario. The 60 million what I purchased and kept in stock was got pushed only 2 times. Okay, that's what we can infer from inventory turnover ratio. In scenario 1, inventories are getting rotated at a faster pace. In scenario 2, it's very low. And how did we calculate this inventory turnover ratio? I took the annual cost of goods sold, I've divided it by average inventory. 120 by 10 gave me 12 times, 120 by 60 gave me 2 times. Okay. So what it communicates is basically going to communicate the ability to make more profits, profitability. In scenario 1, profitability will be much more when compared with scenario 2. In scenario 2, the profitability will be less due to the fact that they have high level of inventory, so there will be high storage cost. They have high level of inventory. It's possible some of the items in the inventory could become unusable, could get damaged, and as a result there will be loss which will impact the profits. And I have 60 million high value inventory. My money is getting locked there, so in order to run my business I have to arrange alternate money to that amount, and it will not come free, it will come with a cost, and that will have impact on the profit. And if I put in my own money instead of borrowing money to meet what is locked in the inventory, then there is an opportunity cost. Opportunity cost is a cost for me, because if I had invested this money elsewhere with good return opportunity, I could have earned return on that, but instead of earning on that, I'm investing here, so there is an opportunity cost. Okay, right. So this is what inventory turnover ratio is all about. But bankers are used to look at more from the period angle rather than the turnover angle. So what we'll do, we will convert this into period. How? We know what is annual cost of sales. Using that information, let us find out monthly cost of sales, which is nothing but annual cost of sales divided by 12 months. That is 120 divided by 12 will give you 10 million as monthly cost of sale. In second scenario also it is same 120 by 12. Now what we can do, we can compare this monthly cost of sales with average inventory. Average inventory, we know already we have 10 million and 60 million. Now let us relate these two, monthly cost of sales and average inventory. My average inventory in scenario 1 is 10 million. My monthly cost of sales is also 10 million. So I can say my average inventory is equal to 1 month cost of sale, or I can say my average inventory is 1 month level. So inventory holding period is average inventory divided by monthly cost of sale, 10 by 10, so we call it as 1 month. Whereas in scenario 2, my average inventory is 60 million, my monthly cost of sales is 10 million, so I can say my average inventory is 6 times of my monthly cost of sales, or I can say my inventory holding period is 6 months. How I derived it? 60 divided by 10. That gave me 6 months. Now by looking at this period, we'll get even more clarity. In scenario 1, inventory is locked only for 1 month period, whereas in scenario 2, inventory is locked for 6 months period. Then you can visualize how much amount of money is locked. You can visualize for how long you have to pay storage cost, for how long the goods are kept in the godown, there is a possibility of losses, and for how long you have to arrange alternate funds and you have to pay interest on that. Okay, so that's the kind of inferences we can have by looking at inventory holding period. And here I gave you how to find the inventory holding period just using the logic. You can also find the inventory holding period using one simple formula, that is through another method, that is take 12 months in the numerator divided by inventory turnover ratio. So here take 12 months divided by 12 times, you get 1 month. Take 12 months divided by 2 times, you get 6 months. As simple as that. Okay, so that's about inventory turnover ratio. Next, we'll
Yeah, sorry for that interruption. Now the time is 11:30. Shall we take a break now? Because next what we have is debtors turnover ratio, because if I start that would run for another 10 minutes. Our break will get extended. Shall we have our break? Just type yes. Yeah. Okay. So the break timing is like this. We are going exactly as per schedule. 11:30 to 11:45. It means we will resume back by 11:45. And whenever you go for a break or lunch break like this, please take an oath you will come back. Okay, you will come back. So I'm not going to disconnect. It will be live. I'll be playing some small materials in the background. So for next 15 minutes, it will be running, and exactly we'll start by 11:45. Yeah, see all the questions I'll be answering only by evening. Okay, so all of you, I request you to post all your questions in Telegram group. I'll be answering them evening one by one. Yeah, that's for Suresh. Okay, right. So it is 11:45, 46. We are back. Shall we continue? Just type continue so that we'll continue our discussion. Thank you, Sudhir, Prasoon, Bharat, Thompson, Dilip, Sukhdev, Shegar, Santana Perumal, Sindhuja. Thanks a lot. I think we stopped at inventory turnover ratio, and we have to get started with debtors turnover, right? Okay. Just a moment. Yeah. Okay. Telegram group link I'll share once again. Yeah, I'll do it. Telegram, I'll post that here. Let me just start this.
Period. Debtors turnover ratio. Again, I'm going to use similar situation. Here what I'm giving you is annual credit sales of 120 million and average debtors of the business is 10 million. So what that means, annual credit sales means these are all the sales where I have made the sale but the cash is not collected immediately. The customers are given some time. Average debtors means these are all the customers who are yet to pay me. So my annual sale, one full year sale is 120 million, and at any point of time I have 10 million worth of customers who are yet to make payment. Now if I look at it, what I can infer is my annual credit sales are much better, because I mean when I compare it with the debtors, because out of 120 million already 110 million has been realized, and I can also express in times, that is my credit sales or certain number of times of debtors. So 120 by 10 gives me debtors turnover, that is my annual credit sales of or 12 times of my debtors. Okay, so 12 times of debtors, or I can also put it like this, 12:1. That is, if I'm having a debtor of 1 rupee, it means this is the scenario when I have sales of 12 rupees. So out of 12 rupees, only 1 rupee is still pending. Okay, that's a good sign. Or I can say debtor service 12 times. My sales are 12 times of debtors. That's a good sign. But look at this scenario 2. My annual credit sales are 120. My average debtors are 30 million. It means out of 120, I have recovered only 90 million. Still 30 million is pending. And if I calculate the number of times, that is 120 by 30, what I get is 4 times. What I get is 4 times. So what is the understanding here? My sales are only 4 times of debtors. It means my debtors figures are bigger. Okay, and if I express it as 4:1, which we don't do, but still for understanding I'm saying, if I express it as 4:1, for every 4 rupees of sales I have 1 rupee of debtor. Whereas in scenario 1, for every 12 rupees of sales I have 1 rupee of debtor. Okay, that's it's more comfortable, right? Out of 12, only 1 is debtor, whereas here out of 4, 1 is debtor. It means nearly 25% of the sales are yet to be realized, right? Whereas here out of 12, only 1 rupee is debtor. Only a small portion of sales is yet to be realized. So that's what we understand. So by looking at this debtors turnover ratio, you will get to understand at what pace you are collecting money from the customer. When 12 is the sale and 1 is the debtor, it means you have collected the money at a faster pace. Whereas when 4 is the sale and 1 is the debtor, it means you are collecting money at a much slower pace. And how did we calculated this debtors turnover ratio here? We took annual credit sale, we divided it by average debtors, as simple as that. And what it communicates collection speed. In scenario 1, collection is happening at a faster pace, whereas in scenario 2, it is at a slower pace. And slower pace comes with many side effects. Side effects are, number 1, it's going to have liquidity strain in your business. Yes, the 30 million which should have come from customers, which should have injected liquidity into your business, has not come. It is still sitting at the home of the customers. Right? This 30 million, your money, is sitting in the hands of customer. It means if you want to run your show, you have to borrow alternate 30 million. Because you need that money to run your business. And when you go to the bank and show the 30 million of debtors, and if you ask the bank to give a cash credit against debtors, a bank will not be generous when it comes to debtors, because for them the debtors are slightly risky asset when compared with the inventory. Because inventories, in case of a default, bank can take the possession of inventory, sell them, get the money back to a certain extent. But that's not the case with the debtors. If it is a bill, then yes, they have some kind of a recourse. But if it's a debtor, bank will always be little finicky. Okay, they will say, okay, you have 30 million worth of debtor. We'll give you 60%. Okay. If it is inventory, bank will say, we'll give you 75% of 30. But if it is debtor, we'll give you only 60%, because we do not know whether those customers will pay or not. Number 1 reason. Number 2, this debtor figure is a figure which includes profit also. Why, as a banker, we should fund your profit? Okay, so because of these 2 reasons, what the bank will do, they generally stipulate a higher margin on debtor. It means if you give 30 million debtor as security to the bank, and if you ask for a loan, bank will give maximum 60% of it, maybe 18 million. It means you still have to manage another 12 million. And this 18 million will also come with a slightly higher cost because of inherent risk. So your finance cost will be higher. And it is also possible that some customers may not pay. Look, when the debtors turnover ratio is 4 times, it means a good amount of debtors are yet to make the payment. And it could also be because of the reason they are not in a position to make the payment. So there are possible bad debt losses. Even 1 or 2 bad debt losses will wash away the profits of the business. Okay, so there could be bad debt losses. And if you are putting your own money to tide over this fund locked, then you are also being deprived of some return on that, which you could have otherwise earned by investing elsewhere. So there is an opportunity cost. Okay, so that's what debtors turnover ratio communicates. And bankers, as already I said, under inventory turnover ratio, they'll be looking more in terms of period. So let's convert this debtors turnover ratio into period. So already we know annual credit sale. Let's divide it by 12 months so that we get monthly credit sale. 120 by 12, 10 million, 10 million. We'll compare that with average debtors of 10 million and 30 million. Now you look, average debtors is 10 million, monthly credit sales is also 10 million. So you can say that your debtors are equal to 1 month sale, or you can say your debtors collection period is 1 month. How I derived this? I took average debtors, I divided by monthly credit sale. 10 by 10, it is 1 month. In scenario 2, my average debtors are 30 million and my monthly credit sales are 10 million. It means my debtors are 3 times of my sales. My debtors are 3 times of my sales. So 30 by 10, it's 3 months. Okay, so by looking at this period, you get to understand that your debtors collection period of 1 month is much better than 3 months, because within 1 month you are getting your money, but in the second case you are deprived of your money for 3 months and you have to manage all the liquidity strain, finance cost, bad debt losses, opportunity cost, all those. Okay, so this is what we can infer from debtors collection period. In the same way, we can also look at creditors turnover ratio and payment period. Let me run all this, then I'll explain just the key points. Okay, yeah. Look at this. You have annual credit purchases and compare that with average creditors. So you have creditors turnover. Here the creditors turnover of 12 times and you compare that with 4 times. So what you can inference is your creditors are settled at very faster pace, whereas here the settlement is happening at a slower pace. So when you will make slow payment to creditors, when you have liquidity strain. So the lower creditors turnover ratio indicates your business is having liquidity strain. And when you don't pay your creditors on time, it is possible they levy penalty. So there will be increase in credit cost, which will have impact on profits. Then that can also cause the profits of the business to come down. Okay. So these kind of inferences are possible by looking at creditors turnover ratio and creditors payment period. And here, if you look at the creditors payment period, which is calculated in the same way like how we did inventory holding period and receivables collection period. It is 1 month and 3 months, and 1 month settlement means you are settling at a faster pace. 3 months you are taking extra time, and this has to be compared with reference to what is the credit period given by the creditors. If the creditors are giving 3 months credit period, then we need not be worried with this 3 months period. But if the credit period given by creditors is only 1 month period, and if this business is taking 3 months, then there is actually 2 months overdue. That will result in other issues like potential future problems. Okay. Good.
Yeah, the first part of financial ratio analysis is complete now. We have the second part. I'll be playing that. The last discussion, the creditors turnover ratio and the creditors payment period, I had an interesting query from one of the student. He asked me, if creditors is giving you 4 months credit period, why you are saying 1 month is good? And for that, I have given an answer, and for that, I received a few bulb-on moments. Okay, that is an extension of what was discussed here. And if you want to know what is that, you have to get into the Telegram group. When that student asked this question, I replied him through a video lecture. Okay, so I'll share the Telegram group link once again. Do not go for it now. Do not go for it now. Whether my sound is too low, anyone facing difficulty? So my audio, is it okay? Yeah, fine. Okay, so I'm just sharing the Telegram group link. I think Pawan asked for this once again. At the end of the webinar, today when we conclude this, you can go back to the Telegram group. The beauty of Telegram group is you can access all the past contents. Okay, so whatever queries that were asked by various members and answers given by me and by other members, the video lectures, everything will be available there. And this query, whether 1 month credit period is good or 4 months credit period good, is answered there. Go through, it will be a kind of bulb-on moment for you. Okay, shall I continue? Just type continue. It's basically for internet testing, internet connectivity. Type continue. Yeah. Let me play the second part.
Next, let's move on to activity ratios. We also call this as turnover ratios or performance ratios, because these ratios helps us to understand the performance and they are more related with turnover. Okay, here the assets are going to be related with turnover. So under activity ratios, we basically have 4 ratios, and here my focus is going to be on the fixed asset ratio, and in that process easily you will also understand total asset turnover ratio. Okay, so watch this case very carefully. There's a company called X Limited. It has invested in a project, let's say 100 crore, setting up a big project, land and building, plant and machinery, a factory and all. they've taken up this project with an expectation of getting 15% return on investment. It means they have invested 100 crore. They are expecting 15% return every year. They are expecting 15% return every year. It means they are expecting a return of 15 crore. Okay. So what is the message? The message is this business should make a profit of 15 crore. Only then the expectation can be met. Okay. This is the understanding. Now listen. Now let's see what this business has achieved in terms of sales. And you are also getting another important information, that is the profitability. This business has a profitability of 15%. Okay, incidentally both are matching. Okay, incidentally both are matching. That is, profitability of 15% means for every sales they'll make profit of 15%. If they are selling for 100 rupees, they make a profit of 15 rupees. If they are selling for 300 rupees, they make a profit of 30 rupees. Okay, that's what the profitability communicates here. Okay, now listen. We know fixed assets are 100 crore, right? Okay. The sales is 50 crore. The sales what they have achieved in a year is 50 crore, and we know profit margin, that is profitability, is 15%. So what would be the profit for this business? 50 crore into 15%, the profit is 7.5 crore. So at this point, I have a question for you, whether the investors in this business will be happy. Will they be happy? Because they were expecting a profit of, they were expecting a return of 15 crore. It means they were expecting the business to make a profit of 15 crore, but this business has made a profit of only 7.5 crore. So investors will not be happy. Let me give you another scenario where the fixed assets are same 100 crore, but sales is 75 crore. They have put in some more efforts, but the profit margin is same 15%. So what will be the profit here? 75 into 15%, it is 11.25 crore. 11.25 crore only. Whether the investors will be happy, at least now answer is no, because they were expecting 15 crore. Okay, let me give you a third scenario. Fixed assets are 100 crore and sales is also 100 crore. And what is the profit margin? 15%. So what is the profit? 15 crore. Whether investors will be happy now? Yes, now they'll be happy because they were expecting a return of 15 crore. This business has made a profit of 15 crore. So there is matching. And here they'll be happy because the profitability of this business is 15%. But on the other side, if the profitability of this business had been 10%, then even 100 crore sales will give profit of only 10 crore, whereas the expectation is 15 crore. In this case, incidentally, the profitability and expected return on investment are one and the same. Let me give you a fourth scenario where fixed assets are 100 crore, same, whereas sales is 125 crore and this business can deliver 15% profit margin. It means the profit is 125 crore into 15%, that is 18.75 crore. Here, yes, investors should be jumping with joy because they were expecting 15 crore, whereas businesses delivered 18.75 crore. But here also it was made good because the profit margin is 15%. What would have happened if the profit margin is only 10%? For a sales of 125 crore, the profit would have been only 12.5 crore. For a sales of 125 crore, the profit would have been only 12.5 crore, still not matching the expectations. Okay, but okay, luckily here the profitability is 15%. Now listen, very critical. In first two scenarios, the sales are lesser than fixed assets. In the third scenario, sales is equal to fixed asset, and in the fourth scenario, the sales are greater than fixed assets. So when the profitability is 15% and when the sales are less than fixed assets, we call this as inefficient utilization of fixed assets. Because to get that 15 crore, they have to achieve more sales because they have fixed assets of 100 crore, but sales are not even matching the fixed assets. That's why we say it is inefficient utilization of fixed assets. And when sales are equal to fixed assets, and when sales are greater than fixed assets at a given profitability of 15%, we call this as efficient utilization of fixed assets because those sales are delivering 15% profit margin that is matching with the expected return on investment of 15%. Okay, so and it's here this ratio comes into picture, that is fixed asset turnover ratio. That is net sales divided by average fixed assets. So we know the net sales are 50, 75, 100, 125. You divide the net sales by fixed assets. 50 by 100 gives you the ratio as 0.5:1. 75 by 100, 0.75:1, 1:1, 1.25:1. And what that communicates, for every 1 rupee fixed asset, they are making a sales of only 50 paise. So because of that only, it's not matching the expectation. For every 1 rupee of fixed asset, they are making sales of only 75 paise. So whenever the ratio is below 1, that communicates inefficient or underutilization of fixed assets. And when the ratio is equal to 1, as an investor, you can be happy provided the profitability also matches the expected return on investment. Otherwise, you have no reason to be happy. And the fourth scenario, 1.25:1, it means for every 1 rupee fixed asset, the sales is 1 rupee 25 paise. Here you can be happy provided the profitability matches the expectation. Okay, so how a fixed asset turnover ratio should be ideally? Fixed asset turnover ratio should be 2:1. For every 1 rupee of fixed asset, there should be 2 rupees of sales. Only then it will make some justice, because not everywhere you will have the profitability matching return on investment expectation. In this case, I said 15% is the profitability, 15% is the return on investment, right? But if the profitability is 5% and if the return on investment expectation is 15%, then even 100 crore, 200 crore sales will not do justice. Okay, so it has to be understood with reference to that, with reference to profitability. Okay, and this is what we understand from fixed asset turnover ratio. So this fixed asset turnover ratio, you cannot prescribe any benchmark specifically. So if you want to really understand the efficiency of the business, with what efficiency they are utilizing the fixed assets, you have to compare that ratio with peers. We have to compare with industry as well as the past. And this ratio is very important for business which are capital intensive.
It's close to 70 minutes now. Next, we have important ratio, that is debt service coverage ratio. Let's see.
This ratio is calculated to measure the repayment capacity of a borrower when he approaches a bank for a term loan. So how repayment capacity is measured? It is measured by finding out the cash profit available for debt service and comparing that with the repayment obligation for every year, which is interest plus principal. So here, how this cash profit available for debt service is computed. Let me show. What we do is we take profit after tax and dividend. With that, depreciation will be added back. Reason being, depreciation is a non-cash item. Not even a single penny cash goes out in the name of depreciation. Okay, since we want to find out cash profit, what we do, we add back depreciation, because while arriving at the profit after tax, this depreciation was subtracted as an expense, but no cash goes out, so we are adding back depreciation. Then we are also adding interest, not because it is a non-cash item, but because we want to know what is the cash profit available for paying interest and principal. If you want to know what is the cash profit available for paying interest and principal, you cannot take cash profit which is after paying interest. Okay, because we are starting with profit after tax and dividend, right? This profit after tax was arrived after subtracting all expenses which also include interest. So let us add back that so that it gets nullified. So by doing this, taking profit after tax and dividend, and by adding depreciation and interest, we arrive at cash profit, and this is the formula followed by most of the bankers. Let me take you through an example so that you can understand it better. Look at this statement. This particular business has made a sales of 1,000. Their direct cost is 500. Their gross profit is 500. Operating expenses are 100. Depreciation is 100. Interest on loan is 100. So from sales, direct cost was deducted 500. They had a gross profit of 500, and we are deducting 3 expenses. So from gross profit, when we deduct all the 3 expenses, we get the profit before tax. So 500 minus 300, you have as 200. From that, let's deduct tax at 50%, which is 100. So you get profit after tax of 100. Now listen. For computing debt service coverage ratio, what we have to do? We have to take profit after tax. With that, we have to add back depreciation and interest on loan. In this case, there is no dividend, so we are starting with profit after tax. So 100 plus 100 plus 100, 300. This becomes the cash profit. This cash profit have to be compared with the repayment obligation, which is basically interest on loan of 100, what we have seen, plus interest on principal I am giving you, which is 100. So what is the total obligation? 200. What is the cash profit? 300. Now we can find out debt service coverage ratio. DSCR is equal to profit after tax and dividend plus interest on term loan plus depreciation divided by interest plus principal. In this case, it is 300 divided by 200 and you get as 1.5 times. You get the value as what? 1.5 times. And what does that communicate? For every 1 rupee loan obligation, which is interest plus principal, this business is having a cash profit of 1 rupee 50 paise. So it looks good, right? Because for paying 1 rupee, they are having a cash profit of 1 rupee 50 paise. It means from 1 rupee 50 paise, 1 rupee can be paid off. Still 50 paise is available with that business. They can use that 50 paise for supporting their working capital requirements. Okay, right. Now I want to ask you a question. What is the minimum DSCR insisted by most of the banks? If you're working in a bank or if you are exposed to this concept, please give your answer. What is the minimum DSCR insisted by most of the banks? Okay. 1.1 will be insisted by the banks who are ready to take risk. Okay, because 1.1 is a very small ratio. If they are okay with that, it means they are willing to take more risk. It means the side effect is the interest rate will be very high. 1.5 is accepted by most of the bankers and 1.75 is insisted by public sector banks, okay, who are very conservative. They'll be insisting a DSCR of 1.75. Now, let me take a couple of minutes to explain the DSCR rationale, why some banks are insisting on 1.75 times or say for that matter even 1.5 times. Why banks are insisting on DSCR of 1.5 or 1.75 and not just 1? Because if DSCR is 1 for paying loan obligation of 1, they are having resources of 1, why not banks stop with that? Why they are insisting on 1.5 or 1.75? Shall I explain? Okay, let me explain the rationale behind this minimum DSCR. Look at this. If DSCR is 1.75 is to 1, it means for every 1 rupee obligation, there is a cash profit of 1 rupee 75 paise. So from 1 rupee 75 paise, 1 rupee can be paid and what is left with the business is this 75 paise. This 75 paise is the profit after tax, after dividend, after paying interest and after paying principal also. So it basically goes as retained profit, and this retained profit will go to a head called reserves and surplus in balance sheet under the head equity. And equity along with other long-term liabilities will become long-term funds, and that long-term funds can be used for supporting working capital margin. If this does not make sense for you, worry not. Look at this. Your statement of profit and loss only communicates what is profit. From that we calculate cash profit. Then we compare that with the obligation and we arrive at DSCR. And if DSCR is 1.75, it means out of 1.75, 1 can be paid, 0.75 can be retained in the business. And I told you that this retained profit will go to balance sheet under the head reserves and surplus. So now this reserves and surplus along with capital will be called as equity. And this equity along with the long-term liabilities will be called as long-term funds. These long-term funds can be considered or can be used for creating long-term assets. I repeat, these long-term liabilities can be used for creating long-term assets. But if you look at the proportion, look, you have so much of long-term funds, but only a portion of long-term funds has been used for creating long-term assets. It means there is some surplus. So what's going to happen here? This business is also raising some short-term funds. It is creating short-term assets. The short-term assets are more than the short-term funds. How it was made possible? Because short-term funds are very small, but short-term assets are much bigger than that. It was made possible because the remaining surplus of long-term funds, has been utilized for creating this short-term assets. Now try to link with our fund utilization principle. We said a portion of current asset should be funded by short-term funds and another portion should be funded by long-term funds. Because I said I marked it as ideal. Utilizing the long-term funds for creating short-term assets is ideal because that is going to relieve the business from liquidity pressure. So if a business is having a DSCR of 1.75, that 0.75 gets retained in the business. It gets retained. It becomes part of long-term funds. So that long-term funds, after being utilized for creating long-term assets, there will be some surplus. That surplus will in turn get utilized for short-term assets, and this is what we call as long-term funds used for creating short-term assets. Technically, this is the net working capital. Okay, so it is not that mere profit along with capital, along with long-term liability, they all become put together long-term funds, and they are actually supporting short-term asset creation. So this is the logic. I hope you would have understood. Next, let us move on to profitability ratios. Profitability ratios can be calculated by relating the profit with sales. Profits are related with sales, we call them as general profitability ratio, and when profits are related with investments, we call them as overall profitability ratios, or it is also called as return on investment ratios. First, let's get started with general profitability ratio. Under that, we have gross profit ratio, operating ratio, operating profit ratio, expenses ratio, and net profit ratio. Even though we have several ratios, only selective ratios are used widely by bankers. First, I'll take you through gross profit ratios. Gross profit ratio is a ratio where gross profit is compared with sales. That is, from sales, if you deduct cost of goods sold, you will get gross profit, and that gross profit is compared with sales. Let's say sales is 100 million, cost of goods sold is 80 million. So 100 minus 80 gives you gross profit of 20 million. So now gross profit ratio we can calculate gross profit divided by net sales into 100. So it is 20 divided by 100 into 100. So it is basically 20%. This is how we calculate gross profit ratio. Next comes operating ratio. Operating ratio is a ratio where we will compare the operating cost, not the operating profit, operating cost with net sales. Operating cost is nothing but cost of goods sold. Already we have seen in gross profit ratio, right? Cost of goods sold plus other operating expenses. So how we are calculating this? Operating ratio is equal to operating cost divided by net sales into 100. Let me give you an example. Let's say sales is 100 million and there are some sales written also, and you have information about raw material being consumed 60 million, manufacturing expenses 10 million, admin expenses 5 million. So with this information you have to calculate operating ratio. How do we do it? We have to take operating cost. Operating cost is nothing but cost of goods sold. Okay, so operating cost divided by net sales into 100 will give us the operating ratio, whereas operating cost is nothing but cost of goods sold, in which case it is 60 plus 10, 70 million, and 5 admin expenses. That comes under other operating expenses. So if you add these two, that is cost of goods sold and other operating expenses, you get to know what is your operating cost. It is 75 million. Now compare that with net sales. Net sales is nothing but sales minus sales return. 100 minus 10, so your net sales is 90. And operating ratio is 75 divided by 90 into 100, so it is 83%. It means they have operating cost as 83%. Next, let's move on to operating profit ratio. In operating profit ratio, we will be comparing the operating profit with net sales. Operating profit is nothing but net sales minus operating cost. Already we have seen how to compute operating cost. Okay, net sales minus operating cost gives us operating profit. Let's say net sales is 100 million and operating cost is 80 million. Then automatically the difference between these two gives the operating profit. In this case it is 20 million. So operating profit ratio is nothing but operating profit by net sales into 100, that is 20 divided by 100 into 100, so it is 20%. That's about operating profit ratio. Next we have expenses ratios. These are all the ratios where we will be comparing the sales with particular expense or group of expenses. The calculation is like this. For each and every expense ratio, we will be taking that particular expense in the numerator and we will divide it by net sales, multiply it with 100. Have a look at this. Let's say I have expense as cost of goods sold. I have expense for administration purposes. I have selling and distribution expenses. I have factory cost. I have certain specific expenses. So I can compare them with sales. So in that case, if it is cost of goods sold, then it is cost of goods sold by net sales into 100. If it is admin expenses by net sales into 100. In the same pattern I can do for other expenses. Next, net profit ratio. In net profit ratio, we will be comparing the net profit after tax with net sales. So the formula is net profit after tax divided by net sales into 100. Let's say the net profit after tax is 20 and net sales is 100. Then obviously the ratio is 20 by 100 into 100. So it is 20%. Next, we'll move on to overall profitability ratios. Overall profitability ratios is also called as return on investment ratio. Under that we have three types of ratios. One is return on asset, two is return on capital employed, and three is return on shareholders equity. First, let's have a look at return on asset. In return on asset, we will be comparing the profit with total assets. But when we say profits, there are different types of profits. We have profit after tax, we have profit before interest and tax, we have profit after tax then adjusted for tax benefit. That is profit after tax plus interest minus tax benefit. But for bankers, this third classification is not relevant. We'll just focus on the first two classification, that is profit after tax and profit before interest and tax. Look at this example. I give you sales is 100 million, operating expenses is 50 million. So sales minus operating expenses gives me operating profit. Okay, we also call it as profit before interest and taxes. That is 50 million. Then I am paying interest 10 million. So I get profit before tax. And let's say the tax is 30% on this profit. So 40 into 30%, it is 12 million. So we get profit after tax of 28 million now. Now, let's find out the return on assets. I'm also giving you this information. Total assets is equal to 100 million. So we have three formulas, but we'll just focus on two. One is profit after tax. We will relate that with total assets. 28 divided by 100. That gives us return on assets. Profit after tax by total assets. 28 divided by 100, it means the return on asset is 28%. We also have the other formula where we take profit before interest and taxes, we compare it with the total assets. Okay, so that is 50 divided by 100, so it is 50%. So the difference between these two ratios is, this ratio is focusing on return on assets from equity shareholders' point of view, because the profits after tax is the profit available for the shareholders. Okay, so it is not specific to equity shareholder, it is specific to shareholders, we can say, because it is possible some businesses will have preference shares also. So this formula specifically looks at the return from shareholders' point of view, and for them it is 28%. Whereas this formula looks at the return not only from the shareholders' point of view, but also from shareholders and lenders' point of view. So when we say lender point of view, we have to consider the profit before rewarding the lender. So profit before interest is the profit before rewarding the lender, because the reward for lender is interest. So before rewarding the lender, what is the profit? It is 50 million. So that 50 million is the profit available as well as for the shareholders, because it is from this 50 interest have to be paid, and it is from this 50 after providing for taxes, the remaining profits are available for shareholders. So we say this is from both the shareholder and lender point of view, and in that case it is 50%. The third case I'm not explaining, so I'll just skip this. Okay, next let us understand return on capital employed. Return on capital employed. In return on capital employed, what we do, we compare the operating profit with the capital employed. And what we did in return on asset, we compared the profit before interest and taxes, which is nothing but the operating profit, with the total assets. And here we are comparing the operating profit with the total capital employed, which will be obviously equal to total assets. Okay, so this is kind of a mirror ratio of return on asset, but banks will have varied definition for capital employed. Some banks will consider the total capital employed, that is equity shareholders' money plus long-term liability plus short-term liabilities. Some banks will restrict that to long-term liabilities only. So depending upon the bank, this calculation part could vary, but for me it is more or less the mirror of return on asset ratio. So here we will be comparing the operating profit, which is nothing but the profit before interest and taxes, with the capital employed. Have a look at this balance sheet. You can see shareholders funds, bank loans, sundry creditors all put together 300. Fixed assets, current assets put together 300. And you can also see their income statement. Sales is 200 million, operating expenses 150, so operating profit is 50. Interest is 10, so profit before tax is 40. Now we can easily find out the return on capital employed. In return on capital employed, the numerator will be the profit before interest and taxes, which is nothing but operating profit, and denominator will be the total capital employed. In this case, it is 100 plus 100 plus 100, 300, that is the total capital employed, and the operating profit is 50. So return on capital employed is operating profit divided by capital employed. It is 50 by 300 into 100, so it is 16.67%. Okay. Next, we have return on shareholders' funds. The return on shareholder funds is basically calculated by comparing the profit after tax with shareholders' funds. Okay, so the profit after providing for taxes, that is compared with shareholders' funds. So the formula is profit after tax divided by shareholder funds into 100. Okay, then if we go even beyond this, it will go deeper into various ratios from shareholders' point of view. But here I want to stop the ratios at this juncture, because the focus is more on say the performance, efficiency, the liquidity and solvency. The other set of ratios that are relevant for the shareholders are not relevant for us at this point of time.
Yeah, thank you. So how the session is going so far? Are you really deriving value? If you're deriving value, please type IDV. Thank you, Sivam, Prasoon, Viresh, Thompson, Shruti, Shekhar. Thanks a lot. Thanks a lot. Now, the ratio part is completed. I didn't get into shareholders ratio. That's basically from owner's point of view, investment point of view. That will have a separate session. Okay. Now, we are going to get into the most or critical part, that is working capital. Working capital. So just type WC, just type WC so that we can get into working capital session. Yes. In this presentation, I'll try to cover the concept of working capital, covering the why of working capital, why what, then we'll also understand working capital cycle, what are the sources available for funding working capital, and if time permits, we'll go deeper into the fund-based and non-fund-based working capital products. One assurance I can give you is I'll try to cover fund-based working capital products as much as possible. And if time permits, I'll take you through non-fund-based. Okay. So this is the context I want to set. So whether everything is clear, the audio, video, shall we start now? Just type start so that we'll take off. Just type start, so we'll take off. I request all of you to type because it's basically to ensure that we are connected, not because on my side. Okay. Yeah. Thank you. Just a moment. I'm playing this in YouTube, so let me just check whether it is going perfect in YouTube also. Yeah. Okay. Thanks a lot. We'll move on now. So in order to make you to understand this concept of working capital, I'm sorry, I'm going to start with a negative question. The question is this: why business fail? Okay, put yourself into the shoes of an entrepreneur or put yourself into the shoes of a banker and just have a look at those businesses which have failed. Okay, in your experience, you would have come across some business which had undergone failure, or you would have heard some stories from entrepreneurs why they failed. Okay, now try to put them. Okay, we'll try to put them and let's bring it out. Okay, so just type out why a business could fail. If at all a business fails, why? Whoever have attended my earlier webinars, they'll know like what's going to be the flow. But others, please type why a business could fail. What could be the reason when a business will fail? Yeah, Sandosh is saying lack of knowledge. Ankur is saying underestimation of working capital needs. Anurag is saying lack of experience. Obstruction in operating cycle. That's from Krishnagiri. Javan is saying lack of planning. Perfect. Pandu is saying failure to manage working capital. Good. Yeah, I could see things are pouring. Yeah. Let's maintain this energy. Failure to understand the market trend. That is from Anurag Singh. Sunil Rana is saying poor management. Rishabh is saying it can be on account of many factors, internal and external. I agree fully. Ankur is saying diversion of funds for personal consumption. Okay, so there can be various factors. Like this. Yeah. So let me put them. Yeah, here on YouTube also I could see Sidhu saying lack of planning. Rajiv saying improper management. Okay, so let's bring all over here. So it can be on account of marketing, it can be on account of competition, quality, not doing enough R&D, then not updating your technology, not managing your HR, human resources effectively, not giving due attention to the pricing. Then even the legal problems can come in. Then Ratan is saying bad credit policy. Yeah, I agree. See, all these are all reasons they can pull down a business. But a study was conducted, and let's say 100 failed units were selected, and they were asked, what is the reason? So reasons like this came up, like poor marketing, technology, pricing, legal, competition, everything. But the stunning fact is, all these reasons collectively contributed only to 5% failure of business. That is, if 100 failed units were selected, of that only 5 units failed on account of this or these many reasons collectively. It means remaining 95% business units, they failed on account of one single factor, that is financial mismanagement. And when we go deeper into financial mismanagement, it can be on account of diverting short-term funds for long-term purpose, or it can be on account of not managing their working capital. So the financial mismanagement can be intentional or unintentional. And when the working capital is not managed effectively, it could result in financial mismanagement, and those companies, they get into that trap of 95%. So in that context, it becomes very, very important to understand what is working capital, to effectively manage working capital. Otherwise, businesses will get into the trap of 95%. Okay. So this is the backdrop. With this, let's move on to understand what is working capital. For that, I'm going to take you through a small example. Let's say I'm going to start a business, and this business demands an investment of 10 crore. And why I need this 10 crore? I need this 10 crore to invest in land and building 4 crore, plant and machinery 5 crore, and furniture and fixture 1 crore. So totally 10 crore. I'm investing on these items. I'm going to call these items as assets because I'm going to own that. And for funding these assets, I am bringing money. When I bring money as the owner, it will be called as capital. So I'm bringing a capital of 10 crore that is used for creating these many assets. And capital comes under the head called equity and liabilities. So this is looking like a statement. And if you look at the total, both sides, the total is also balancing. So we can give a name for this statement. It's simple. The name of the statement is balance sheet. So this balance sheet communicates from where money had come for the business. The money of 10 crore had come for this business from the owner. That's why it is called as capital. Had it come from outsiders, had it come from bankers, it would have been classified as loan. Okay, but it had come from owners, so it is classified as capital. And that money is used for what purpose? Land and building, plant and machinery, furniture and fixture. It means now I have an amazing factory, all plant and machineries and furniture and fixtures. It means I have set up or created a basic infrastructure. I have created basic infrastructure. Now a customer walks in and he is ready to place an order with me. I have a question for you. Put yourself into this position. You are facing your first customer, and first customer is placing an order. Will you be happy about this? Just say yes or no. If it is no, give your reasons. Javan Singh and Ankur is happy about this. What about others? Rishabh is not happy. But Anurag Singh is happy. Sandeep happy. Pandu is not happy. Siddhu is also not happy. Ankur is not happy because he does not have any product to deliver at this point. Because what is there is only the skeleton, okay, only the structure. Just, Krishnagiri is saying just setting up will not make the business happen. Rishabh said he is not having money to execute at this point. So I asked whether you are happy. Some of you said no. I asked why. You gave some reasons. On YouTube, I could see Sidhu is saying that there is no raw material. There are no employees to work. Exactly, I have the same point. There are no raw materials. There are no employees. And without these, I cannot carry out the production. And without this, how can I execute the order of my first customer? So here what I've done, I had 10 crore. I've invested that entire 10 crore in creating assets, but all those assets are long-term fixed assets. I have not invested in my operational expenses. I have not invested in my raw material, employees, production. It's not happening. So without investing in this, how can I expect those big long-term assets to deliver results for me? See, just imagine you want to purchase a car for taxi business. You do not know how to drive. Just imagine you have 10 lakhs with you. You use that 10 lakhs for purchasing a car and you don't know how to drive. So you should engage a driver. And if you want to take the car out of the showroom, there should be some minimum fuel. But you don't have even 1 rupee extra because you just had 10 lakhs, you purchased the car. This car will not move even a single inch. Number one, you don't know how to drive. Number two, you don't have any cash to purchase fuel for this car, right? Now listen. Sorry for the interruption. Vibhor Agarwal in YouTube, just drop a message after this webinar, okay? Do not send repeated messages now, I request you, okay? Just send message after this webinar so that either me or my executive will get in touch with you. Yeah, sorry. Okay, sorry, I just got disrupted. Yeah, so the question is, this fixed asset, what I have created, will not fetch any revenue for me, will not generate any revenue if I don't invest in that fuel or if I don't invest on the salary of employee. So unless and until I do that, I repeat, unless and until I make that small investment, this big investment will not yield any money for me. It means it's not sufficient just to have long-term capital for long-term asset, but it is also required to have some capital for the short-term assets, say like fuel, say like raw material, say like on investing on employees. So unless and until I do this, this long-term assets will not generate any revenue for me. So I should invest in working assets, not only the long-term assets, I should also invest in working assets. So this boils down to the point that working capital is the capital required for daily working of business. What is working capital? It is a capital required for daily working of business. Okay. Now I got a gyan, the knowledge. What is the knowledge? I cannot run the show just with fixed assets. I should also invest in raw material. I should invest in employees. I should invest in production process. Okay. So I'm going to arrange some cash. I managed. Somehow I arranged some cash. Now what I'm going to do with this cash, I'm going to purchase raw material. But when I move on to purchase raw material, a question arises. How much raw material I should purchase? Should I purchase raw material just for today's production? Should I purchase raw material for next 5 days, 15 days, 20 days, 30 days? For how many days? See, this actually depends upon various factors. It depends upon availability of raw material. It depends upon the price of raw material. It depends upon for how many days you can store the raw material in good condition, whether the raw materials will get damaged, whether there are any price fluctuations in the market, whether there are any restrictions in holding the raw material, whether holding the raw material beyond a certain level amounts to hoarding. Okay, so it all depends upon various aspects. So inventory management is a special area. Okay, so by applying the inventory management principles, I have to decide on for how many days I have to maintain raw material. Okay, so first my cash will go in purchasing raw material. After that, what will happen? This raw material have to be taken for production. Now the question is, how much time it will take? See, the production process can be a very simple process in some cases. It can be very complex and elongated process in some cases. For example, if you take the garments, from cotton to ultimate garment, it will take substantial period of time. because it has to undergo various stages. Whereas in certain cases, if you give the input, you will get the output in a matter of 30 minutes. Okay, so depending upon the nature of your process, the product, the production time will undergo a change. And it is in the production time, you will feed the raw material, you will engage the employees, you will consume power, you will incur various other manufacturing expenses. So with the result of all these efforts, what you will get? You will get finished goods. But again, now the challenge is whether the finished goods will get sold immediately or will it take time? Is it a hot cake or it is going to require some time? It again depends. It depends upon the market. It depends upon the product. It depends upon the demand for the product in the market. It depends upon the marketing efforts, advertising. So many factors play. So finished goods, in certain cases, for example, if you take Royal Enfield two-wheeler Bullet, they don't keep much of inventory because all their finished goods are made to order. Already they would have received an advance payment. So they produce, they immediately dispatch. They produce, they immediately dispatch. Buyers will be paying advance and waiting for months together. But in some cases, in some other brands, they'll produce, they'll keep it on display, they'll keep it in various places. Okay, they'll have stalls, they'll have promos everywhere. Okay, they'll give chance to the people to have the feel of the product. So till the ultimate buyer buys, the product will be either in display or in showroom. So depending upon the product, depending upon the various factors, finished goods will also be there. Okay, then eventually a buyer, a customer will be identified and it will be sold. But that customer may pay immediately, or that customer may be a customer demanding credit period. That customer can be a customer demanding credit period. So if that customer demands credit period, then only on the expiry of the credit period, whatever the cash you have invested in raw material will come back to you. But of course, when it comes back, it will come back with profit. So what is happening here? I realized that investing in fixed assets alone not sufficient. I should also invest in working assets. So I managed to arrange some cash. I invested in raw material. Then I waited for some days. Then I've taken that to production where that raw material. Then I also invested on some employees. Then it had become finished goods. I thought I'll get back my money, but the finished goods got locked for some time. Then eventually I identified a customer, but the customer is not ready to pay immediately. He needs some time, and only after that money is coming back to me. So what is happening here? The cash what I had went and logged in material. For how many days? I'm going to assume that in material it got locked for 30 days. Then from there, it was taken for production. Let's say my production process is 15 days. So what is happening? 30 plus 15, 45 days, my money is not going to come. Okay, then it had eventually become finished goods. But finished goods, it's not going to get sold immediately. Let's say it's going to take another 15 days time. It means 60 days my money is locked. Then I identify a customer. Customer purchased my goods, but customer is saying he will pay me after 30 days. So what's happening? 60 plus 30, 90 days. So the cash what I have invested in raw material, it will come back to me after various stages, after various further investment on the 90th day only. Okay, now answer me. The cash what I have invested now, when it is coming back to me, it's a simple calculation, but I request all of you to answer this. I had invested cash today, 0. It is coming back to me on 90th day. Okay, please all of you participate. It is coming back to me on 90th day. Now the second set of raw material purchase, when can I make? When can I make my second set of raw material purchase? Because my cash had gone out now, it's going to come back only on 90th days. So when can I make my second set of raw material purchase? It is 91st day. Yeah. When will I get back that money? When will I get back that money? 180th day. Okay, it will come back to me on 180th day. Right. When can I make my third purchase of raw material? 181st day. Okay, it's a simple calculation, but keep participating. When will I get back that money? On 270th day. And when can I make my fourth purchase? 271. And when will I get back that money? When will I get back that money? 360 days. Simple. It means how many times I can purchase in a year? How many times I can purchase in a year? 4 times. How many times I can sell in a year? 4 times. How many times I'm going to realize money in a year? 4 times. So look, what is happening here? I had money, I invested that in raw material, then taken for production, converted that into finished goods, sold to a customer, and customer is paying cash, and that cash is coming back on the 90th day. So on 91st day, I'm going to purchase like this, and if I'm going to do this, I will be repeating the cycle only 4 times in a year. But whether I can afford to tell my employees that, see, I'm going to get cash only 4 times in a year. You also take salaries only 4 times in a year. Is it possible? Can I say so? Because I'm going to get money only 4 times in a year. So can I tell my employees that please take salary only 4 times in a year? No. Yes, because expenses will be recurring. It will be fixed. Salary you have to give 12 times. And if it is wages means then weekly 54 times or 52 times. So understand, not survive in this pattern. When I invest my cash in raw material, when I do this today, I should also purchase raw material at frequent intervals so that I can have continuous production. I should not be waiting for the 90th day to purchase my second set of raw material on 91st day. If I go to the supplier and introduce myself on 91st day, he will ask me, who are you? But even more than that, I cannot sell only 4 times in a year. Yeah. If I want to sell a product in a market, I have to make such a noise in the market. I have to establish myself as a seller, and I should be available to sell my products on a daily basis. I cannot afford to sell my products only 4 times in a year. If I go to a market only 4 times in a year to sell my product, no one will agree me as a seller. No one will buy my product. So what is the message? Things should happen continuously. So when I invest my cash in raw material and when I go cash dry, I need money once again so that I can purchase my next set of raw materials. I should not wait for 90 days. When I invest my cash in my production and when I go cash dry, I need some other source to support me so that I can have continuous production process. I should not wait for 90 days. Similarly, when my money gets logged with finished goods, customers, I should not be waiting for 90 days. I should get some cash as and when this lockage happens so that my business works on a continuous basis. Cash flows happens on a continuous basis. So what's happening here? Have a look at it. I'm creating raw material, work in progress, finished goods, receivables. In all this, my money is getting locked. Okay, it means basically I'm creating some set of assets here, right? So I wish to call these assets as current assets because I can convert these assets into cash within a period of 1 year. Okay, so that gives the understanding, that gives rise to the understanding current assets are those assets which can be converted into cash within a period of 1 year. The technical definition says it can be converted into cash within a period of 1 year or within operating cycle. But for creating these current assets, I need sources. I need money. From where I can get source, from where I can get fund for creating these assets. Maybe for raw material, what I can do, I can go and ask my supplier, please give me raw material today, I will pay you on 30th day, like you giving credit to your customer. Okay, so the raw material, it is possible it can be funded by suppliers. I've just classified it as sundry creditors. Similarly, work in progress, finished goods, receivables, where my money is getting locked, right? I can approach a bank. I can approach a bank and tell them, look, this is my business, this is my operation. I'm getting support for raw material from suppliers. You please help us in you please help us to have continuous production. Please help us to fund finished goods receivables. And yes, bankers will come in. Bankers will come in through fund-based products, non-fund-based products. Fund-based products can be in the form of cash, credit, overdraft, and all. So look, I have created various current assets, and these are all funded by the suppliers, bankers, and all these are short-term funds. So since they are short-term funds, I'm going to call them as current liabilities. But still, if you ask me whether all the current assets are funded, no. Look, on the right-hand side, you have so many items, but on the left-hand side, you have only 2 items. So it looks like it is lopsided. It means there is still a gap. So who should fund that gap? See, here you can see there is a gap. Who should fund this gap? Please answer. Who should fund this gap? Very good. Promoters, borrower, they have to fund this gap by bringing suitable long-term funds. And technically, we call that as net working capital. Net working capital is nothing but the difference between the current asset and current liability. So that portion have to be funded by the promoters by bringing adequate long-term funds. So technically, we call it as net working capital. So look what happened here. Look what happened here. Various current assets are being created. And who should fund those current assets? Owners, they have the primary responsibility. Then suppliers can come in to fund creating raw materials. Then sundry creditors can come in. See, who can be sundry creditors? It can be, say, like outstanding salary, outstanding rent, electricity bill not yet paid. So all those can be sundry creditors, right? Then bankers will also fund creating current assets. And how bankers will do? They'll do it in 2 forms. One is fund-based and the other one is non-fund-based. In fund-based, bankers, they give literal cash through bank account, whereas in non-fund-based, they don't give any money, they give a letter or a certificate, and that will do the job exactly. Okay, so with this, let's get into the core of today's webinar. That is how banks are going to assess working capital requirements of borrower. That's the topic also, right? How to assess working capital as a banker, right? Okay, now listen. See, there are 3 methods for assessing working capital. Turnover method, maximum permissible bank finance method, and cash budget method. I'm not going to cover cash budget in this because that requires a lot of calculations, detailed calculations, and our timing will not be sufficient for that. Okay, so I'll restrict my focus to turnover method and maximum permissible bank finance method. Now listen, what is this turnover method? It's very simple. Knowingly or unknowingly, we have covered it. How? See, we have seen that a cycle. I mean, we started with cash, we invested that in raw material, then it was taken to production, it had become finished goods, then it was sold to customer, then eventually we got the cash. Okay, it is a cycle. Actually, I didn't name that cycle. It's called as working capital cycle. Working capital cycle, or we also call that as cash cycle or operating cycle, cash to cash cycle, right? So in that working capital cycle, what was our core understanding? I mean, the example what I gave, how many days cycle it was? How many days cycle it was? Can you just type your answer? How many days? It was 90 days cycle, 90 days cycle. Okay. And how many cycles we can have in a year? How many cycles we can have in a year? 4 cycles. Okay, right. So there are only 4 cycles. It means each cycle can be expressed as 25%. Yes or no? Because there are only 4 cycles. First cycle 1/4, second cycle 2/4, third cycle 3/4, fourth cycle 4/4. So each cycle is 90 days. So totally 360 days. Take like that. First cycle is 90 out of 360. Second cycle is also 90 out of 360. Third is also 90 out of 360. Fourth is also 90 out of 360. Okay, right. Now, what is this 90 out of 360? How will you express that in percentage? What is 90 out of 360? What is the percentage? Can someone tell me? It's simple. It is 25%. Okay. So the cycle what we have discussed is basically the core foundation of the Nayak committee method of assessment. We also call that method as what? Turnover method. Because the cycle what we discussed said the total days are 90 days. It means there are 4 cycles. So each cycle represent 25%. Okay. That's what Nayak committee also says. Look at this. Nayak committee method assumes 25% of the turnover is working capital requirement of any business. 25% of the turnover is the working capital requirement of any business, but that entire 25% should not be funded by the bank. That is, whatever the figure you get when you express that 25%, of that only 80% should be funded by banks. It means the remaining should be funded by owners. That is the argument under Nayak committee. How to understand? I'll come back to that little later. Look at this. Look at this example. You will get it clear. See, estimated turnover is 300 lakhs. I repeat, estimated turnover is 300 lakhs. Following the first method, that is the turnover method, you have to calculate what is the eligible bank finance. Now, what is our understanding? 25% of the turnover is the eligible working capital, but that is not the bank finance. Let's be very clear about it. 25% of the turnover is the eligible bank finance, of which 25% of the turnover is the eligible working capital, of which 80% is the eligible bank finance. Look at this. What is the estimated turnover? 300. What is 25% of 300? It is 75. Now, what Nayak committee says, take 80% of this. 75 into 80%. That is the eligible bank finance, and that works out to 60. So now there is a gap because their working capital requirement is 75, but what they are eligible for is only 60. It means there is a gap. And who should bring that gap? Promoters. So that becomes working capital margin, which is 75 minus 16, 15. Okay. See, now this looks like some kind of a detailed calculation. It's very simple. Close your eyes. Okay. Close your eyes. What is the estimated turnover I gave? It is 300 lakhs multiplied by 20%. That's it. What is the estimated turnover? 300 lakhs multiplied by 20%. 300 into 20%. How much you are getting? 60 lakhs. 300 into 20%, 60 lakhs. 60 lakhs is the eligible bank finance. So now a question arises, what happens to the margin? Margin is obviously supposed to be the balance 5%. Because we know 25% is the overall eligible working capital, of which 20% is now funded by the bank. It means remaining 5%. So remaining 5% on 300 works out to 15. So that becomes working capital margin. Is that okay? Is that okay? Okay, so you can simply close your eyes. I mean, if the estimated turnover is freezed, then 20% of the estimated turnover is the eligible bank finance as per turnover method, that is Nayak committee. There is nothing rocket science, no complex calculations, nothing. Now, why Nayak committee is making this kind of a simplistic assumption? See, this method is based on an assumption. Okay, this method is based on an assumption. The assumption you can see here, and this is what we have already discussed. This method assumes that the business is having only 4 cycles in a year. That's what we discussed in the cash cycle, right? 90 days, 4 cycle. So Nayak committee method assumes that business will have 4 cycles in a year. So their working capital requirement is 25% and bank can give 20% of the turnover as bank finance. And it is the minimum credit within quotes. It's a minimum credit. So what does that mean? It means if the actual working capital cycle of the borrower, if it is not 90 days, please do not harass, please do not penalize the customer by estimating the turnover by taking 90-day cycle. If you do so, you are killing 2 persons. One, the customer. Two, you are also killing your bank. Why? If a customer is in, let's say, like 120-day cycle, and if you are going to assess him for 90-day cycle, and if you are going to give him inadequate working capital financing, that is the greatest sin you can commit. Under financing, excess financing, both will cause trouble. You have to give what is right financing. Okay, so if a customer is having a 120-day cycle, do not blindly follow the turnover method, because the turnover method says it is only minimum credit. So if a customer is having 120 days, please go and assess based on his actual requirement. How many of you are with me? Just type with you. If you are with me, type with you, because this is the key learning for you from this. I mean, if you're spending your quality time, which you're ideally supposed to spend with your kids or with your family, then you should have some valuable learning. See, just imagine, based on 120 days cycle, if the customer is in need of 30 lakhs credit facility, and if you are going to give him only 20 lakhs credit facility, the question is, who is going to help him for the remaining 10 lakh? As a banker, you are not doing it, and promoter is also not capable enough to bring that. Then it means that business will starve, then it will face its natural death. Sorry for using all the negative things, but it happens. See, it's like you performing a surgery. Okay, you perform a surgery and you are supposed to give medicine, and when you give medicine, do it holistically. Okay, don't give only 70% medicine and say 30% I don't have powers, or it is outside our reach, outside our sanctioning limit, or you don't have collateral security. I mean, if there is inadequate collateral security, then don't give inadequate loan. Better don't give any loan. Okay, if collateral security is inadequate, please don't give inadequate loan. The only option is either give full or don't give anything. Okay, that will save both. Right. Now, so this is about the first method, that is turnover method. Now, to understand this, let me take you through a case study. Okay, this one already we have seen. Yeah, the second case study. Listen. You have the following information. You are given sales for 3 years, 2017, 18, 18, 19, and 19, 20. So the sales figures are 80 lakhs, 100 lakhs, and 130 lakhs. Estimated sales for 2021 is rupees 200 lakhs. Bank has a practice of finalizing the estimated turnover by selecting the lowest of, number 1, turnover estimated by customer, number 2, 25% growth over previous year, number 3, average growth over previous 3 years. Okay, now before I proceed further, let me just explain. See, in turnover method, what was our core understanding? Eligible bank finance is 20% of estimated turnover. So it's so simple. So just estimate the turnover, apply 20%, eligible bank finance is obtained, fatafat. But it cannot be that casual, no? Because bankers, they are basically the agents of public money. They have to exercise due diligence. And when it comes to finalizing the estimated turnover, they cannot have any arbitrary number over there. It should be a valid number, a validated number. So every bank will have their own policies on freezing or finalizing the estimated turnover. So I'm going to Here, see, here I have taken up a real case of a particular bank. So how this bank finalizes the estimated turnover? Number one, they will look at turnover given by the customer. Number two, they will apply 25% growth over the previous year. Number three, they will also apply average growth over previous 3 years figure on latest year turnover. And then they will arrive at one estimated turnover. Do not worry, you will understand. So only on this pattern, they are going to arrive at estimated turnover. Then what happens, you see. Here, this bank is not going to take a decision just by looking at estimated turnover. They're also insisting on collateral security. Look, you have to compute eligible cash credit limit if either of the following security is offered. So this borrower is having three different securities. One is land, two is self-occupied residential building, three is commercial building. The value of land is 50 lakhs, whereas value of building is lesser than that, 38 lakhs. And commercial building is even less than that, 35 lakhs. But this bank gives less weightage for land. I mean, they are ready to consider only 50% of the value of land as security value. So here we have as LTV, loan to value. They are going to apply 50% on this. It means 50 lakh into 50%, only that will be considered as value of land. Whereas if it is self-occupied residential building, they are ready to treat entire 100% of the building as value of security because of the sentimental factors attached to that property. Because if the borrower is self-occupied in that building, then if he is living with his family and all, then there will be a lot of sentimental forces attached to that, and his possibility of defaulting on that loan will be very, very remote. Okay, that's why bank is also factoring that and giving highest LTV percentage. Then commercial building, yes, bank is giving 90% value. Okay, now listen. The bank is going to sanction the limit like this. Limit is sanctioned as lower of turnover based limit, loan to value limit. See, already we have seen turnover. So on the turnover, 20%, then loan to value on this parameters, and whichever is lower, that will be the limit. Let's see how this works. So first we are going to estimate the turnover. Let's first capture the past 3 years sales. Year 1, 80 lakhs, year 2, 100 lakhs, and year 3, 130 lakhs. This is the information which I picked up from the case. Now we have to estimate the turnover. First, let's consider what is the estimated turnover, or what is the turnover estimated by the customer. The customer has estimated a turnover of 200 lakhs. In the previous year, it is only 130, but now he is estimating 200 lakhs. Okay. Number two, what we can do based on the bank policy, 25% growth can be applied over the previous year. What? 25% growth can be applied over previous year. What is previous year turnover? 130. 130 plus 130 into 25%. How much you get? 162.5. The third one is last 3 years turnover. You see what is the average growth. Let's see. We have to find out what is the average growth over previous year turnover. See, from 80 to 100, what is the growth rate? It is 25%. From 100 to 130, what is the growth rate? It is 30%. Now we have to take average of this. 25 plus 30 divided by 2. So we get like 27.5. Here it is rounded off as 28%. Now let's apply this on the latest year turnover. So 130 plus this 28%, it works out to 165.75. So now you see there are 3 turnovers. But what is the bank policy? Bank will select only whichever is lower. Okay, now tell me which figure we can select as estimated turnover. Please tell me which figure we can select as estimated turnover. Yeah, Krishnagiri is saying it is 162.5. Yeah, so all of you got it right. So it is 162.5, and here also you can see it is 162.5. Now, on this we have to apply 20%. So look, CC limit is 20% of estimated turnover. So it is 20% of 162.5, and that works out to 32.5. But this is not final, because this is the turnover, sorry, this is the limit on the basis of turnover, estimated turnover. Now we should also find out the limit on the basis of security. Let's do that now. Yeah, we'll analyze item by item. The first security what is having is land. But what is the LTV approved by the bank? LTV percentage, it is 50%. So the loan to value amount will be 15 to 50%. It becomes 25. But what is the limit based on turnover we have arrived at? It is 32.5. Okay, now tell me what is the eligible limit. If this borrower is going to offer land, what is the limit he will be eligible for? Is it 25 or 32.5? 25 or 32.5? It is only 25. Okay. See, it's possible that some of you will come across situation like this. Based on the turnover, you would have arrived at the eligible limit is 32.5. But based on the collateral, you will give them only 25. But now the question is, who will fund the remaining 7.5? Because based on his requirement, it is 32.5. What you are giving is 25. So who will fund the remaining 7.5? Who should fund the remaining 7.5? Owners. But as a banker, when you sanction in this kind of a stage, you got to double ensure that owners are going to fund this, and you have to double ensure whether owners are capable of funding this. See, if owners are not capable of funding this remaining 7.5, then this is the warning bell I gave you some time back, a few minutes back. Don't do under financing. Because here what they deserve is 32.5, but because your policy permits only 25, you are giving 25. Never ever do that mistake. I mean, if owner is capable of managing that remaining 7.5 from either his own source, or if he can arrange it from some other source, then go and do that. Otherwise, in my opinion, the eligible limit in this case is nil. How many of you agree with me? Just type with you. So this is the key learning. Okay, so never ever sanction. See, especially working capital. If you're going for mortgage loan and all, that's fine. But working capital is like giving him oxygen for breathing, for performing his normal activity. Okay. So if you are, just imagine like he needs a cylinder of oxygen, and you're going to give him only 3/4 of it. But he needs a full cylinder. You're going to give him only 3/4, and without even ensuring that whether he's going to get that 1/4 from some other source or not. If you're going to give, then both of you will suffer. Okay, this is the point I want to drive home today. Rishabh is asking how banker will confirm that promoter will be able to arrange. That's something which you get to know only by having a detailed discussion. Okay, you should understand what is his potential, from where he can arrange the funds. He should demonstrate that yes, he has the capability, or he has identified some other sources. The money is going to come in, and you should also cross-check, verify. Okay, so unless and until you could do this, don't sanction. Okay, I don't want you to become so pessimistic, but I want all of you to become more realistic. Okay, pessimism means, I mean, if you take this to your head, then you will say no to all loan proposals. I want you to be realistic. Okay, understand what they need. Okay, just always see, whenever you give working capital credit facility for a customer, imagine you are giving them a cylinder of oxygen. Cylinder of oxygen means it should be a full cylinder of oxygen. Even if you are going to give 3/4 of it, or 50% or 70%, 80%, that small gap will also create so much of trouble. Okay, are you deriving value from the session? Just type IDV. Just type IDV if you are deriving value. Because are you learning something sensible? That's the point. Thank you. Okay, so that's about land. That's about land. Let's say he's going to offer self-occupied residential building. Then what is the value? 38%. Bank is also ready to consider it at 100% LTV. So loan to value is 38 lakhs. But what is the limit based on turnover? It is 32.5. It is 32.5. Now tell me, what is the eligible limit? Is it 38 or 32.5? Okay, here you have to be extra cautious. See, based on security, he is eligible for 38. But based on turnover, he is eligible for 32.5. So how much you should give? Bank policy is whichever is lower, I agree. Bank policy is whichever is lower. But given a chance, how much you will sanction for this customer? Forget about bank policy for the time being. Forget about bank policy for the time being. Given a chance, how much you will lend for this customer? Pandu is saying 38. Ratan is saying 26. He even reduced further. Now, I want all of you to introspect and give your answer, genuine answer, given a chance, because you are getting a posh residential building, 38 lakhs is the worth, and based on LTV, he is eligible for 38 lakh. Of course, the turnover based method is saying he is eligible only for 32.5, but LTV is 38, and I will not get a better collateral from anywhere. So given a chance, how much you will lend to this customer? That was my question. And Sandeep is saying average between 32 and 38. Nageshwar Rao 32.5. Sami is also 32.5. Rishabh is also 32.5. I've seen someone saying 38. Who was that? I missed it. Yeah, Pandu. Pandu was saying it is, he will give 38. And Abhishek is asking how LTV is determined. It's based on bank's policy. Yeah. It depends upon the risk perception. Okay. So I asked this question, given a chance, forget about loan policy, given a chance, he is giving a security worth 38 lakh, and on the basis of turnover, he is eligible for 32.5. I asked you how much you will lend, and I'm glad that almost all of you said it is 32.5. Yes. Under financing will put business in trouble. That is, when they deserve 32.5, and if you're going to give them only 25, it will put that business in trouble. But excess financing will put that business in serious, irreparable trouble. Are you all with me? Under financing will put that business in a trouble. I agree. All of you will agree. But excess financing, it may sound a little strange, but excess financing will put that business into serious, unrepairable trouble. Because excess financing, in this case, how much they are eligible for? 32.5. And if the bank is going to lend based on LTV, the bank will give how much? 38. It means there is a difference of 5.5. So that's an excess fund. And this excess financing, I am saying that it will put business into even more serious trouble than under financing, because when the promoters are given excess money without any purpose, that's where their brain starts playing monkey games. They are having excess funds without any purpose. When funds are going to land in balance sheet without any purpose, then it will go and sit in unnecessary places. So this fund will get easily diverted for non-productive activities. It will easily go out of the business in the form of loans and advances to sister concerns, or it will easily go out of the business in the form of investments, right? So when there is going to be excess financing, that will put that business in even more serious trouble. So never ever resort into excess financing. So as most of you said, it is only 32.5. The third option is collateral. Sorry, the third option is commercial building, which is 35 lakhs. And LTV percentage is 90%. So LTV is 35 into 90%, 31.5. Whereas limit based on turnover is 32.5. So what will be the eligible limit? Here the eligible limit will be only 31.5, whichever is lower by applying the bank policy. Of course, here bank has to ensure that this borrower is managing the difference of 1 lakh. Okay. Now tell me, if the borrower wants to get optimum credit facility, I'm not saying excess and all, optimum credit facility, which security he should offer? Is it land or SORB or commercial building, CB? It is SORB, okay? Self-occupied residential building. In that case, he will get 32.5, which is the limit based on turnover, and that only would meet their exact requirement. Okay, right. So this is the assessment, a typical case under Naik committee, that is turnover method, Now, I will take you through the second method where we compute the maximum permissible bank finance. See, as far as sorry for the interruption. Our scheduled lunch time is 1:30. We are running with a delay of 10 minutes. Shall I continue so that I can finish off this? This will run exactly for next 10 minutes. Okay. It's 1 hour 5 minutes presentation. We are 55 minutes done. Just give me 10 minutes time so that we can finish off this. Instead of 1:30, we'll have our lunch by 1:40. And if any senior members are present here, please, I request you to go and have your lunch. Others, I request your additional 10 minutes time. Yeah. Questions? Yeah, I've just seen Rishabh question. See, all questions I request you to put in a Telegram group, okay? Because I have a lot to cover here. So all your queries will be answered in Telegram group, okay? Yeah. And this said also in YouTube also, I'll just mention that. So this is our Telegram group. So if you have any queries related to the presentation, please put that in Telegram group. Okay. Yeah. Yeah, we'll continue now. The second method is stand-in committee. This is, see, under this method only we compute this maximum permissible bank finance. In Naik committee, what was our understanding? The working capital cycle is assumed as 90 days. Stand-in committee says don't make an assumption. You see what is their actual working capital cycle and assess based on their level of operations and activity. And this method comes into picture whenever the limit is greater than 5 crore. But I request you to check with latest policies, procedures now and then, because it's possible that these figures can undergo a change over a period of time. Okay. So stand-in committee method says, do not assume the cycle as 90 days. You see what is their actual cycle, then arrive at the limit. Okay. So there are basically 3 methods prescribed under stand-in committee method, in which we'll ignore the third method because it is not in practice. It was not approved, first of all. So there are 2 methods. Still, there are banks which compute under both the methods, and whichever is convenient, they sanction. Actually, whichever is lower, they sanction that. Okay, let's see. So there are 3 methods. We are not going to talk about the third method. See, under first method, how working capital bank finance is assessed. Let's see. Let's say the business creates some current assets. It is funded by other current liabilities, and there is a gap. That gap should be funded by the borrower, and that gap can be funded, the balance portion can be funded by the bank. So look at the focus. Stand-in committee says only the balance, residual, should be funded by the banker. How? Let the current assets be funded by other current liability. Even after their funding, there will be some gap. let that gap be funded by promoters by bringing some margin, and residual, if any, should be funded by the banker. Okay, now look at this. So I said there is a gap. I said there is a gap. Now this gap, how promoters should fund? How much of the gap should be funded by the promoters? So that is prescribed under method 1. Method says 25% of the gap, whatever the gap, 25% of it should be funded by the promoters. It means balance can be funded by bank finance, cash credit. That is method 1. It is very liberal method, I would say, because in this method, if you follow this method exactly and if you calculate current ratio, it will be very low. It means it is beneficial for the borrower, but from the banker point of view, it is slightly risky proposition. Whereas in second method, the argument is when you create a current asset, okay, fund some portion with other current liability. There is a gap, agreed. How the gap should be funded, that's where the second method differs from the first method. In second method, the gap funding, working capital gap funding is like this. 25% of the current asset should be brought in by the promoters as margin to fund the gap, and only the balance can be funded by the bankers. I repeat once again, current asset, some portion can be funded by other current liability, there is going to be a gap. This gap got to be funded by promoters. How much? 25% of the current asset should be brought in by the promoters to fund the gap, and there will be something left over. Only that portion can be funded by the bankers. Only that portion can be funded by the bankers. How to understand? Let's have a look at this case. Here, let's ignore this core current asset because it's outside our discussion now. So you are given current assets 100 lakhs, and I'll call this as other current liability, OCL 40 lakhs. We have to compute the maximum permissible bank finance under all the 3 methods. No, we are going to do only under 2 methods. So how it will be? Okay, let me just list and I'll explain item by item. Now, what is the current asset? It is 100 lakhs. Okay. What is the other current liability which we discussed, or it is given in the case? What is the other current liabilities? It is 40 lakhs. It means for creating 100 lakh worth of current asset, 40 lakh support or 40 lakh funding has come from other current liability. It means there is a working capital gap of 60 lakhs. Let us also ignore this core current assets now. So there is a gap of 60 lakhs. Now, how this gap should be funded? 25% of the gap should be funded by promoters. So 60 into 25%, that works out to 15 lakhs. That should be funded by the promoters. So there is a gap of 60. Promoters are funding 15. 60 minus 15, what do you get? 45. So this is maximum permissible bank finance under the first method. I would say this is very liberal one, because here the funding is much higher. Because if you look at this, other current liability is 40. This bank finance is also current liability. So if you total these two, 40 plus 45, you get total current liability as 85. Whereas total current asset is 100. 100 divided by 85 will give you current ratio. 100 divided by 85, you will get current ratio as 1.18. Current ratio is very low here, because whoever got exposure to banking, they will say minimum current ratio is 1.33, whereas here it is only 1.18. Okay. Then what second method says? Let's see. In second method also, current asset is same 100, other current liability is 40. There is a gap of 60. This is working capital gap. Now the question is, how this working capital gap should be funded? As per second method, promoters should bring in 25% of, not working capital gap, of current asset. So this is current asset, 100 into 25%. So that should be the margin contribution by the promoters. So 100 into 25% gives you that 25. This is the margin. So 60 minus 25, what do you get? 35. So eligible bank finance is only 35, because the gap is 60, but here the promoters are mandated or pressurized to bring in 25, whereas here they are pressurized to bring only 15, whereas here the pressure is more, they're asked to bring more 25. So as a result, bank finance has come down in second method. So comparatively, the second method is conservative. Now let us calculate current ratio. You are going to have one key learning now. Okay. What is the current ratio? Current asset by current liability. What is your current asset? It is 100. What is your current liability? It is other current liability plus bank finance. It is 40 plus 35, 75. 100 divided by 75. What is the current ratio now? It is 1.33. And what 1.33 communicates? When the current ratio is 1.33, it means there is a 25% contribution by the promoters for creating the current asset. There is a 25% contribution by the promoters through long-term funds for creation of current asset, and this is the reason most of the banks insist a minimum current ratio of 1.33. And that's the reason we say this method is slightly conservative, because when current ratio is 1.33, how much the banker is giving for the same level of current asset? They are giving only 35, whereas here for the same level of current asset they gave 45. But second method has been in practice, it's widely used, and what the borrower is eligible for is only 35. And this also enables the banks to ensure achievement of minimum current ratio of 1.33. So how many of you got this logic? Why banks are insisting on minimum current ratio of 1.33? It's because of this. Because when the current ratio is 1.33, what is the message? The message is there is a 25% contribution of long-term funds by the promoters for build-up of current asset, and that ensures compliance with the tandem committee method as well. Okay, so how many of you are finding this useful? If it is useful, just type useful. If this is useful, type useful, or if you're deriving value, yeah, thank you, Ankur. If you're deriving value, type IDV. Thank you, Roshnisha. So thank you very much. I could see many of you are deriving value in the session. The hijacked Sunday, I took away your family time, but I want to ensure you are getting value. Okay, tomorrow there should be a sea change in the way you look at things related to topics we are discussing today. So thank you. I could see many of you are deriving value. And before we break for lunch, okay, it's going to be 1 hour break. I request you, I request you, if you are determined to learn, okay, if you're determined to learn, please do come back by 2:30. This link will be on, the video will be on. Okay, I'm not disabling the link. It will be on. I'll be playing some MCQs, some multiple choice questions I'll be playing for this entire 1 hour. Okay, so when you are done with, you can go through the MCQs, put your answers, comment your answers. Okay, in that way you can learn even in this break when you're done with the lunch. But you have spent half the day, we have almost equivalent part. So just type determined to learn, determined to learn. It means you are confirming me that you will join back by 2:30 p.m. or simply type DTL. DTL, yeah, thank you. DTL stands for determined to learn. Okay, and by what time we can join back? It's 2:30 p.m. Okay, instead of 1 hour break, I'll make it as 50 minutes break. Okay, we'll join by 2:30 p.m. So type 2:30, type 2:30 so that it gets registered. Number two. Number three, it's a request. It's a request. If you have derived value, can you just share about this workshop in your social media with the hashtag CRaja classes? Let it be LinkedIn or let it be social media, whatever. You can just say that you are attending this workshop, and if you're deriving value, mention that and give the link of this workshop, because even in the post lunch session we have many new things to learn. So even if someone has not attended the first part, they can attend the second one. So for that purpose, I'll give the link once again. Basically, this webinar link, I'm posting that here. So what you can do, just go to your social media, let it be Facebook or Insta or LinkedIn. Just say you are attending this marathon workshop and you find this useful, so that your friends, colleagues can join. If possible, invite them to join as well. That's my humble request, because we are not so-called big MNCs to aggressively spend on marketing. I've grown only by word of mouth support or referrals by existing students. Okay, just do me this favor, so that in the second half many can join. Okay, so we'll catch up by 2:30 p.m. Bye bye. So I'm back. It's exactly 2:30 p.m. Yes, Sudhir, are you facing difficulty? Let me check. Okay, I received your message in WhatsApp. I'll share that link. So please check your Telegram. Okay, now the time is 2:31. Shall we start? Type start. And whoever had heavy meals, please have your notepad alongside. You will have a lot many things to note now. Okay, have your notepad alongside. Yeah. Next, we are getting into letter of credit and bank guarantee. So we are continuing our discussion in working capital.
Let's understand what and why of non-fund based credit. Non-fund based credit is an important business segment of banks because here they are not going to commit any immediate outlay. Instead, they are going to give only promise in favor of a third party for a monetary compensation, say on behalf of a client, and only when a certain situation emerges or if certain conditions are fulfilled. It's very important business segment because it's going to bring in huge revenue for the banking system without any immediate outlay of money. So that's the a very critical part of non-fund based credit, and these non-fund based credits are basically given by the banks in the form of letter of credit and bank guarantees.
Yeah, a small question. Any issues in the video or audio? Are you facing any issue? Sorry. Whether audio and video, is it okay? Just type AVC. Okay.
So in both the products, the banks are going to act as an intermediary, say between the buyer and seller, or between the provider and recipient of service, or say between the contractor and contractee. Here, what is the benefit for the customer? Why customer should go for non-fund based credit? If he's going for non-fund based credit, for him also there is no borrowing of funds. He's not borrowing money, so there is no physical flow of money, number one. Since there is no borrowing of money, there is no big cost on interest. Okay. The very critical point is he is not borrowing physical money, number one. Number two, he is not going to pay interest on that. So this is going to help him in managing his balance sheet, because without disturbing the liability of the business position or financial position, he can get something done. And number two, since he is not going to pay interest, it's not going to have big impact on the profits. He's going to only pay some commission or charges, and it's going to be very small when compared with the interest. So that's the benefit for the customer. And when it comes to bankers, yes, it's a big business, because they are just going to give a promise and they are going to get substantial fee-based income, which is going to be the next best to interest, and they are going to raise only a small portion of funds for meeting these non-fund based credit facilities, that too basically to ensure some compliance with the statutory requirements. So as far as the banker is concerned, for them it's very low cost of funds that have to be set aside for these non-fund based facilities like LCBG, and they're going to get good income, fee based income, that's going to be the next best to interest. But of course these non-fund based credit facilities comes with a risk in the event of default. So when the default is going to happen, here the bank is basically giving a promise in favor of its or say on behalf of its customer to a beneficiary, right? So if that customer does not fulfill his promise, then that would result in default. Then bank would be asked to compensate that monetary loss. That means in the event of default, say from customer side, then bank's non-fund based facility would crystallize into fund based facility. So that is the risk which banks have in non-fund based credit facilities.
Let us understand what is letter of credit. Let's look at this transaction. There is a seller and a buyer. Seller selling goods to buyer, and buyer is making payment to seller immediately, and there is no complication in this transaction. We can say it's a normal transaction. But just think of a transaction where the buyer and seller are in different geographies, or say in different countries, and they do not know much about each other. But this buyer wants to purchase goods on credit, and seller is also ready to sell on credit, but seller does not know this buyer thoroughly, and because of that he lacks faith. And here the seller says to the buyer, if you can give me some kind of a comfort or security, I'm ready to sell goods on credit. So what this buyer will do, he will approach his bank where he is having his working capital facilities, and he'll explain the situation that there is a seller who is ready to sell goods on credit, but he needs some kind of a comfort. So what this bank will do, after assessing the position of the buyer, that is bank's customer, this bank will send a letter called letter of credit, and in that letter bank will say, hey seller, you can sell goods on credit to this buyer who is our customer. And hereby saying this, bank is indirectly assuring the financial standing of the buyer, and then bank also gives assurance that buyer will make payment on the due date. And in case if the buyer is not making the payment on the due date, then do not worry, you come and ask us, we will pay you provided you guys have agreed on all the conditions. That is, you guys agree on conditions and comply with the conditions. Let's say for buying goods, buyer will place certain conditions, and only when seller comply with all the conditions, as a banker we will honor it. Okay, so that will be mentioned in the letter of credit by the buyer's bank to the seller's bank. Now seller has got a big comfort because there is an assurance, that too from the bank, that buyer will make payment on the due date, and even if buyer does not pay any money, okay, he is going to get that money from the bank provided that seller is complying with all the conditions that are mentioned in the letter of credit. Okay, so on the strength of this letter of credit, seller is going to sell goods to the buyer on credit basis, and it is the duty of the buyer to make payment on the due date to the seller. But what will happen if buyer does not pay on the due date? Simple. Seller will ask the bank to make payment which has issued letter of credit, and this scenario will be called as devolvement of LC. If all conditions stipulated in the letter of credit are complied by the seller, then the bank which had issued LC has no room to escape. They have to make payment to the seller. Of course, eventually they can collect it from the buyer, but they got to meet the payment to the seller. So this mechanism is nothing but LC mechanism, and it promotes trade. It helps various transactions to take place. Okay, so this is about LC. And who are the parties generally involved in LC? Number one, the buyer, we call him as applicant. Two, seller, we call him as beneficiary. And number three is the bank of the buyer, that is LC issuing bank. Okay, we call it as LC issuing bank. And the LC will not be dispatched simply through post. It will be routed through another bank in seller place. We call that bank as advising bank. And sometimes seller may be in a dominating position, or seller may not believe the LC issued by the issuing bank of the buyer. Seller may stipulate a condition saying that LC got to be confirmed by bank in his location. So another bank may also come into picture. We call that bank as a confirming bank, and it's through these banks the entire LC process revolves.
Let's have a look at the types of letter of credit. Now, types of letter of credit would basically depend upon the method of payment, whether the LC is revocable or not, whether any middleman is involved or not, or whether any other transactions is involved or not. Okay, so it depends upon all this. Now, the basic classifications what we can have is number one, irrevocable LC. It does not mean we are going to have a revocable LC. That concept was removed way back in 2007. It means now all LCs that are opened are irrevocable in nature. It means you cannot, you can neither amend nor cancel the LC without the express agreement of all parties to the LC. So that's what we mean by irrevocable LC. It means when we say all parties, the applicant, issuing bank, beneficiary, all three minimum should agree. Then we can also have two or three other classifications or types of LC. One, we have site LC. Site LC is a case where the supplier is not giving, the seller is not giving any credit to the buyer. It means the buyer is opening LC in favor of seller just to get his confidence, so that he can send the goods, because the goods have to travel a longer distance, and the seller has a fear whether the buyer would pay or not, say without credit itself, because there is going to be a transit period and whether he will pay or not, so there is a fear. So seller has insisted on LC and buyer had opened LC in favor of seller, and that is a site LC. So in site LC, what is going to happen? The buyer's bank would open the LC, and by the time it reaches, that is by the time it is cited to the bank, the payment has to be made. Okay, it means if the seller is going to show the documents which are prescribed in letter of credit which is opened by the buyer in favor of the seller, and if the seller is going to show all the documents, say like invoice, say the transit documents, shipment documents, and insurance, whatever that is stipulated, and if everything is shown, then payment at site should happen. So here the payment is happening on or upon presentation of documents. Even though we say site, it would take minimum say 7 days, or it sometimes it goes like 7 plus 7 plus 7, 21 days. Okay, so that's about site LC. Then there is something known as usance LC, where the seller is permitting a certain credit period to the buyer. So here the buyer would open the LC, it would reach the seller would showcase the documents, okay, and the payment for the seller would happen only after the usance period plus these say that minimum grace period, or that 7 plus 7 plus 7 days. Okay, so credit period is offered by the seller, payment is going to happen on a prefixed date. Then we also have two other kind of LCs, inland LCs and foreign LCs. That's based on the geography. The LCs which are issued within the country we call as inland, and LC that are used in import-export transaction we call them as foreign LC. Let's look at some of the other general aspects related to LC. Now, for what purpose LC is sanctioned? LC is basically sanctioned for purchase of raw materials, because suppliers are going to sell raw materials, they are going to insist on some kind of guarantee from bank. So that's how LC is coming to picture. But LC is also issued for purchase of capital expenditure items. We say capex items. Let's say The buyer is purchasing a plant and machinery from abroad or say within the country, and the seller is ready to sell the goods only when the buyer presents the LC. It means there is a guarantee purpose also. LC has been done. Then what is the maximum credit period that can be covered under LC? Now, as per the regulations in India, it can go up to 360 days. Then what do we mean by CapEx LC? They are LCs that are issued for acquiring capital assets, say plant and machinery, and these are generally sanctioned as a sublimit of term loan, because when the companies purchase plant and machinery, they would generally go for a term loan, and this LC for purchase of machinery would generally be sanctioned as a sublimit of term loan. Then this LC can be sanctioned as a sublimit of CC, that is cash credit, or it can also be sanctioned as a separate limit. And what are the primary securities for LC? Basically, the assets that are acquired through LC, it can be the goods that are procured under LC, or say the capex items that were purchased. And what about the collateral securities? Yes, the banks would insist on collateral security. First, whatever the security that was stipulated for, say, cash credit or overdraft or term loan along with the LTV norms, then the banks would also insist on cash margin to be maintained for LC. Let's say, for example, the company approaches the bank for opening a 10 million LC, then bank would say the customer should maintain 10% cash margin as a deposit. It means bank would give 10 million LC, but 10%, that is say 1 million worth of deposit have to be maintained with the bank, and other collateral securities can be something what is as stipulated for cash credit and overdraft. Let's move on to assessment of letter of credit limit. We know letter of credit is a facility which is given by the bank to enable its customer to buy goods on credit from his supplier. That is, bank will be issuing letter of credit in favor of supplier, so that supplier will sell goods on credit to bank's customer. So how this facility is assessed? It is purely linked with purchases. So first let's capture what will be annual purchases. Annual purchases. But not all purchases will be made on credit. There will be some cash payment, there will be some advance payment, there will be some purchases on credit without LC also. Okay, so we should know how much purchases are expected to be made under LC. So we'll say procurement under LC. There is going to be a certain amount. Say for example, if annual purchases is 120 crore, and let's say the procurement under LC is expected to be only around, say, like 40 crore. Okay, only 40 crore worth of goods are going to be procured under LC. Fine. Then we should know what is the monthly purchase. Monthly purchase of what? Monthly purchase of LC goods. Okay, which is nothing but item number B divided by 12. So let me put that here. Item number B divided by 12, we get something like 3.33. Okay, so this is the monthly purchase of goods under LC. I'll rewrite monthly purchase of goods under LC. Fine. Now we should also factor the credit period, because this is on credit, right? LC is issued so that he can, the customer can buy goods on credit. So what is the period involved in this? That is, we should capture total time involved here. Total time. Total time in the sense, two time factors are there. One is usance time period and the other one is lead time period. Usance time period is a credit period given by the supplier to the customer. Lead time period is a time taken by the supplier to execute the order. Let's say the bank's customer has placed order with supplier, and supplier is going to take 21 days for executing that order. So that's the lead time period. And usance time period is a credit period which he gives. Let's say for example, lead time period, that is, if a customer makes an order today, the supplier will take 15 days to manufacture those goods, and supplier is also giving 45 days credit. So if I order goods today, it will take 15 days for manufacturing, and from there 45 days count will start. So if I order today, payment will happen only on the 60th day. So we can say total time taken is 45 plus 15, 60 days. That is equivalent to 2 months, right? This is 60 days, which I'm going to say as 2 months. I'm going to say this as 2 months, right? So what is the monthly purchase of goods under LC? It is 3.33 crore. Okay, and I should give LC for 2 months requirement. So my monthly purchase is 3.33. Then for 2 months it will be 3.33 multiplied by 2. So I can say item E, eligible LC limit is nothing but item number C multiplied by D, which is 3.33 crore per month multiplied by 2 months. So this is the eligible LC limit, and this is how LC limits are assessed.
In this session, let us understand what is bank guarantee, its meaning, purpose and nature. First, let's get into the meaning of guarantee. Guarantee is basically a contract to perform the promise and to discharge the liability of a third person in case of a default. And this is what we have in section 126 of Indian Contract Act 1872. So, guarantee is basically a contract where you are going to perform the promise because you have made a promise that if third party is not going to perform, then you would perform. Okay, so it's basically a contract to perform and discharge the liability of a third person in case of a default. So who are the parties involved in bank guarantee? Basically there are three parties. One is applicant, two is beneficiary and three is guarantor. Applicant will be bank's customer. Beneficiary is the person in whose favor bank guarantee has been created, or say the guarantee is given, and guarantor is generally banker. Now let us also understand the nature of this contract, that is guarantee. Whether this contract for guarantee is a primary contract, answer is no. The nature of guarantees are collateral. It means they are consequential to the main contract between the applicant and beneficiary. It means there will be a contract between applicant and beneficiary, say for some exchange of goods or for rendering of services or for some fulfillment of promises. And if that contract is not executed, then this guarantee contract comes into picture. That's why we say guarantee is collateral in nature. Now let's say bank is going to give guarantee in favor of a beneficiary on request by applicant. What is the risk bank has with regard to guarantee? See, risk arises in the event of default by applicant. That is, applicant is supposed to perform some promise or make some action and he is not doing that. Then if the default is brought to the notice by beneficiary, then the guarantor should perform the promise. But if the guarantee is given by the bank, then bank will not perform the promise. Rather, bank will compensate the loss that was suffered by beneficiary on account of non-performance or non-fulfillment of promise. And this compensation by the banker will be restricted to originally guaranteed amount. So understand, very, very important. Okay, in the event of default by applicant, the default has to be brought to the notice by beneficiary to the guarantor, and guarantor is only going to compensate the loss. Okay, it's not that guarantor is going to perform the promise here when bank is a guarantor. Understand that. Okay, also understand, when beneficiary makes claim to the guarantor, that scenario we call as invocation of guarantee.
In this session, let us understand the types of bank guarantee. But before that, let's see what are the circumstances or situations in which bank guarantee would be given or it would be requested. Okay, generally in case of tenders or auctions. Understand, in case of tenders or auction, there would be various bidders. So those agencies, that is whoever going for tender or auction, will not have time to understand the financial capacity of all the persons who are participating in the tender. So they would ask them to say park a minimum stipulated amount with them as security deposit or earnest money deposit. Now instead of locking that money with them, those participants in tenders or auction would approach their bank to issue a guarantee. That is a guarantee instead of security deposits or EMDs. Now this guarantee would be given to those agencies who are conducting the tenders or auction, and they are relieved of the worry whether these people have financial strength or not, because that is now analyzed by the bank and bank has given the guarantee. Okay, so in those situations bank guarantees are used. And let's say there is a big construction contract, and if you want to start the contract, let's say you are the contractor, and if you want to start the contract, you need some kind of advance from the contractee, not only in the beginning but also in various stages. But the person who awarded this construction contract will have a fear whether you would complete the work for the advance you have received. Okay, so this is going to happen mainly in case of construction contracts, where in various stages advances have to be mobilized from the say awardee, and to give him a sense of comfort that this contract would be performed for the advance that has been received, the banks would give security against those advances. It means the bank would give first the guarantee for mobilization advance. The awardee will get that mobilization advance guarantee, then he would give the mobilization advance to the construction contractor. And if construction contractor is not going to perform the work as promised, then that guarantee would be invoked. Okay, so these are all the situations, very common situations in which bank guarantee can be used. Now let's focus on the types of bank guarantee. The bank guarantee is basically divided into two. One is based on the nature, that is financial guarantee and performance guarantee. The other one is performance guarantee. So in financial guarantee, the bank is basically certifying the financial ability or worth of the customer to meet the financial obligations, or saying that he will certainly make the payments whenever it arises, or the dues whenever it arises. One of the classic example for financial guarantee is guarantees which are issued in lieu of security deposit or EMDs. So these guarantees are basically say guaranteeing the financial ability or worth of the customer. Okay, then we have the second type of guarantee within the nature, that is performance guarantee. Now these are all the guarantees which are given by the bank to the beneficiary, saying that bank would make good the monetary loss if the applicant is not going to perform as promised. So this guarantee, bank have to be very careful, because if the bank is giving this guarantee, they should have first understood or assessed the technical competency of the client. Number two, they should have understood the managerial ability and vocational experience of the promoters or management. Okay, so this guarantee, I mean, whenever the bank is say forced to pay the loss suffered by the beneficiary, or say whenever this guarantee is invoked and bank is forced to make the payment, it's basically the penalty for non-performance for the client or non-performance of the client. Okay, so performance guarantee would force the bank to pay penalty basically for non-performance of the client. Of course the bank can get this money back from the customer, but this is very serious in nature. So bank should ensure that there is adequate security for performance guarantees, number one, and number two, there should be no clause in the guarantee beyond compensation of loss in monetary terms. Here the need for invocation arises when the customer does not perform. So when he does not perform, then bank should not be forced to perform. Okay, bank should only compensate the monetary loss, so there should be no clause beyond compensation of loss in monetary terms.
Let us understand what is bid bond guarantee. If you are a contractor, you will be getting most of the business by participating in tender. If you are bidding against the particular tender, then you may have to submit a deposit. We call it as earnest money deposit. Instead of that deposit, you can also submit a bank guarantee, and that bank guarantee is called as bid bond guarantee, and they will be generally up to 5% of value of contract for which tenders have been invited. And if you look at the expiry date, it will be fixed and it will generally match with the date on which bidding process is expected to be completed and the date on which contract will be signed with successful bidder. Okay, right. So once this bidding process is completed, the bonds will be returned to unsuccessful bidder and successful bidder will be called to sign the contract. In case if successful bidder is not signing the contract, then the organization which has called for the tender will invoke this bid bond. Okay, so we can say bid bond is more of performance guarantee, and here the assessment is focused on capability of the contractor to take up the contract which he is bidding. Okay, and in general bidder will win a contract only after bidding many tenders. So it is possible that the number of bid bonds and amount involved in those bids will be beyond the capacity of the contractor if he is going to win all. Okay, so it's okay sometimes despite winning, if he is not taking the contract, it's normal and it's not a worrisome situation. In this session, let us understand what are maintenance bonds or maintenance guarantee. If a contractor has completed his job successfully, let's say to the satisfaction of the employer, then automatically all guarantees should come to an end. But certain employers would try to act safe because they do not want any fault or mistakes to crop up after work completion, and they do not want to suffer any loss. So what they'll do is they will insist on a guarantee for maintenance period. That would be basically the period after completion of the project, and generally it would go up to 1 year. This guarantee would give them protection against faults which are discovered after project completion. When these faults are identified, the employer will call the contractor to rectify, and if the contractor is not going to rectify it, they can invoke the bond, get the money from the bank and get it done by someone else. Okay, so this maintenance bond is generally given for 1 year period, and maximum it will be like 5% of value of the contract. In this session, let us understand what is retention money guarantee. In banking, you will come across customers who are undertaking construction contracts. While these contractors receive payment from their employers, certain percentage of the payment will be retained, and generally it will be like up to 10% of each and every payment. That retained portion is called as retention money. But the problem with retention money is that this is going to affect the cash flows or liquidity of the contractor. So what's the solution? Whether employer will compromise retention money? Answer is no. Employer will not compromise retention money, because once the contract is completed and if defect is identified, then that defect will be either adjusted against the retention money, or contractor have to rectify the defect to get back the retention money. Okay, so that's the very objective of retaining portion of payment. So they are not going to agree. So what's the alternative option? In most of the cases, employer will accept guarantee instead of retention money, and this will be equal to retention money in general. This guarantee will ease the liquidity in business, and when this retention money guarantee will expire, it will expire when the project is completed, that too to the satisfaction of the employer. But of course, later on this retention money guarantee will be substituted with maintenance bond or maintenance guarantee for some more period. That is, after completion of project, generally it goes up to 1 year for maintenance period. In banking, you will come across customers who are taking up big projects, turnkey projects, construction projects, mega export projects, that too all involving high cash volume. These customers will be requiring advance payment from their buyers to execute the contract. That's basically for purchasing materials, paying laborers, and so on. And for this, they also would have entered into an agreement with the buyer. But buyer will be making this payment only after the seller provides him some kind of a guarantee. Okay, that's where this advance payment guarantee comes into picture. If seller is not going to deliver the product or render the service after collecting advance, then the buyer can invoke that advance payment guarantee and get back that advance money whatever he paid from the bank. Okay, so whenever advance payment guarantee is issued, it is very important that it is tracked very correctly, because if invocation arises, its consequence will be worse then default in fund-based facilities. Okay, so how it can be tracked? Probably you can insist on a cash budget. By having a look at the cash budget, you get an idea how this advance payment is going to be utilized and what will be the impact if the need for repayment of advance payment arises because of invocation.
In this session, let us understand about the appraisal and assessment of bank guarantee limits. Whenever the bank guarantee limits are appraised, the credit officer or say the credit analyst should see for what purpose this bank guarantee is being sought for. Okay, because there are various purposes and according to the purpose, the appraisal or the approach of the banker should vary. Because if it is going to be the bid bond guarantee or say it's a security deposit, I mean guarantee against security deposit or EMDs, then the banker should get the details of all those say tenders where this customer is going to participate, and they should get the idea about the value of tender, then what is the percentage for which this guarantee is required. Instead, if it is going to be an advance payment guarantee, then they should get the details about the contract that has been awarded. Okay, then the advance payment terms and the reference where the bank guarantee is insisted, and how much guarantee has already been taken, that is guarantee taken and advance availed, and whether the work has been done with reference to advance that has been received. Okay, all those got to be checked. Number two, the frequency. At what frequency these guarantees are required? Okay, is it at very short frequency or is it of one-off kind of guarantees? So that will give an idea about the way in which the transactions are being structured, the guarantees are being taken. Okay. Number three, the bank should have a clear idea as to the nature of guarantee, whether it is financial guarantee or performance guarantee. In case of financial guarantee, they are guaranteeing the financial stability or financial worth of the customer. Whereas in case of performance guarantee, the banker is guaranteeing the loss that is going to uh, suffered by beneficiary due to non-performance. Okay, so this clarity is required. Number four, the past performance of the guarantee should be checked into, because in the past, if the particular customer had taken various guarantees and many of them were not performed or they were invoked because of non-fulfillment of promise, then banker have to take extra caution in sanctioning those bank guarantees. Then outstanding BGs, outstanding bank guarantees have to be looked into so that the banker will get an idea, because many of those guarantees might get matured during the year. So banker need not sanction very high limit. Say for example, the outstanding bank guarantee is 10 million and the guarantee request placed by the client for next 1 year is 20 million. So outstanding is 10, guarantee required request placed is 20 million, but of this outstanding, let's say at least some 7 million is maturing during the current year, then the total requirement of the client or the customer who said 20 million, okay, of that 20 million, the 7 million can be made from the existing limits itself, right? Because already the client has a limit of 10 million, and of the 10, 7 is getting mature during the current year. It means only the remaining 13 got to be sanctioned. Okay, so accordingly, the limits have to be worked out. Then the margin, which is the very critical element, if the credibility of the client is, say, customer is very strong, then bank can relax on margin, but otherwise they have to insist on cash margins. Let's say the requirement of bank guarantee is 10 million, then bank would generally stipulate a margin of say 10 to 15% to be maintained as deposit with the bank. Okay, now this margin would become higher or lower, or sometimes it would even become nil depending upon the credibility of the customer. Collateral security. Collateral securities would be required especially in cases where performance guarantees are given. Okay, but collateral security would almost get packaged along with the cash credit or OD when it is sanctioned. Then counter guarantee. Yes, this counter guarantee is very much essential because the bank guarantee is basically a collateral guarantee which comes into picture only when the bank's customer fails to perform. So the bank is going to compensate the loss, but the bank should be recompensated, right? Bank is compensating the loss suffered by the beneficiary due to non-performance of the bank's customer. Now, bank is compensating, that should be recompensated by the bank's customer, and for that counter guarantee is required. Then the period for which the bank guarantees are given, is it for shorter period, say 2 months, 3 months, or is it for a longer period? Say it goes in certain cases up to 36 months. So according to the bank's policy, the period got to be checked. So these aspects have to be kept in mind while appraising the bank guarantee limits. And how the bank guarantee limits are assessed, it's like this: opening bank guarantees plus bank guarantees that should be issued during the year, and that should be subtracted by the bank guarantees which are expiring in the next 1 year, let's say the proposal period, and this calculation would give the total BG assessed, or what is the eligible BG limit. So we should not only look into the BG that are being requested by the clients or customers, we should also take into consideration those BGs that are getting expired. Similarly, while calculating the BGs that are to be issued, bank should take into consideration the work orders or bidding details. Bank should have a detailed discussion with the customer to arrive at this figure. Okay, so this is how BG is assessed.
So thank you. In this 60 minutes, right, we had, 40 minutes. In this 40-minute session, I gave you a broader picture of letter of credit bank guarantee. And as far as the bank guarantee is concerned, at the end, I said, add BGs to be issued, less BGs expiring. Then you are going to get the total BG assessed. Okay. So the mathematical part is very simple, but the detailed work is required under BG to be issued, because you have to arrive at that amount. Already I have explained all the different types of BG. So each and everything is arrived, or each and every figure is arrived only after a detailed discussion, meticulous calculation. Sometimes cash budgets are required. You have to go through what are the projects they are going to undertake. Okay, so lot many things are there. That by itself is a separate topic. So once we'll have a separate workshop on LC and BG. Okay, right. Now it's time for us to move on to term loan. Shall we proceed? Type GA. Type GA. GA stands for go ahead, so that we can move on to term loans. Yeah. So today's topic is how to carry out term loan appraisal and assessment as banker. So it is not only for the banker, even for finance managers, project consultants, chartered accountants. If you are assisting the client, or if you are part of the organization which is taking up the term loan project, then this will help you out. Okay. We are going to talk about term loan appraisal and assessment. But before that, let's understand one thing: why business entities should go for a term loan. Okay, so I'm going to show you 2 or 3 scenarios. I'm going to show you 2 or 3 scenarios to help you to understand the importance of term loans. Number one, if they want really magnified returns and growth, they should go for a term loan whenever they take up a project. It means this is contrary to the saying that you should not borrow, you should use only own funds. No, if business they want to really make better revenue, if they want to really make a magnified returns and growth, they should go for term loan. Let me show you a scenario. Look at this. There is a project. The cost of the project is 100 lakhs. Let's say I'm taking up this project at a cost of 100 lakhs. Now I have two alternatives to fund the project. One is a scenario where I fund the project with 100% my own money, and second scenario is where I fund the project partly with my own money and a major portion with bank's money. Let's see how this works. So this is a scenario where I'm going to fund with a bank loan. Okay. So what is the cost of project? We know in both scenarios it is 100 lakhs. In first scenario, I'm fully funding the project with my own money. So I say this is equity funding. Whereas in the second scenario, only a portion of the project is funded by me. That is, out of 100 lakhs, only 30 lakhs is funded by me. It means in the second scenario, I'm going for a debt funding. That is, I'm going for a debt funding of 70 lakhs. Okay, now listen. This project is taken up with an understanding that this project will generate a minimum return of a certain percent. Okay, let's say this project is capable of generating a minimum return on investment of 15%. So this is the return which this 100 lakhs will generate. So this return can be technically called as earnings before interest and taxes, right? This return, what this project will generate, can be technically called as earnings before providing for interest, before providing for taxes. That is the capacity of this project. So 100 lakhs into 15% will give me 15 lakh in scenario 1. In scenario 2 also it will give me 15 lakhs. So this is what you have to understand. Because this earnings before interest and taxes is like a gross profit. Okay, gross profit will give you the same amount whether you invest the project with your own money or with a combination or with full debt fund. Okay, it is the net profit that will get varied. It is the net profit that will get changed because of operation of interest cost. Okay, right. Now listen, this project is capable of giving a minimum return of 15%, that is 15 lakhs. And I said this is the earnings before interest and taxes. So that automatically means I'm yet to pay interest on loan. Let me deduct that. I have taken a loan of 70 lakh in scenario 2. And let's say that loan was taken at 10% cost. It means in scenario 1, 15 lakhs is my earnings before paying interest. From that, should I deduct any interest? Answer is no, because in scenario 1, there is no debt at all. Whereas in scenario 2, 15 lakhs is the earnings before interest. Now I know my loan is 70 lakh. 70 lakh into 10%, I have to pay 7 lakhs as interest. So from this profits, if I deduct interest, what I will get? I will get earnings after interest, or technically it is earnings before tax or profit before tax. So what is the profit before tax in scenario 1? It is 15 lakhs. What is the profit before tax in scenario 2? It is 15 lakhs minus 7 lakhs, that is, it is only 8 lakhs. Okay, so now when you look at it, the profit has come down. But how did I say that if a business goes for a term loan, there will be magnified growth? It is there. Let's understand. Now what we have arrived is profit before tax. From this, let us deduct the taxes. What is the tax amount? I'm giving you that information. It is 30% of the profit. So on 15 lakh, 30% works out to 4.5 lakhs. And under alternative 2, on 8 lakh, 30% works out to 2.4 lakhs. Okay, right. Now let's arrive at profit after tax. 15 lakh minus 4.5 lakh, 10.5 lakh is the profit after tax. Whereas in scenario 2, 2.4 lakh is the tax, 8 lakh is the profit before tax. So 8 lakhs minus 2.4 lakhs, you get profit after taxes 5.6 lakhs. Okay. Now it's time for us to measure the return for the owners. Look at scenario 1. Owners are going to get profit or say the return for their investment of 10.5 lakhs for having invested 100 lakhs. So let me calculate return for owners. Just ignore this F by B. Okay, it's basically H divided by B. Okay, so return for owners. How much owners are getting now? They are getting 10.5 lakhs. Okay, but how much they have invested? They have invested 100 lakhs. So 10.5 lakhs as return for 100 lakhs, it means owners are getting 10.5%. They have invested 100 lakhs in this business and they're getting 10.5%. Pretty good. Okay. Now look at this. In scenario 2, what is the profit available for owners? It is 5.6 lakhs. How much owners have invested? Owners have invested only 30 lakhs. They are getting 5.6 lakhs by investing 30 lakhs. So 5.6 divided by 30, it means they are getting a return of 18.67%. It is comparatively higher, or it's better than alternative one. It's good, right? Because they are getting 18.67% return on their investment. And how much they've committed? They've committed only 30 lakhs. It means this owner, assuming he is having 100 lakhs funds, out of 100 lakhs, he has invested only 30 lakhs in this business. It means he still has investable funds of 70 lakhs, which he can invest in a project like this combination. Okay, so that's the power of debt funding. See what happened here. Here, the presence of debt, okay, help this organization to have more return on investment for the owners. Because the same project, same assets, what has undergone a change is only the funding pattern, right? Here it was fully funded by owners' money, but here it was partly funded by owners and major portion by the bankers or say the lenders. And if you see the profit before taxes, yes, you can see comparatively the amount is lesser. But what you have to understand is look at the amount that was invested by the owners. Amount invested by the owners is only 30 lakhs and they are taking 5.6 lakh. It means they are getting a return of 18.67%. So there is a magnified return. That's why I say, like business, whenever they take up a project funding, they should also have debt as a part of funding. Okay, debt also as a source of finance. Okay, this is reason number one why debt funding is required for funding a project. I'll give you one more. The another reason can be tax benefit. The other reason can be tax benefit, but before that, whether this concept is clear for you, I mean, why business should go for term funding? Why business should go for term funding when they go for a project? If this concept is clear, that is, having a debt in capital structure could result in magnified return for a business when the market scenario, market condition is good. Here, for me, I made an assumption that market condition is good. Okay. Anyone facing issue with the audio? Anyone facing issue with audio? If audio is clear, type AC. I just received 1 or 2 messages saying audio, there is a problem. Okay. If audio is clear, just type AC. Okay. Then whoever having issue, that should be at your end. Okay, it could be because of internet connectivity issue. Okay, because for majority, yes, it's going perfect. Okay, now let me just once again conclude this. In scenario 1, there is no debt funding. In scenario 2, it's a hybrid, a debt and equity, and the return on investment is same, cost of the project is same, but what is undergoing change here is the profits that are available for owners for the amount they have invested. In scenario 1, having invested 100 lakhs, they are getting only 10.5 lakhs. In scenario 2, for having invested 30 lakhs, they are going to get 5.6 lakhs. It means it is 18.67%. It is 18.67%. So there is a magnified return. But here there is an assumption. The assumption is in both scenarios, I'm saying the return on investment is same. Okay. And it also means that market condition is good. And if the market condition is not good, the term loan itself will become a bigger burden. Okay, right. And the question from Barney Dharan, okay, I said I'll not be taking up questions now, but still I've seen this, I'll answer. In EMI, we have both interest and principal, but why we are deducting only interest? Because interest is considered as an expense, whereas the loan amount which had come into the business is not treated as income. Okay, I repeat, interest is considered as expense, so we are deducting it. And the loan amount which had come in was not treated as income, was not taken to the statement of profit and loss. Rather, it was taken only for the only to the balance sheet. So if at all any repayments are going to happen, that will get reduced only from the balance sheet and not in, say, the statement of profit and loss. Okay. Yeah. So this is scenario one, and I just wanted to confirm whether this concept is clear for you. That is, having a debt fund in the capital structure could result in more return for the owners in good market condition. Within quotes, good market condition. If this concept is clear, can you type CC, concept clear? CC stands for concept clear. Yeah, please. In bad market condition, this interest is a fixed cost. This will act as an axe. It could even cut the head of the business which are not performing well. Because in bad market condition, this 15% return on investment may not be possible. Instead of 15 lakhs, if they make only 10 lakhs or 5 lakhs, then that will have impact on the profits. That will have impact on, say, the repayment, all those. Okay, right. Let me give you one more reason why term loan should be considered for project funding. I'm taking the same scenario what we discussed. Okay, these are all the same figures, and all this we calculated. Okay, now you see, look at the scenario one. What is the tax amount? 4.5 lakhs. Look at the scenario two. What is the tax amount? It is 2.4 lakhs. Projects giving same return on investment, 15 lakh. But for the first project, tax is 4.5 lakhs. For the second project, the tax is 2.4 lakhs. It means it looks like penalizing the owner for having invested all his money. This guy invested all his money in this project. He didn't borrow at all. And so he is asked to pay 4.5 lakhs. But this guy had invested only 30 lakhs. Okay. And he is getting benefit out of it because he's paying only 2.4 lakhs. Okay, it's not because he invested only less, it's because he borrowed. Because when he borrows, he pays interest, and interest is considered as a tax deductible expense by income tax authorities. It means when my business has made a profit of 15 lakhs, and when I pay interest of 7 lakhs, I can claim this interest as expense. I can tell my tax authorities, my profit is not 15 lakhs, I have paid interest of 7 lakhs, so my profit is only a net of 8 lakhs. And they will consider that as profit, and only on that 8 tax will be levied. But in scenario 1, my profit is 15 lakhs, I have no other expense, so my entire profit of 15 lakhs is subject to tax at the rate of 30%. So by having the presence of interest in my cost structure, what is happening? My profits are comparatively lesser, and so my taxes are. Look at here, instead of 4.5, I'm paying only 2.4. It means there is a tax saving of how much? 4.5 minus 2.4, that is 2.1 lakh. And the beauty side is this 2.1 lakh from where I made the saving. One understanding what I have is the presence of interest. Yes, it is presence of interest, because look, 7 lakh is your interest. What is the tax rate? 30%. 7 lakh into 30% is 2.1 lakh. Are you getting this point? Having interest in your cost structure will help you to save taxes. Just take that interest amount, multiply by the tax rate. In our case, I took 7 lakh, I multiplied it with the tax rate of 30%. I derived 2.1 lakh. Now I'm comparing it with the similar scenario. If there is no interest, I would have paid 4.5 lakh. Because of interest, I'm paying only 2.4 lakh. So I have saved 2.1 lakh, which is nothing but the result of interest. Could you get this point? If this point makes sense for you, just type MS. Just type MS. MS stands for makes sense. Okay. This is something many entrepreneurs miss out. Many bankers also miss out. I mean, you can educate your customer like when they look at the interest as a burden, interest as an expense, tell them that, see, on one side you are saving taxes. Otherwise, you would have ended up in paying more. When you pay interest, there is one good thing: you get an immediate benefit, right? Because when you pay interest, you have borrowed, the money is in circulation. When you pay taxes, you get nothing. Of course, you enjoy the social infrastructure of the country, which is a common benefit. But when you pay interest, you get loan money, which is a personal benefit. Okay, this is a direct benefit. Okay, so this is the second reason why business should go for term loans when they take up a project. And let me give you one more reason. Having interest, having borrowed funds actually results in lowest cost of funds for the business. How? Let me continue with the same example. We have seen that interest amount paid is 7 lakhs on one side, but what is the tax saved on the other side? That is, on one side, the business is paying interest at the rate of 10% on 70 lakhs loan, that is 7 lakhs. But we have also understood that on the other side, they are saving a tax of 2.1 lakhs. So on one side, I pay 7 lakh, and on the other side, I save 2.1 lakh. It means I can say my net interest cost is only 7 lakh minus 2.1, that is 4.9 lakhs. My net interest cost is only 4.9 lakhs. And what is the loan amount I have taken? 70 lakhs. For having taken 70 lakhs, I am paying interest as 4.9 lakhs. It means my effective interest cost, my actual interest cost, I know it is 10%, but my effective interest cost is 4.9 lakhs over 70 lakhs. It is only 7%. Because when you pay interest on one side, on the other side, you save taxes. So you have to see the net of it. Because if you don't pay interest, you would have paid more taxes. So because of interest only, you are saving the taxes. So net it. I pay 7 lakhs on one side, I save 2.1 lakhs on the other side. It means my net effective interest cost is only 4.9 lakhs, and I have taken a loan of 70 lakhs. So my effective interest cost is only 7%. Okay, if this is cool, if you feel this concept is really cool, just type cool. Okay, this is something which you have to understand, because this goes into management decision making. Okay, this is basically a part of management accounting. People at the top level, CEOs, CFOs, they look at it in this range. Okay, they look at it in this range. They look at what is the after tax cost. They do not primarily or blindly look at the apparent cost. Okay, right. Next, we are actually getting into the appraisal process. So I wanted to give a 3 scenario, because it stresses on the importance of term loan. Because term loan is not a mere money that is coming into funding the project. It has several other side effects. The first side effect, what we have seen, is a magnified growth, right? The second side effect is savings in tax. And third side effect, all are positive effects, right? The third side effect is your overall interest cost is lower. Okay, these are all positive side, but the negative side is when the market downs, or when the business, the unit is not performing well, then this term loan itself will act as an axe and kill that business. That's how many NPAs are being created. Okay, right. So today, our topic is term loan appraisal and assessment. So term loan, in the sense, I'm not going to talk about normal business loans which are given for 3 years, 5 years, 10 years without looking into the purpose. Term loans are the loans which are given for a term period. Let's say 3 years, 5 years, 8 years and all. Number one. Number two, it is given for a specific purpose. It means out of that purpose, cash profits will be created, and that cash profits will be used for repaying the loan. Okay, so I repeat once again. Term loans or long duration loans. Okay, so we say a term period. It is given for a specific project or a specific purpose, and that project would in turn result in either creation of sales, additional sales, or it would result in reduction of cost. Okay, so either sales or additional sales, or reduction of cost. So in turn, the profits will be created, or additional profits will be created, and from that profit we arrive at cash profit, and with that cash profit the loan will be serviced automatically. It means we are not talking about general business loans, general corporate loans. We are talking about loans which are given for putting up a project. The project can be, say, putting up a small factory, or constructing factory building, purchasing plant and machinery. Okay, all these projects are with an intention to either start a new business or expand an existing business, or a diversification or a cost reduction or a modernization projects. Okay, so in term loan, what is more important is you have to arrive at the exact cost of the project, and then you have to decide the means of finance. This is the quantitative part. But before getting into the quantitative part, the qualitative part of the term loan, that is very important. Okay, before going deeper into the numbers, before going into the technical analysis, as a banker, you should study the customer. Okay, understand his integrity, whether he is a man of word, whether he will repay the loan or not, what is his market reputation, okay, what was his past track record. Okay, this is the due diligence which you have to do for each and every loans. But when it comes to term loan, when he approaches you for putting up a project, you have to study that aspect in addition, whether he is capable of implementing this project. Not only implementing, whether he is capable of taking this project for the project period so that term loan will get repaid without difficulty, whether he has got that managerial capability, whether he has got that technical expertise. Okay, all those qualitative aspects you have to take into consideration. Without that, there is no point in getting into these financials or analytical aspects. Okay, so it's like sometimes the appraisal part, the quantitative appraisal part is given, or it's overemphasized, ignoring the critical qualitative parts. Okay, I mean basically the management, the integrity, their technical expertise. Okay, you have to frame an opinion by having a deeper discussion with the customer, then come for this. I mean, I'm not saying that this is not important, but that is even more important. This is critical, okay, but that is even more important. Study your customer first, understand their mindset, understand their integrity. Okay, look at their past track record, their knowledge level, their technical expertise. Okay, if you are okay with that, then go ahead with the other aspects, technical aspects of the project. Okay, the first thing is you have to freeze the cost of the project and means of finance. I'll take you through an example. Okay, look at this. Okay, this is a typical format. This is a typical format of cost of project and means of finance. Let's say I want to start a project, let's say starting or putting up a factory and purchasing plant and machinery and installing it. So basically I'm creating the infrastructure for starting my business. So in that case, I have to invest on land, then I have to construct the building, I have to purchase and install plant and machinery, then some additional small items comes here. I'll explain what are all this as we progress. But these are all the items which I have to create to kickstart my company. And for this, I need money, right? In order to create all this, I need money. So as an owner, I'll be bringing some money. And this is something what you will see only in the companies which are profit making, existing profit making companies. I'll explain at appropriate time. Then for the balance portion, I go for a term loan. It means this table is very, very important for my project. Where and all I have to spend. I have to spend on land, building, plant and machinery and other items, miscellaneous items. And for all this, from where I will arrange money, how much I'm going to bring, how much I'm going to ask bank for a loan. Okay, that gets captured in cost of project and means of finance. It's something like a balance sheet. Okay, balance sheet will have like sources on one side, uses on the other side. Here I've just kept the uses on the left side and sources on the right side. Okay, any side as you wish. Okay, now let me take you through an example. Look, I'm going to start a project at a cost of 10 crore. And this project comprises where I purchase a land for 1 crore, and on that I construct my factory building for 3 crore, and I have to purchase and erect and install plant and machinery for 6 crore. So my total cost of the project is 10 crore, and how I have planned to fund this is I will be bringing in 3 crore, and I will go and approach a bank for a term loan of 7 crore. It means I'm contributing 30% for the project, and I'm asking a loan of 70%. Okay, so you can also arrive at the project debt equity ratio here. The debt is 7 crore divided by equity of 3 crore. That gives you project debt equity. Okay, so this looks like very simple, but the point is it is actually simple. It is not comprehensive, because when you finalize or when you freeze a cost of project and means of finance for a company, especially for a new project, you have to be very, very careful, because for this project there is no past. Okay, because it's a new project, it's a new company, new project, they don't have any, they don't have past. It's like a baby. Okay, so you have to take, or you have to give that maximum care so that you can ensure this grows appropriately or in correct phase. If you don't give that due care when you give birth to a new project like this, in a short period it will die. Okay, and it will uh, come as a big headache for you at a later point of time. I hope you are getting my point. If a company is starting a project, let's say a new company is starting a new project, then it's like handling a baby. Okay, you have to take utmost care to ensure that whatever is required is given. I mean, whatever the feeding is required, that have to be done. If it is not done, then this baby will collapse. Okay, shall I proceed whether everything is perfect? Just type go ahead, GH or GA. Just type go ahead. It's basically to ensure that we are all connected, the audio and video, everything is correct. Yeah, thank you. Okay, so this is the project, and this is what I'm showing to my banker, and the banker is also finalizing, but it should not be finalized in this way. Okay, here, even though we have concluded the cost of the project as 10 crore, we are missing on something. We have to take care of that. What is that? Let's see. The first one is, please provide working capital margin. Please provide working capital margin. Before that, I'll make a disclaimer here. See, this is a project at a cost of 10 crore. Okay, right. And I have 3 crore with me, and without the bank loan of 7 crore, I cannot take up this project, because the maximum funds what I have now is 3 crore. And if at all some small plus and minus is required, I can manage, but I cannot independently take up this entire project on my own. So I need a minimum term loan of 3 crore. I have brought in, I need a minimum term loan of 7 crore. I have already brought in 3 crore. Some small additions is manageable. It means there will be corresponding reduction in loan if bank says so. Okay, but if the bank is generous to give this entire 7 crore, I'll be happy. Okay, so this is the background. Now I have this project, and let's say my first customer drops in, and he is ready to place order. He's ready to place order, and he's actually placing the order. So that's where my headache starts, because I have set up this project, and when a customer places an order, I have to execute that order. For that, I have to purchase raw material. For that, I have to engage my laborers. I have to incur manufacturing expenses, and whatever the fund I had, close to 3 crore, I have invested in this project. How will I manage? And that's where we say, don't worry. When the bank has given a term loan, they will also give working capital. Okay, fine. So bank is also ready to give me working capital. Okay, that's the scenario I'm going to show here. Okay, this is what required for my initial operations. I mean, if I want to kickstart my operations, I should have investment in raw material at least 1 crore. I should make investment in labor at least 50 lakhs. I should invest in other manufacturing expenses at least 50 lakhs. It means I should make additional investment of 2 crore. See, already what is my total investment? 10 crore. But now to kickstart my operation, I have to invest another 2 crore. But already I said I have only 3 crore. Maybe a small addition here and there I'll be able to manage, but a total amount of 2 crore I cannot manage. Okay, that's, we need not worry, because that's where the bank will also step in, because the bank which is giving a term loan for a project to take off should not shy away from working capital. If they are doing so, it means they are trying to give slow poison for themselves. What is the point in forming a company? I mean, what is the point in giving a term loan to a company to put up a project and saying no for working capital facility? It's like constructing a full building and saying that you will not give electricity connection, or it's like constructing a full building and saying that you will not give water connection. What is the point? Okay, never ever, as a banker, never ever have that policy. Okay, so if you are giving a term loan for putting up a project, for starting a project, then it is equally your responsibility to ensure that they are given adequate oxygen, adequate water, or adequate electricity in the form of working capital facility. Okay, so here what we have understood is they need at least another 2 crore to kickstart their operations, and let's say banker have agreed to give 75% of it. So out of 2 crore, the banker is giving 75%. Banker is ready to give 75% of it. It means the condition placed by the banker is, we will give 75%, you please bring 25%. That's what you see this 0.5. It means 25%, 50 lakhs out of 2 crore should come from the owner, and 1.5 crore bankers are ready to give. But here you should also empathize with the customer. Already that customer has managed or had so much of difficulty to bring this 3 crore, and now you are saying, or you are asking him to bring in another 50 lakhs. How he will manage? Because repeatedly I maintained that some small additions here and there with the 3 crore is manageable, but big amount is difficult. Okay, this is something which you have to relate with reality also. Okay, this would be the situation of most of the borrowers. Okay, so our banking system has recognized this difficulty. Okay, that's why our banking system is ready to consider this 50 lakh, basically the margin which the borrower should bring in for meeting the working capital facility. Our banking system is ready to consider this 50 lakhs working capital margin also as cost of the project. So already we have seen cost of project as 10 crore, right? Now with that, I'm also adding this working capital margin as cost of the project. So my cost of project will become 10.5 crore because I've added 0.5 crore. So 10.5 crore. In that, as an owner, I will bring 30%. Okay, so now 10.5 into 30% is 3.15 crore. Earlier, it was 3 crore. Now I'm forced to bring 3.15 crore. Okay, there is addition of 15 lakhs, but I'm ready to do that because bank is helping me to fund what I am supposed to contribute. In this point, I am supposed to contribute 50 lakhs, but bank is ready to contribute. Bank is ready to consider that as a cost of a project, and bank is taking my load of contributing this 50 lakh. They are actually contributing how much? 35 lakhs, because 15 lakhs comes from my hand. And look at the term loan, it has become 7.35 crore. It means bank is contributing 35 lakh. Okay, so this is a concept which are overlooked by many of the bankers, and I can relate with some scenarios, some real life scenarios where the business units which were denied of this working capital margin, they had greatest difficulty in taking off. Okay, greatest difficulty in taking off. And I've seen cases which have achieved quick mortality, that is having sanctioned a term loan but not structuring the working capital facilities appropriately. Those term loan accounts have turned out to be a non-performing asset within a period of 2 to 3 years because they were not given adequate oxygen, adequate working capital. Okay, so this is the concept of working capital margin, which should be considered as part of cost of project. So if this concept is new for you, just type new, and if it is something you are exposed for the first time, and if it's something that has opened up your mind, just type bulb on. If it is something which has opened up and you feel like, yes, you have learned something new today, just type bulb on. I want to see how many bulb on we have. Yeah. Great. Okay, so never ever, I mean, even if the customer, because customer will be ignorant of this. Customer will not know, first of all, he'll not even know the concept of working capital when they come to your bank. It's gradually they get to know about this. Okay, so in the initial stages, they won't even understand working capital. Then how they will understand working capital margin? So it's your responsibility to educate the customer. Okay, when you educate the customer, you will also love your process. Okay. See, the message is like this: if you want to really learn something, teach. If you want to really learn something, teach, because there is a pyramid for learning. Okay, when you listen to a lecture, there is a certain percentage of learning happens. when you read books, a certain percentage of learning happens. Okay, so that pyramid goes, and if you look at a point where you will have the maximum learning is when you teach. Okay, I mean, your learning will be 90% more effective when you teach. So these are all something which whenever you find an opportunity to educate your customer, educate them, and they will remember you for lifetime, number one, and you will remember this concept for lifetime. Okay, shall I go ahead? Shall I go ahead? Just type GA. It's permission from your side so that I can continue the presentation. Yeah. Thanks a lot. Okay, so now we have freezed the cost of the project as 10.5 crore. But again, it's a new company, I said, right? New company, they're putting up their project for the first time. And we should not freeze the project cost at this point, because this business would have incurred some expenses even before forming this company, but for the purpose of forming this company. Let's say the incorporation expenses, or they would have done some market research, they would have done some field survey, but all are incurred for this business only. Okay, so that should also be considered as part of cost of project, and our banking system recognizes that as well. So let me put that here. Let's say I have incurred some expenses like 25 lakhs in feasibility report, 15 lakhs in market survey, then flotation cost, the cost incurred by me in starting this business. Okay, 10 lakhs. It means I have spent 50 lakhs even before I make any revenue. Okay, or 50 lakhs even before I commence my operations. So who will fund this? Already for the land, building, plant and machinery, 3 crore is gone. Then probably I would have spent this money, but I need this back to reinvest in the business, because that 3 crore, what I have planned, have to be invested over a period of time. But out of the 3 crore, some portion already I would have invested. It means I will face a shortage of funds in fulfilling my promise, because as per the earlier stand, I'm supposed to, as per the earlier stand, I'm supposed to bring in a capital of 3.15 crore. But this 3.15 crore is for meeting a portion of all this, right? But out of this, close to 50 lakhs already I've spent. It means I will not be having 3.15 crore with me. I'll be having an amount of 50 lakhs lesser than 3.15. Okay, so that means when it comes to the compliance of this capital bringing in, there will be an issue, because the bank will not give loan amount entire 1 crore for purchasing land, because bank understands 30% is a margin. So what the bank will do, if I have to pay 1 crore for purchasing the land, bank will give me check for 70 lakhs, and bank will say, okay, you are supposed to manage 30%. No, okay, you manage. Then for building, bank will not give entire 3 crore. Bank will give check only for 2.1 crore, 70%. It means remaining 90 lakhs I have to manage. And for plant and machinery, once again, bank will not give entire 6 crore. They will give only 70%. It means balance I have to manage. But at this point, we'll get that realization that that balance may not be manageable, because I have already spent them even before starting this company, or even before commencing the operations. It means at that point I will face mismatch, and my business, my project should not suffer because of that. And that's why our banking system has recognized they are considering this preliminary and pre-operative expenses also as part of cost of project. But this approach can vary from bank to bank. But public sector banks who want to be really conservative, they actually take care of this, because this is something which got to be provided. If it is not provided, that business, that term loan, that project will suffer. Okay, so already we had 4 items including working capital margin. With that, now I am adding preliminary and pre-operative expenses of 0.5 crore. So what is the total now? 11 crore. Out of 11 crore, 30% from owner. It means earlier it was 3.15 crore. Now it had become 3.3 crore. It means, yes, it's my responsibility, because here I'm not I'm not put into the burden of managing this entire 50 lakhs. I have to manage only 15 lakhs. 35 lakh bank is going to support me. Look, Earlier, what was the term loan? Earlier term loan, it was 7.35 lakh. Now with 7.35 lakh, another 0.35 lakh, it means bank is supporting me via term loan. So in this way, this preliminary and pre-operative expenses is also getting included in cost of project. And this aspect comes into picture only for new businesses, okay? Because preliminary, pre-operative, these expenses are applicable only for the new businesses, not for existing running business, okay? Right. The next one. This is very, very important. And again, I see like several private bankers, they just go blind on this. They just go blind on this. But if you really want to nurture a baby in appropriate form or in the correct or right form, you have to provide for this. That is contingency, because we are dealing with future, right? The term loan is basically a project. This project is being implemented. So some projects can be very simple project, like just purchasing plant and machinery, simple, not an issue. But some project will have a longer implementation period. Okay, if you start the project today, it will take at least another 1 to 2 years to have that project completed. So in this 2 years, anything can happen, any change can take place. Market can go up, it can come down. The prices of the components of the project, the price of the land, the building, the plant and machinery, several things can undergo a change. Who expected a situation like this we have now, the COVID, the lockdown, okay? How many business units have expected a fall in sales in this period? So the market scenario can go in any direction. And when it comes to finalizing the cost of project, we have to anticipate these kind of possible negative impact, especially on the components of the cost of the project. Look at here, the land cost, the land cost is 1 crore. Okay. As far as the land, since it is a one purchase, I do not expect any major change, because when they have identified the land itself, they would have made an agreement. So there is not likely to be any major change in the price of the land. But building, I have to construct it over a period of time. And in this period, there are several factors where we will not have control. Say in the price of sand, the price of cement, in the availability of laborers or cost, or there can be interruption because of monsoon, there can be interruption because of a situation like COVID. So because of this, the implementation period will get elongated, and as a result, the cost what we have estimated will also go up. Okay, several factors are there and which are mostly beyond our control. And look at plant and machinery also. Plant and machinery 6 crore. Generally, they will give a pro forma invoice, and that pro forma invoice will be valid only for a certain number of days, let's say for 60 days or 90 days. But if the project implementation itself takes a longer time, and if the plant and machinery have to be purchased and installed after 6 months time, 9 months time, and in between period, if anything happens like a scenario what we have now, then again the cost of those assets, plant and machineries, will also undergo a change. Okay, so out of these items, that is land, building, plant and machinery, working capital margin, preliminary expenses, on two items, mainly building and plant and machinery, there is a possibility the cost will undergo a change. It can undergo a change on the negative side, in the sense it can increase. So I am anticipating a 5% increase in this cost. So 9 crore is the total cost. I anticipate 5% increase. So that 5% increase I want to provide in the cost of the project, because had I known them in advance, then I could have provided that in the cost of building and plant and machinery itself. But I'm not sure whether it will happen or not. So it is contingency only. If at all it happens, yes, that will be taken care by funding. If it does not happen, then to that extent, loan also will not be released. So what I'm doing, along with working capital margin and preliminary pre-operative expenses, I'm also adding a component called contingency, which is 5% applied on building and plant and machinery. Okay, so 3 crore plus 6 crore, 9 crore. 9 crore into 5% is 0. Already we had how much? We had 11 crore. With 11 crore, this 0.45 is added. It means now the cost of the project is 11.45 crore. Remember, we started with 10 crore. Now it has become 11.45 crore. Okay, on this 70%, that is 3.44 crore is the capital which I should bring in, and bank will give me 8.02 crore. So look at this. In the previous stage, a capital contribution is 3.33 crore, but now we had reached the stage where the capital is 3.44. So at this point, the promoter will show his reluctance. Promoter will show his reluctance. What, I have come to you with the expectation of me bringing in only 3 crore and you giving 7 crore, and now you are asking me to bring in 3.44 crore. So that could be the reaction of the borrower. But here, borrower have to be educated, and that's the need. If the borrower is not ready to understand, then he is digging grave for himself. Okay, because if he is not going to provide for contingency, if he is not going to provide for preliminary preoperative expenses, if he is not going to provide for working capital margin, these are all the small things which can have big impact on the implementation of the project. Okay, so it's very important that they have to make arrangements, because it's not just the capital is increasing. Look, the term loan is also increasing. We started with a term loan of 7 crore, but now we have reached a stage where the term loan is 8.02 crore. So the bank exposure is also increasing by 1.02 crore. But unless and until banks takes this 1.02 crore, banks takes these three elements in the cost of project, bank is also digging grave for itself. Okay, so that's the level of importance. So here, I cannot say that I will stop myself with 3 crore. Then if that is the case, it's better I drop this project. Okay, I can drop this project if I'm not in a position to manage this additional 44 lakhs. I can drop a project of 11.45 crore size because of my inability. Because if I'm not in a position to bring this, then it's better to drop. Do not undertake a big risk, because these are all small items, but they can have a big impact. Okay, next. The other element that should be considered in the cost of the project is interest during construction. This is also not prevalent in many of the private sector banks, but if you want to really safeguard yourself, if you want to really ensure that business, what your funding is taking off, consider this also. And this is very important, very important in case of new businesses which are going with their first project. What is this interest during construction? Let's take our case itself. What is the cost of the project? 11.45 crore. What is the term loan we have finalized at this stage? It is 8.02 crore. Okay. Now this loan has been sanctioned, and from next month onwards, EMI is started. So every month they have to pay interest and principal. But let's say this project is going to take 1 year for completion itself. Okay, so the cost of the project is 11.45 crore. The term loan required is 8.02. I'm making one rough assumption that the term loan is released in the beginning and they have brought in their capital. It means implementation period is 1 year, and for this 1 year they have to pay interest without any income. Why? It's only after 1 year they're going to start having their commercial operations. 1 year is implementation period, and for this 1 year period they are going to pay interest. How they will pay interest? They don't have income, they have only expense. How they will manage? That's where this concept of interest during construction comes into period. Let's say 12 months is an implementation period. Then this loan amount into implementation period, that is 8.02 crore into 1 year. Okay, it's 1 year, right? Into 12%. 12% is the rate of interest I'm considering here. It means this 0.96 is something what they pay without having any income. How they will pay? They cannot pay. And if they don't pay, within a matter of 3 months, this account will become an NPA. So it is very important that this amount should also be considered as cost of project. This is not something propagated by me. Our banking system considers this also as cost of project. So already we had cost of project is 11.45 crore. Now with that, it's very important that this 0.96 crore is also included. It means what customer is supposed to pay is 0.96 crore. Now that is getting included in the cost of project. So the cost of project is 12.36, and bank is going to fund 70% out of it. It means now the term loan is increasing to 8.65. Earlier it was 8.02. Now it is 8.65. So 63 lakhs is coming from bank side itself to get their interest itself. But that is required. That's important if you really want to give appropriate oxygen, appropriate say the lifeblood for the business. Okay, so the term loan is getting increased on one side, and on the other side, of course, the balance money should come from the capital. It is 3.71 crore. So now a point has come where the borrower should realize that if he wants to go for this project, if he wants to take up this project, mere investment of 10 crore is not adequate. If he thinks that he can start this project with an investment of 10 crore, he is digging grave. Okay, he needs at least 12.36 crore to have this project implemented, and he cannot have this project done just by bringing in 3 crore. He should be mentally, financially prepared to bring in 3.71 crore, and that's good because term loan is also increasing from 7 crore to 8.65 crore. So if these factors are not considered in term financing, like IDC, interest during construction, contingency, preliminary pre-operative expenses, working capital margin, if you're not considering this, and if you're arriving at the cost of project and means of finance, it means what you are carrying or what you are preparing is an incomplete memorandum. Okay, it's not, I mean, you have not factored all the cost. I mean, see, what banks do is they freeze, or they will have a cap on the maximum loan they can give. So the bank or the branch will say, see, our maximum is 5 crore. We will give 5 crore. Balance you somehow manage. If that is going to be the approach, in that way, if you are going to give a loan to a project which demands 8.65 crore. So I'm talking with reference to the present scenario. See, this is a project which demands an investment of 12.36, and at 30-70 proportion, term loan required is 8.65 crore. So if this is the reality, and when the reality is like this, and as a banker, if you are going to say our bank sanctioning authority comfort level is only 5 crore, we will give 5 crore, you manage the balance, let's say 7.36 crore. If you are going to structure a term loan in this fashion, then that's the beginning of the end. That's the beginning of the end, because you are trying to give a half cylinder oxygen for a person who demands like 2-cylinder oxygen. Okay, you believe that by just giving half cylinder oxygen, he will start, walk, run, and fly, but he actually needs at least 2 cylinders of oxygen just to stand up. Okay, so that's the situation, that's the reality and background. Understand this. So never ever have a casual approach for a term loan. Do not just look at it as a just one proposal. Do not look at it as just another proposal. Each and every term loan project or actually feeding multiple number of families. That's how I was trained. That's how I was given exposure. I mean, we never looked at term loan project as just another proposal. Each term loan is going to impact several thousands of lives at the time of project implementation and during the course of the life of the project. At the time of project implementation, the owners, the laborers, the stakeholders, the suppliers, okay, so many people are involved. It's going to have impact on their life, on their livelihood. And not only that, after the project, see how many employees, how many laborers are going to work in an organization. So if you take this role with the utmost care, because you are shaping a future of so many people, it's not mere a table where you put in some numbers and get the sanction. No, you are actually shaping a society itself. That's how I looked at term loan funding. I request whoever handles the term loan funding to have the same kind of approach, because it's not just one proposal, it's going to have impact on several lives. Okay, so this is something I wanted to touch on. Whether whatever I've explained was clear. I mean, if everything was going on perfect, and if you had some new learnings today, just type BULBO on bulb on. And I derive my happiness when I see so many bulb on here. Yeah, thank you. Thanks a lot. And I wanted to keep this session really a short. Thanks a lot for sharing your bulb on moments. So now it's time for us to have a break. So our original scheduled time is 4:06. We managed with 3 minutes addition. It's 4:09. I'll count it as 4:10. Okay. Shall we have 10 minutes break or 15 minutes break? 10 or 15? Okay, fine. Oh my God. Now it's 15:10, 15:10, 15:10. 15:10, 15:10, 15:10. Okay. Okay, we'll do one thing. We'll have a 15 minutes break. Now the time is 4:10. So when you will be back, just type. Yeah, Ahmed, I acknowledge. All of you will be back by 4:25. 4:25. We'll catch up. After that, we'll have a session for another 30 to 45 minutes. And with that, I believe we should be able to pack up dot 5:30. And if you feel today's session is very well structured, at the end of the session, when I ask for feedback, just do share that. Okay. Yeah, 15 minutes break. Now the time is 4:10, 4:20, 4:25. 4:25 will come back. And in the meantime, I'll just play the tea break video. And whoever watching this in YouTube, you can make use of it because I'm going to show you something related to YouTube membership. Thank you. So it's 4:25 on dot. Shall we start? We'll just give 2 minutes. So thank you. We'll move on. We'll continue our discussion in term loan. I have one case. It will make things a little more clear. Let's proceed. Yes. Now, I want you to understand a concept called internal accruals. Just before, I mean, the case what we have seen so far is where the project is funded with a bank loan and owner's money. Okay, bank loan of, I think we started with 7 crore, we ended up at 8.65 crore loan, and owner's money, we started with 3 crore, and I think we ended at 3.74 crore something. That's a project for new company. But existing companies which are already profit making, what they'll do at times is when they take up a project, they'll say, we need a term loan of, let's say, 70% of the project, and the margin, that is the owner's money portion, we will meet out of internal accruals. So if you look at this case, the cost of the project, I think it's the same case what I've discussed. Since it is for existing company, the need for working capital margin, the need for say the other elements, working capital margin, interest during construction have not been provided because it is already existing profit making company. Okay, right. Now what they are saying is 10.45 crore is the cost of the project, and 70% is 7.32 crore loan, and the balance money they are saying that they will meet out of the internal accruals. Internal accruals is nothing but cash profits of the business. Okay, what is internal accrual? It is the cash profit of the business. It means they are saying that they have so much of cash profit. Out of that, we'll take a portion of the cash profit for funding this project. Okay, then you have some additional information. This company, that is X Limited, has repayment obligation of 1.5 crore for existing loans. It means already they have some loans, and on that they are paying interest of 50 lakhs and principal of 1 crore. So already they are paying 1.5 crore. And you're also given information about what is their profit, estimated profit after tax and dividend. That is 3 crore. That is, if they take up this project, okay, they are estimating the profit after paying tax and after paying dividend to the owners as 3 crore. Okay, and you are given additional information. Estimated depreciation is rupees 2.5 crore, which is on existing assets what already they have plus the new project assets. This is new project assets. So both put together, this is the depreciation information. And you are also given another information, proposed loan repayable in equal installments over 8 years. So this 7.32 crore will be repaid in equal installments over a period of 8 years. So if you want to know what is the annual installment, take 7.32 crore divided by 8, you get the annual installment. Okay, now the question is, you are required to comment on acceptability of internal accruals as margin for the project. So the question is whether we can accept this internal accruals as margin or not, because they are saying they are going to meet 3.14 crore out of profits. Is it possible or not? That's what. Okay, how do we find out internal accrual? What I said, internal accrual is nothing but the cash profits of the business. What we have from the books of accounts, what we have from the statement of profit and loss is profit after tax and dividend. We call that as a book profit. Okay, it's a profit which is arrived by following the accounting standards, procedures and all. Okay, but that is not cash profit, because that profit is arrived after subtracting some items where no cash is paid. For example, depreciation. Depreciation is an expense that would have been factored while arriving at this profit, but there is no single cash going out in the name of depreciation. Okay, so with the profit after tax, what we have to do, we have to add back depreciation. Okay, I'll show you that. Listen, look at this computation of internal accrual. So this is what we have seen as profit after tax and dividend, 3 crore. But with that, what I'm doing, I'm adding back the depreciation information given here, 2.5 crore. Okay, then I'm also going to do 2 additions back. One is interest on existing term loan, 0.5 crore. From where I got this information? Here. Interest of rupees 0.5 crore. Okay, right. Then interest on proposed term loan, I have it as 0.88 crore. From where I got this? This is the loan, 7.32 into 12%. 7.32 into 12% gives me 0.88. Now, with profit after tax, I'm adding depreciation. That makes sense because depreciation is a non-cash item. But why I am adding interest on existing term loan, why I'm adding interest on proposed term loan? I'm adding these 2 items because my objective is finding out the cash profit, and it is only from the cash profit interest have to be paid, principal have to be paid, margin have to be met. Margin for the project. What is the margin for the project here? It is 3.14 crore. Okay, now what I'm doing is I'm finding out what is the cash profit, that is profit after tax and dividend plus depreciation. With that, when I add back interest, I get to know what is the cash profit before paying interest. So I have 6.88 crore. Because it's only from 6.88 crore I have to pay interest. Yes or no? It's only from 6. I cannot say I have to pay interest from this 5.5 crore. That is 3 plus 2.5. I cannot say I have to pay interest from this 5.5 crore. No, because this 3 crore was arrived after deducting interest. So if I want to know what is the cash profit available for paying interest, I have to add back what was deducted. So I'm arriving at my cash profit as 6.88 crore. So whether this concept is clear, the concept of internal accrual, whether this is clear. If concept of internal accrual is clear, just type CC, that is concept clear. Just type CC. Okay, perfect. Now listen. I'll repeat once again. We are trying to find out internal accruals. Internal accruals is nothing but the cash profits that are available for paying your principal, interest, and meeting margin. Okay, be very clear on this. What is internal accrual? It is nothing but the cash profit available for paying your interest, paying the loan principal, and for meeting the margin requirement, if any. So if I want to pay interest, I should find out what is the profit before interest, because only out of it I can pay my interest. I cannot pay interest on the profit after interest. So here what we have is profit after interest. If you want to know what is the profit before interest, add back the interest. And if you want to know what is the cash profit, add back depreciation as well. So we have internal accrual at 6.88 crore. So now comes the real test, whether they can meet 3.14 crore out of 6.88 crore. Now when you look at it, it looks like yes, because they want to use 3.14 crore of 6.88 crore to meet the margin requirement. Okay, so what's your answer? Whether they can use internal accrual or whether they are having adequate internal accrual. What's your answer? They have to invest 3.14 crore out of 6.88 crore. Do they have adequate internal accrual to support the margin? Yes or no? Type yes or no. Are they having adequate internal accrual to support the margin requirement? Because they have internal accruals of 6.88 crore now. And for supporting the margin requirement of this project, what they need is only 3.14 crore. So apparently it looks like they have adequate internal accrual, but the answer is no. Answer is no, no, no. The reason being, they already have a repayment obligation. They are also supposed to repay their existing loan. Okay, they are also supposed to repay existing loan. So look at this. I'm going to show you availability of internal accruals to support margin. Internal accrual, what we have computed is 6.88 crore. And let's say we use the 3.14 crore to support the project. Out of 6.88, if I use the 3.14, what is left over is only 3.74 crore. Okay, out of 6.88, if I use 3.14, what is left over is 3.74 crore. What is the problem? You still have more money, but I have a problem. The problem is like this. I have to repay the existing loan with interest, 1.5 crore. I have to repay my proposed loan. What is that? I have to repay that in 8 equal installments of 91 lakhs every year. I have to pay interest on the proposed loan, which is 88 lakhs. So if I add all the three, my total obligation is 3.29 crore. I have to pay 3.29 crore and I have cash profit of 3.74 crore. So out of 3.74 crore, if I pay 3.29 crore, still I will have some money left, okay, some cash profit left. But let me calculate the debt service coverage ratio here. That is DSCR, 3.74 divided by 3.29. What is the ratio I'm getting? 1.14. Whether this ratio is adequate, what is the minimum debt service coverage ratio insisted by your bank? What is the minimum debt service coverage ratio insisted by your bank? Can you just type the number? What is the minimum debt equity? Debt service coverage ratio. So we have the numbers like 2, 1.5, 1.73, 1.25, and here it is 1.14. So because of this reason, I can say it is not fair on the part of the company to utilize the internal accruals as margin for the project. Am I correct? It's because of this. I mean, they are utilizing 3.14 crore as margin for the project, and because of that reason, their DSCR is coming down. So what ideally they should do? Owners should bring in adequate money in such a way that their DSCR is adequate. Debt repayment capacity is very, very important. I mean, you should not compromise on debt repayment capacity. If you are going and taking up a project which has a DSCR of 1 or 1.14 like this, and if you are sanctioning the project, it means you are knowingly making a mistake. Okay, I won't even say risk. It's a mistake. It's an unpardonable. Okay, I hope you are getting the point. Like most of you said, yes, the DSCR is 1.5. And here, because of utilizing the margin, because of utilizing the internal accruals as margin for the project, their DSCR got affected. Had this not been there, okay, If the internal accruals had been maintained at 6.88, then 6.88 by 3.29, they would have had wonderful DSCR greater than 2 times. Okay, but because of utilization, it is 1.14. So let's answer the question. You are required to comment on acceptability of internal accruals as margin for the project, and for that answer is utilization of internal accruals as margin for the project will affect the repayment capacity, which is evident from the lower DSCR. So this company should be advised to meet the margin for the project out of owners' money. Owners are expected to bring money, not entire 3.14 crore. They can bring a portion of money, and some portion can be met out of internal accruals. In such a way, the minimum DSCR is at least maintained. Did you got this concept clear? Did you got this concept clear related to internal accruals? And if it is a bulb on moment, just type bulb on. If it is a bulb on moment, I mean, if you are able to digest this concept, just type bulb on. That's what more important. When you spend your time, when you sit late night, when you burn your midnight oil, you should have a carry. I mean, you should have that takeaway. Okay. Thanks a lot. Okay. And many of you said the minimum DSCR, right? Many of you. So thanks for all those bulb ons, and I believe most of you would have got the concept clear. And I've seen Mohan Kumar mentioning even one is also considered sometime DSCR. Yeah, one is also okay provided they don't have any issues on working capital side, because for working capital margin should go. If working capital margin is coming from owners funds, absolutely no issue. But if profits are going to be retained to support working capital, or if that business model is such that it is also dependent on the reinvestment of profits for working capital, then DSCR of 1 will be a very risky proposition. Okay, right. How this DSCR is calculated, 1.75, everything we have already discussed under financial ratio part. Now let's move on to two technical areas in term loan. One is break-even analysis, the other one is sensitivity analysis. I repeat, break-even analysis and sensitivity analysis. And whoever watching this in YouTube, once the break-even analysis part is completed, I'll be closing the session in YouTube, and I'll be sharing the direct Zoom link. Okay. So whoever wish to continue the session, you can come to Zoom and attend. Once I complete this break even, I'll be closing the session. Is that okay? Yeah. Let's move on. Just a moment. See, as far as this break-even session is concerned, this recording I've done some 4 to 5 years back, but it will be worth listening, because when you are handling project financing term loan, forget about mortgage loan. Okay, I'm talking about project finance term loan. Break-even sensitivity, they play a very key role, because they will indicate whether this project will survive, whether this project will withstand the possible negativities in future. Okay, so it gives you that critical cue whether it's a strong project or weak project, whether your term loan will come back to bank safely or not. Okay, so the calculation part will look like a little bit of mathematics, but let me tell you, it will be worth spending your time on this. It will be, I mean, hardly it will be like 8 plus 7, 15 minutes. Okay, but it will be worth spending your time on this break even. Shall I proceed? Type GA. GA stands for go ahead. And once I complete the break even, I'll be closing this session in YouTube. Yeah, thank you.
Friends, in this session we will understand the concept of break-even analysis. So before getting into the technicalities of the concept, let us understand some fundamentals. We know from sales, if we remove the cost, we'll get what is known as profit, right? This cost can be divided into two. One is variable cost and the other one is fixed cost. So the cost can be divided into two components. So what I'll do, instead of writing here as a single cost, I'll write the cost or divide the cost into two. So I'll rewrite this now. From sales, instead of removing single item cost, I'll remove the variable cost first. Then once variable cost is removed, what will get something is known as contribution. Because from sales, if you remove variable cost, you will get a profit, and that profit is called contribution, because this portion is what going to contribute for covering the fixed asset and for giving profits to the owners. So from contribution, if you remove the fixed cost, what you will get is known as profits. So instead of single cost, here we have divided the cost into two. One is variable cost and the other one is fixed cost, and finally we landed in profit. Now to understand this in a better way, I'll give numbers. Let's say the sales is going to be 100 and I'm going to tell you that variable cost is 60. So from 100, if I remove 60, I'll get a contribution of 40, and I'm going to give you the fixed cost is also 60. So fixed cost is 60, contribution is 40. So whether this company has profit? No, they have in turn a loss of 20. Now I'll give you another scenario where the sales of the company is 200. And here we have understood that variable cost is 60 when the sales was 100. So the variable cost could be 120 when the sales was 200, and here the contribution is 80. But what about the fixed cost? Whether the fixed cost also would jump along with sales? No, it will not. That's why it is called fixed, and the cost which jumps or moves along with sales is called variable cost. Here 60 has moved along with sales, so 60 has become 120, whereas fixed cost will remain fixed even if the sales level goes up. So here the fixed cost will remain at 60. So now there is a profit. There is a profit of how much? 20. 80 minus 60, there is a profit of 20. But now we are in the session to understand what is known as break-even point. Break-even point is a point where there will be no profit, no loss for the business. See, when the company was making sales of 100, they were suffering a loss of 20. When they were making sales of 200, they were making a profit of 20. We are interested in knowing what is a point of sales at which the company would neither make profit nor make loss. So that is called break-even point. So at break-even point, the profit of the company would be 0. So we understand the profit of the company would be 0, but whether the fixed cost will undergo change during the break-even point? No. During break-even point also the fixed cost would remain fixed at the same level. Let's say it remains at 60. So we understand profit is a result of what? Profit is a result of removing fixed cost from contribution. Here when you remove the fixed cost of 60 from 80, you got the profit of 20. Here when you remove the fixed cost of 60 from 40, you got the loss of 20. Here you have nothing. It means your contribution is equal to fixed cost. If you have a contribution of 60 and fixed cost of 60, you will not have any profit and no loss. So here your contribution is supposed to be how much? 60. So now this is going to tell us something very important, the percentage of contribution to sales. Look at here, the 40 is the contribution when the sales was 100, right? The 40 is the contribution when the sales was 100. It means the contribution percentage is 40. And 80 is the contribution when the sales was 200. So 80 on 200, it means the contribution was also 40. And what is this contribution? How you will get this contribution? You will get the contribution if you remove the variable cost from sales. So if your contribution is 40%, variable cost is supposed to be 60%. So if this 80 is 40%, then 60% is 120. And here if this 40 is 40%, then 60% is 60. Similarly, here you have 60 and you should know what is the variable cost of it. So for that, look at here, when 80 on 200 was the contribution, its variable cost was 60%. See, when the contribution is 40%, variable cost would be how much? It would be 60%. So in our case, what is the contribution? In our case, the contribution is 60, right? So 60 on 40%. 60 is actually 40%. So with this, we'll be able to calculate what is the sales. If the 60 represents 40%, what is 100%? The 100% would basically convey the sales. So if 60 is 40%, 100% is sales, which is 150. So now this would tell us what is the variable cost. So this is 100%, this is 40%. So 60% should be the differential figure. So we understand variable cost is equal to 60%. Okay. So 60% on sales would be, say, 90. So now we have the information of sales, we have the information of variable cost. So we can fit them here. Our sales is 150, variable cost is 90, and contribution is 60. But why all this fundas? Why? What is that we are trying to find out here? The point of sales at which there is no profit or no loss. And how we were able to find out that? We were able to find out by identifying the contribution percentage. So understand the point at which the contribution is equal to fixed cost. The point at which the contribution is equal to fixed cost is a point for break even. So let us summarize. At break even point, there will not be any profit and there will not be any loss, and follow it. At break even point, the contribution will be equal to fixed cost. Contribution will be equal to fixed cost. So till break even point, or break even point is the sales level which will cover all the cost, and if the company wants to make profits, it should achieve the break even level soon, and the sale which is beyond the break even point only would give profit. So profits can be imagined only after break even point.
So in this session, I have given you the concept of break even point. Whether bankers will be using this, yes, in term loan, in project financing, they do the break-even analysis. Okay. So how a typical break-even analysis will be done? Let me explain you that with a case study in next session.
In this session, let us understand how typical break-even analysis will be carried at bank. Okay, so this is case 1. You are given a sample company which has installed capacity to produce product A 30,000 and product B 15,000, and so total it is 45,000. Even though they have capacity of 30,000, actual production is only 24,000. Here it is only 13,500, so total is 37,500. Whereas the capacity utilization, so it is basically linked like this: 80%, 90%. Let's not mind about this figure. And you are also given the sales. It is 4,500. Figures are in lakhs, 500, and total is 5,000 lakhs. Okay, right. Now you are also given variable expenses. You are also given variable expenses. Variable expenses are those expenses which tend to vary as per production. Okay, they vary in proportion to the changes in production. So raw material, generally it is 100% variable. Packing materials, There can be something fixed, something variable. No, packing is linked with your production and sales and all, so we can say this is variable. Consumable, stores, spares, variable. Power, water, fuel. In power and all, there is a possibility for semi fixed expenses, because something will be fixed and something will be variable. Okay, so let's assume that only the variable portion were captured here and semi fixed are taken under fixed expenses. Repairs and maintenance, distribution expenses, interest on working capital and other short-term borrowings. So all variable costs were captured here and it is 2400. What is the sales? It is 5000. So from sales, if you deduct variable cost, what you get is contribution, and contribution only is going to help you to recover your fixed cost. So from A sales, if you deduct B variable expenses, you get C contribution, which is 2600. Now from this contribution C, if you deduct fixed cost, you are going to get your operating profit. Okay, so from this contribution C, let us deduct fixed expenses. So we have various fixed expenses like wages and salaries, other factory overheads, depreciation, sales expense, interest on debenture, term loan, admin expense, royalty. When you deduct all this, you are going to get your operating profit. Now it's time to compute what is break-even sales. Right. See, at break-even sales, what happens at break-even sales? Your contribution will be equal to fixed cost. Your contribution will be equal to fixed cost. But now you don't have exactly the break-even sales. Okay. Why it is not break-even sales? Because you are making profit. At break-even sales, you cannot make profit. There will be no profit, no loss. Okay. So your sales of 5000 is giving you a contribution of how much? 2600. And when your contribution is 2600, you have a fixed cost of 2450. It means your contribution is greater than fixed cost. That's why you are making a profit of 150. We want to reach a stage where profit will be zero, because that is your break-even sales. It means from 2600, when you deducted 2450, you had profit as 150, but now you want profit to be zero. Your fixed cost will not undergo a change. It will be 2450 only. It means you want your contribution also to be 2450. So now the question is, what level of sales will give contribution of 2450? How to find out that? It's simple. When your contribution is 2600, okay, when your contribution is 2600, what is your fixed cost? It is 2450, right? Which level of sales gave contribution of 2600? It is the sales of 5000. So 5000 is giving contribution of 2600 and fixed cost is 2450. So now I am going to create a relationship between these two. If 5000 is creating contribution of 2600, what level of sales will give contribution of 2450? So what is this 2450? This is nothing but the fixed cost, correct? So now we can do a simple cross multiplication. This 2450, which is the fixed cost, multiplied by sales divided by contribution, will give you the sales amount. Okay, so we can make it as a formula. Break-even sales is nothing but fixed cost into sales divided by contribution. Let me bring that here. Look at this. Break-even sales, how it is calculated? We are bringing that fixed and semi-fixed expenses 2450. We are bringing that contribution 2600, bringing net sales of 5000. Okay, so 5000 gives contribution of 2600 how much sale will give contribution of 2450. Okay, so that's what you see here. Break even sales is A into C divided by B. What is A? Fixed and semi-fixed expenses. Okay, this is A into, not B, sorry, C. A into C. What is C? This is net sales. So here you have C, net sales, A multiplied by C divided by B. What is B? Contribution. So this is B, contribution. So 2450 into 5000 divided by 2600 gives you 4711.54. This is the break even sale. What is their actual sale? Actual sale is 5000. What is the break even sale? 4711.54. So it is only the remaining sales that are driving profit for the business, and it would say highly, or we can say this business has highest risk. Why? Because they have to work so hard to achieve break even. Because if you express this in percentage, 4711.54 divided by 5000, it works out to 94%. So only at the 94th percentage they are able to recover all their cost, and only the remaining 6% of the sales is going to bring profit for them. And this business is highly vulnerable. Just imagine there is going to be a small drop in sales. Let's say sales drop by 5% or 10%. Then this business will start reporting loss. Why? Because they have to make a sales of 4711 to break even, to cover all their costs. And if the sales is going to drop by 10%, if 5000 is going to get reduced to 4500, then it's a clear case of loss, right? Because they need a minimum 4711.54. It means clearly it's going to be 211.54 lakhs loss they have to report. Okay, so that's the importance of break-even sales.
So I believe by now you would have got the picture or the importance of break-even, because the businesses that achieves break-even at the earliest, the businesses that has high level of break-even sale, I mean, basically we look at the margin of safety. Okay, so if 100 is the sale and in that 60 is the break-even sale, then that additional 40, whatever sale they make, that only contributes to the profit, and that only ensures this business will service the loan, because break even will take care of interest, cost is taken care, but who will take care of the principal repayment? And we are talking about what? We are talking about term loans. Okay, so earlier the business achieves the break even, better and better is the margin of safety or the security comfort in terms of primary security. Okay, so this is about break even. And I'll close this with a discussion on sensitivity analysis. I'll close this with a discussion on sensitivity analysis. But before that, it's time to say goodbye to participants in YouTube. So now I could see there are 30 plus participants watching this in YouTube. So whoever wishes to continue this session, I've shared the link in description. Okay, this Zoom link is available. So you have to register and you can step into Zoom now. And there we will continue our discussion. So thanks for all who have supported me in today's session in YouTube.